Hey guys, welcome to the first module of our trading course. I'm super excited, super eager, and super stoked to be taking this journey with you. I can't wait for you guys to be advancing with me and learning how to trade stocks the right way. Now, this is the first module, so it's going to be a super quick video. I'm just going to be covering the course objectives and my teaching approach. Now, make sure to check for notes for each module that we have and to do the quizzes for each module. So really quickly, what is the course objectives for this course? Now, first of all, one of the objectives is for anybody who wants to become a day trader. So if you want to become a day trader, this is absolutely for you. So I've developed this course so that if you do want to get into this business, or if you're already trading but want to improve, be more consistent, this will help you get there. Okay. Another objective for this course is for you to be making better investment decisions. Not everybody wants to become a trader. Not everybody wants to do day trading. Some people want to do swing, but some people just want to invest. If you want to invest, it's also very important for you to understand the intricacies of trading and how really all aspects of trading and how that works to help you get good entries in your investments. And that can make a lot of difference, trust me. This course is also the first level of training for our traders. So all the traders that work here have actually went through this course, and that's how we hired them, right? So it is actually, a training module that we've set up for our traders before we hired them. So they're obliged to take it before getting a position here. We also use this course to scout for new talents. So every course, we're going to look at the traders. We're going to see if one of them looks promising. And if one of them does look promising, we'll invite them and bring them over to trade with us. It's very competitive. We get a lot of applicants, but we do use this for scouting for new talent. We also give this course to prospective employees who aren't sure if they want to become traders or not, and they just want to discover the business, right? So before you want to jump into trading, if you have another job, if you're doing something else full time, don't jump into trading right away. Take this course, see how you like it. If you see you like it and this is something that you want to do for the rest of your life, then you might want to jump in. But don't jump in without really knowing what you're getting into, right? A lot of people have misconceptions about what it takes to become a profitable trader. It does involve work. It does involve you learning a lot of new things. So make sure you test the waters first, see if you really love it. And if so, then you can, leave the other things that you're doing and get into that. Now, really quickly, about my teaching approach. Now, I've been in this business for a long time. I've seen a lot of really smart people not make money in trading. And I've seen a lot of people who aren't that smart, okay, make a killing in trading. So what is the difference? And I don't mean not smart, but I mean maybe not with a lot of degrees. So I've seen guys with double PhDs, maths, programmers, super smart, and they've never made a cent in trading. On the other hand, I've seen guys without a high school diploma who are consistently killing it and making a shitload of money. So what's the difference? It's not that the guy without the diploma knows more than the guy with the diploma. Obviously, the guy with the diploma knows more and has more discipline maybe in getting educated. But it doesn't necessarily mean he understands the concept that he's learned. He just knows them. Than the guy who doesn't have the proper education. So it's not really about how much you know. It's about your understanding of these concepts. So what I've decided is to really focus on the concepts that I found most important and the ones that made the difference between the people who are making money and the people who aren't making money, and focusing on those concepts and not just on knowing them, but on understanding, really the issues with them that make the difference and that could lead you to profitability. So really the course is very much based on understanding these concepts and not just throwing a bunch of information at you, asking you to learn them by heart, but really to understand why this happens and how to interpret different types of information under different circumstances. In this module, we're going to be talking about why be involved in the stock market. Now, there's two reasons to be involved in the stock market. Reason number one is going to be to trade/invest your money to generate income. Number two is going to be invest or trade other people's money to generate income. Now, In both situations, your main objective is to generate capital, to make money for yourself, right? So you can go about this in two ways, by trading your capital or trading somebody else's capital. Now, a lot of people trade their own capital, and they do that to either supplement their main income with a side income, or they just trade full time and that's their only income. Their main income is from trading. Now, I believe that everybody should be invested in stocks at one point or another. Like everybody at one point has to be invested in stocks. You know, when you're going to be saving up your retirement funds, your money is going to be in stocks in one way or another. Now, throughout my years and throughout my careers, I've worked at brokerage houses. I've seen a lot of accounts, people with, $500,000 accounts that's for retirement, going from $500,000 to zero because they selected really bad stocks, all high risk, all same industry, gold miners or penny stocks. But I've seen other people going from $500,000 to over $1 million. So you can very easily, and when you're saving up your money for retirement, that's done across decades, 20, 30 years. When you're looking at such a big period, it's very easy to double your cash. It's very easy by selecting good stocks. Now, it's also very easy to lose most of your cash if you select really bad securities. So for me, everybody's supposed to learn about trading and about investing, because if you're willing to work 20, 30 years of your life to have X amount of capital that you can retire with, well, why not spend 6 months or a year learning how to invest and double that amount of capital? Why not double it by spending a few months to a year learning when it takes you 20 or 30 years to make it, right? And not risk losing it, right? So it makes no sense for somebody not to get educated about investing, because everybody has to invest at one point or another. Now, this is one way that you can go about it, investing your own capital. Now, the other way is finding other people that you can invest their capital or trade their capital. Now, to do that, first you got to be good, okay? So, example, there's a lot of companies that fund traders. Now, to get into a company like that, you got to prove that you're good. So, when I hire a trader, I want to see their track record. I want to see if they are performing well, if they are making cash. So, start off trading your account. And if you're performing good, if you have, a year of track record to show, or even, 8 months of, consistent profitability, you can see a company, show them your track record, and they can fund you. They'll give you a funded account. Then you can trade with way bigger amounts of money and keep a percentage of those returns. So that's a very good situation to be in, because you have no risk in terms of capital, and you have very, very high rewards if you're performing good. So these are the two ways that you can make money in trading. You got to start off by trading your account, proving that you're good, and then you can move on to even trading other people's accounts. And regardless of what you want to do and what's your end goal, you have to learn to trade and invest, because it is something that is super important. It will make a difference for you. And you are going to have to do it at one day or another. Hey guys, in this module, we're going to be talking about something super simple. What's a stock? Now, a stock is basically just a security that signifies ownership in a corporation. So basically, by having stocks in a company, you have claim on that company's assets and earnings. So basically, their buildings, their equipment, and all the money they make, part of it is yours because you're partial owner of that company. So by having stocks in a company or shares, these are synonym words, stocks and shares, it's the same thing. So if you have shares in a company, you're basically partial owner of that company, and you have a claim on their assets and their earnings. Now, why would a corporation issue shares or stock? And why would somebody want to buy stocks in a corporation? Well, very simple. So imagine this. Imagine you're an entrepreneur, you like electronics, and let's say you sell drones, okay? You're making and selling drones. And you're selling drones to your family, your relatives, and in your community, and you're making good money doing that. Now, you think drones are going to be a big thing in the future, so you want to go global or even nationwide, right? So you want to sell way more across the globe. So what do? You need to open more stores, right? How would you do that? You need capital. Now, let me get on my whiteboard here. So imagine this. Imagine right now, this year, you're able to make $100,000 by selling drones in your community, right? Now, you're 100% owner of your company. This is your company, and let's say we're going to call it DRN for drone. So you're 100% owner of this company, which makes $100,000. Now, you want to go nationwide, open stores everywhere, okay? Let's say you want to open 5 stores, and each store that you're going to open is going to cost you about $1 million, okay? So it's super expensive having drone stores. Again, this is just an example. Numbers don't need to make sense. So where are you going to get $5 million? You can't collect $5 million by making $100,000 a year. Is going to take you way too long. So you need investors to give you that money, right? So what you're going to do is you're going to sell shares, sell stock in your company for them to give you the cash that you require. So if you require $5 million in total to open these stores, you're going to tell investors, look, I'll give you part of my company. I'll give you shares in my company. And let's say you give them 50%. Okay. So maybe you're going to give them 50% of your company. So they give you $5 million for you to open all those stores. And by you having all those stores, you're going to be able to make way more money. Okay. So let's say with 5 stores, you can make $2 million every single year. Okay. So even though you only own 50% of your company right now, that 50% is worth way much more because you make way more money now. So that 50% you're still gonna make $1 million every year in comparison to only $100,000 every year. So even though you have less shares in your company, you're able to make way more money because your company is way bigger, right? So this pie here is way bigger than this pie, okay? So it's actually a very good idea to sell shares in your company when you want to grow your company and you need the capital. If you don't want to grow organically, because that might take too long, right? So why would a corporation issue stock? Because they want to grow. They need the capital to expand, and they're willing to sell part of their company to you to get that capital. Now, why would an investor want to buy shares in a company? Again, very easily, to participate in the growth of that company, because that person who's investing will own part of the company. So they'll participate in the growth of the company and make money through their earnings and their growth, but without even putting in work, just by owning the shares, right? So somebody else is going to be doing the work and they're going to be collecting money. Now, for traders, what we want to do is we want to look for mispricing in the price of a stock, because again, when we buy or sell a stock, it has a price. If we can evaluate at what point that price is too high or too low, and we find the mispricing, we can take advantage of it and profit off that mispricing. So this is really why you would want to companies issue shares and why investors or traders would want to buy shares in a company. Now, let me just open this real quick here. Now, how can you buy a stock? What do you do to buy a stock? Now, there's 2 ways to buy a stock, and it depends if a stock is private or if the company that you're buying is public. Now, how and where can you buy stock? Well, it depends. If you want to buy stocks in a private company or if you want to buy stocks in a public company. Now, what's a private and what's a public company? A private company is basically a company that has a relatively small amount of owners and that doesn't trade on a public exchange. A public company is a big company that trades on one of the public exchanges. So when we're talking about Apple, Amazon, Netflix, all these big companies, Facebook, they're public companies. Now, before they were public companies, they were private companies. They were smaller companies at one point that didn't trade on an exchange, okay? So in the same example that we were talking about, where if you wanted to open a drone company, initially it would be a private company, right? You would have a few investors and that's it. It wouldn't be public. Then there's a process for a private company to go public, which we'll cover in a later module. But this is what you need to know about that for now. So you can't just walk down the street and see a restaurant that somebody opens and invest in it, right? Because any restaurant, that's a private company. If somebody has a store, it's their private company. You can't just walk in and say, hey, I'm buying shares in that company. To be able to buy shares in a private company, you got to know the owner. You got to be either a friend or relative of the owner or somebody who works there, or you got to be a qualified investor. So you got to have a lot of cash. You got to be rich. And that's the only way that you're allowed to invest in a private company. So it's not easy to invest in private companies. And because of that, it's not easy for private companies to get funds when they need, right? Because they got to know somebody who's going to be able to give them the funds, or they got to know some people who have a lot of money. Now, public companies, on the other hand, anybody can invest in them. It doesn't matter how much money you have. You don't need to know the owner. You don't need to know anybody at the company. You can just call your broker, call the bank, tell them, hey, I want to buy shares in Facebook, and that's it. You got your shares. So there's a very big difference in private companies and public companies. When we're talking about buying and selling stocks, we're only talking about public companies because these are the only shares and stock that we can buy. And that's the only stocks that trade on exchanges. Private companies don't trade on exchanges. And again, if you want to invest in a private company, you got to either know the owners, somebody who works there, or you got to be a qualified investor. With a qualified investor means that you make, and it depends, each state and each country is different. But let's say, for example, in Canada, you got to be making more than I think either between $200,000 or $400,000 every year for the past 3 years, and you got to have more than $2 million worth of assets under your name. So you got to be rich enough that you're financially savvy to be able to understand how private companies work. Again, so private companies, very hard to buy shares in, but public company, extremely easy. And that's what we're going to be looking at in this course. Hey guys, in this module, we're going to be covering what's a market. Everybody knows what a market is, right? We go to markets every single day. A market is basically just a location where you go to buy and sell products. It's a location where people go to do commerce. Now, there's a lot of different types of markets. There's clothing markets, there's electronic markets, there's grocery markets. So markets are characterized by the product that they specialize in, right? So there are markets that are more general where you can buy and sell different things, but some markets are very specific where they only deal in one type of product. Now, we're used to one type of market. The market we're used to is a market where we go, the prices are already set, and we can either accept them or refuse them. Example, when you go to a grocery store, apples might be at $2 a pound. You can either accept that price or leave. You can't say, no, I want to get it for cheaper. You can't bargain. So that's the regular type of markets that we're used to. Now, there's another type of market, and that market is called an auction market. An auction market is a market where buyers can compete on the bids that they're willing to pay for a product, and sellers can compete on the offers that they're willing to sell that product for. Imagine this. Imagine if you went to a grocery store and instead of having apples at a set price, in a basket, you had 20 different people, and every person in that group held an apple and was saying, I'm willing to sell it for, $2. And the other person might say, I'm willing to sell my apple for $1.90. Somebody else for $1.85. So every single seller would be competing on what price they're willing to offer you the apple. And then all the buyers, instead of just accepting or not, they come out and say, well, I want to buy an apple for $1. And somebody else might say, I want to buy an apple for $1.10. So all the buyers are also simultaneously competing on the bid prices that they're willing to pay for that apple. So obviously that would never work in a grocery store or in the type of markets that we go to. But that's exactly how the stock market works. It's an auction market. There's no set prices. Buyers are bidding for the best price that they're willing to pay for that stock, for that product. And sellers are offering, how much they're willing to sell their product, their stock. And it's all going on simultaneously and continuously throughout the trading day. And that's how prices are set. Now, that's what a stock market is. So we're going to be focusing on that, obviously, throughout this course. Now, there's two types of markets. There's the primary market and there's the secondary market. Now, what is the primary market? The primary market is the market that the stocks trade in for the first time ever. So the first time that a stock is issued, goes out to the public, that's the primary market. Secondary market is every other time it trades after that. So it's basically second hand. Every time the stock has been traded second hand, somebody already owned it before you, you're in the secondary market. Now, the way it works is when a company is private, and again, let's go back to our example where we said you opened a drone company. And let me get on my whiteboard here. Okay, here we go. If you open a drone company and you decided that, okay, you had your initial drone company that was making about 100K a year, and then you went private, right? And you got $5 million of revenue to open a way bigger company, okay? That was making about $2 million every year. Now imagine you want to go one step further. You want to grow your company even more. So you want to go public, right? You want to go from private to public. So you get a way bigger company. Now, if you want to go public, what are you going to have to do is you're going to have to get funded. You're going to have to do an IPO, which is what we call, okay, an IPO. I'll put it here. IPO, which is initial public offering. And this should be in the notes for this module, right? So you got to do an initial public offering. Initial public offering means you're going to sell the stocks from your company to the public for the first time ever. So out of this company that you have and you own with investors, you guys might sell, part of it to the public, okay? And the public is going to pay you for it so you can have an even bigger pie and even grow more, right? So now, how do you do an IPO? You got to hire another company, which is going to be called an underwriting firm. So underwriting firms basically specialize in doing IPOs. So they're going to come in, they're going to see you, they're going to look at your company, they'll tell you, okay, you're making $2 million in revenue. This is the plans that you have. You want to expand here, there, you want this amount of money, you have this much debt, your product sells for that price. Okay, we can probably get you $100 million. So they're going to figure out how much they can get you through an IPO, and they're going to figure out what's the best price that they can sell your stocks at in the beginning for them to be able to sell you the amount of shares that you want to sell, right? So they're experts in that. And obviously, that company is going to want to give you the best amount of money that you can come up with without asking for too much, because if they ask for too much and your IPO fails, you're not able to get that money, then they're going to have a really bad reputation. So for them, they want to get you the most money. At the same time, they want to be able to sell all the shares so they maintain their reputation. So it's very important for them to come up with an exact price and an exact amount of money that they can come up with for you, right? So in this case, they might say, okay, well, we think we can raise you $100 million, 100 million. Okay, we're gonna sell 1 million shares, okay, at $100 each. So we're gonna IPO at a price of $100 and we're gonna sell 1 million shares, so you get your $100 million. That's what they're gonna do. So once they decide to sell those million shares, that's gonna happen in the primary market. So this company, the underwriting firm, is going to call all their relationships, their brokers, the banks, big insurance companies that they know and they have a relationship with, and they're going to call them. They're going to tell them, hey, look, I have this new company. It's called DRN. They make really good drones, and they're going to be a really good company. I have some shares I can give you, 100,000 shares in it. Do you want some? I'll allocate you some shares for that IPO. And they're going to sell those shares to all their relationships. And that's going to be the first time that the shares are sold, which is going to be in the primary market. So those companies, the brokers, everybody who gets shares can give some of those shares to their biggest clients. So if you're a very big client at a big brokerage firm, you might get some shares of that company. Example, when Snapchat or Facebook went public, and they went, from here to here, who could get the IPO price? Who could buy at the primary market? Very few people. We couldn't get any. A lot of people couldn't get any because you had to be a very big client of a very big firm to be able to get some of those shares because they're so hard to get by, right? So we rarely trade in the primary market. We rarely get shares in the primary market because it's so hard. You got to be somebody very, very big to get shares in the primary market. Now, after those shares are sold in the primary market, then there's a date where the stock starts trading on the exchanges, which we're going to come to in the next module. But then when these shares start trading in that exchange, they start trading in the secondary market. So whenever you or I buy something on NASDAQ, New York Stock Exchange, that's all secondhand. These stocks were already sold. They already IPO'd. They're in the secondary market now. We're selling them and buying them from other people who had them. We're not the first people to get them ever. When you're the first person to get the shares ever, you've got them in the primary market. When you're not the first person to get them, it's secondhand, you're in the secondary market. So we're always going to be talking about the secondary market when we're buying and selling securities because we're not the first people to get them, right? Hey guys, in this module, we're going to be covering what's an exchange. Now, we've already talked about markets. A market is a general term that relates to where stocks are trading. Now, when we're talking about exchanges, we're actually talking about the exact location where the trades are being executed. So imagine this. When I say grocery stores, I'm talking about markets. If I go and say the specific store exactly, meaning, Whole Foods or Walmart, these are exchanges. So both of these exchanges where you can go buy food from are grocery stores, which is the market. So same thing with stocks. You have the stock market, but within the stock market, you have different exchanges that you can go to. So different stores, physical locations that you can go buy and sell stocks from. So New York Stock Exchange is an exchange. It's a location that you can go to buy and sell stocks. NASDAQ is another location where you can go and buy stocks. They're both stock markets, but they're different exchanges, right? So just so you understand, I'm going to give a brief history lesson, if you want to call it, for how stock exchanges were born. So initially, back in the time, let's say in 1700s, almost 1800s, when you wanted to buy or sell a stock, you would have to find somebody who wanted to buy or sell that same stock from you at the exact prices that you were willing to buy or sell it at. So if you wanted to buy 100 shares of General Electrics, you had to find somebody who wanted to sell his shares of General Electrics. And you want to find somebody who wants to sell them at the price that you're willing to buy them from him. So it wasn't easy. People back then would have to put it in the journal or try and find somebody on the streets, ask around. It wasn't simple. You didn't have a computer where you can just put it in and you match with somebody else. So it was a bit of a hassle. So what people used to do back then, they would meet. There were these regular meetups that people would have in the town halls and in the centers of the city. And they would meet and they would trade stocks with one another. So one of those locations was in New York. People would meet there every Thursday, either at noon or at 2 p.m., something like that. They would meet every week. And these were groups of financially savvy people. They had stocks in different companies. And they would like to meet so they can buy and sell those stocks with one another easily instead of going through the hassle of trying to find a counterparty. Now, this became very popular and a lot of people started meeting with them. And that specific group that was in New York started growing bigger and bigger and bigger as more and more people started to come on that day to trade the stocks. Then they started meeting more than once a week, then more than twice a week. So what happened is a group of these traders who actually started this, who were meeting there first before everybody else came, started to see that it became a hassle dealing with so many people. There were too many people coming around. So they decided to meet and sign an agreement with one another called the Buttonwood Agreement. Now, they called it the Buttonwood Agreement because the meetup was always underneath a tree called the Buttonwood tree. I don't know why it's called that. And in that agreement, it said, we're not going to trade stocks with anybody else but ourselves. Okay? There were 24 guys. We're only going to trade with ourselves. And if somebody else wants to buy or sell stocks from us, we're going to charge him a commission of 0.25%. So that's how we're going to do it. So that way it stops becoming as hectic and we can profit off of them. And then we know everybody's going to have to buy and sell stocks from us because we have the most stocks and we're a group of people that are going to have the majority of the stocks at this location. So people had to go through them. Now that worked out very well for them. They moved from under the tree to the coffee shop next door. And again, that agreement was made in the 1792. That's when they signed it up. And just a year later, they moved from that coffee shop and they bought the building right in front, which is what is now known as the New York Stock Exchange. So that's how the New York Stock Exchange was born. And these 24 people were the 24 original brokers. And again, there's going to be another module about what a broker is. But a broker is somebody who you have to go through to buy or sell the security. And these were the 24 original brokers. And they hold through this day. There's more brokers, obviously, but that's the same concept works, where you get to call your broker and he buys it and sells it for you. So people would have to go see them and they would either buy or sell the stocks for that person with another broker. Now today, there's three main exchanges that exist. There's the New York Stock Exchange, there's NASDAQ, and there's Amex. New York Stock Exchange is the biggest and most demanding exchange. Now, the way you gotta see it is an exchange is like a store. And to have your product in a store, the store has to accept having it. Same thing with exchanges. If you want your stock to trade at an exchange, you have to go ask the exchange for your product to be listed on that exchange. So if Snapchat wants to be on an exchange, they gotta go ask the exchange. And if they go see New York and tell them, hey, can we put our stocks on your shelves so people can come and buy and sell it here on this exchange? New York has to accept them. Now, New York is a very demanding store. It's a very demanding exchange. They have the most demanding criteria out of all the exchanges. So you got to be a really big, and when I say demanding, it means they're looking at the size of your company. You got to have a big company. You got to have a minimum amount of employees. Your price has to be over a certain price. Your stock has to trade over a certain amount of times every day. So they have criteria. Now, the second exchange is NASDAQ. NASDAQ is less demanding, is very known for having tech companies. So most tech companies are on the NASDAQ exchange. Now, different stocks trade on different exchanges. They don't trade on all the exchanges. Again, it's like having an iPhone. If you want to buy an iPhone, you can't go to Walmart to buy it, maybe. But you can go to the iPhone store to buy it. So you can buy it from that store. Same thing with stocks. You can buy different companies at different exchanges. Some companies very rarely are intra-listed on more than one exchange, but mostly they're going to be on one exchange. So when somebody tells you, hey, where's the stock trading at? It's trading on New York or it's trading on NASDAQ. They're talking about which store is it trading at? Where do I have to go if I want to buy it? This store or that store? Now, the third exchange is Amex. Amex is an exchange that caters to ETFs, exchange traded funds. Now, ETFs is something we're going to get into in another course, in another module, but most ETFs are going to be on the Amex exchange. So these are the three exchanges that you need to get familiar with for all the stocks that trade in the United States. Now, different countries are going to have different exchanges that you're going to have to look up. Hey guys, in this module, we're going to be covering what's a broker. Now, we've already talked about this in the other module. A broker is somebody who you're going to have to go through to buy or sell a stock. So when you want to buy a stock, you got to call your broker, let him know what stock you want to buy, and he's gonna have to go and see if another broker's client wants to sell the stock that you want to buy, and if your prices match, so you guys can transact with one another. Now, we've talked in the other module about how brokers were born. Now, initially, if you wanted to buy a stock, you would have to contact your broker either through mail, and then with the advent of the telephone, by telephone. So you would call your broker, and then he would find your counterpart. Now, brokers, as they became more and more busy, hired floor brokers. So they hired another person that would go out on the floor of the exchange, run, and you know when you see in movies people screaming at the top of their lungs, I want to buy 100 shares of, GE at, $100, $101. These were, the floor brokers that were acting on behalf of clients, trying to buy them the shares. And if another one that wanted to sell at the same price matched with them, then there would be an execution, and you would have your stock. Now, back then, it would take a lot of time for you to get your trade. It took a few minutes before the broker would have time to get there, contact his other floor broker. Other floor broker finds your match, signs it, and gets you the trade. Now, it's still the same structure. It just got way faster. With time, it got automated, so you could enter your orders, what you want to buy, through a computer, and the computer would send your order directly to the exchange, and then your broker would get it there. Now, with time, brokers didn't have to be on the floor anymore because there's a matching system, a computer on the exchange that receives automatically your order. And if there's another order that matches with it, the executions happen instantaneously. You still have to go through your broker, so you still got to call your bank, who's going to be your broker, and tell them I want to buy this. Or you can even send it online, but it still goes through your broker and it goes to the exchange where it's matched right away. So even though the same structure exists, it's way more automated because the human intermediary has been removed and it's been automated right now. But you still got to go through your broker. You still got to pay that commission to them for them to route your order there and do the other paperwork. Hey guys, Mohsen here from the future. I'm here to notify you about a few changes. So ever since creating this course, I've actually started a new company called Bloom Trading in place of MTG. So when you're going to be doing this course, you're going to see a lot of social media handles for my old company, MTG. Do not look at these, do not go follow them because I've changed all of these and there's now completely new social media handles for my new company, which is called Bloom Trading. Now, I'll put the social media handles here, website, YouTube, Instagram, Facebook, all of it is going to be on this side. My personal social media handles on this side, they're exactly the same. They haven't changed. So pause this video, go and follow us on all of these social media links. But when you're doing the course and you're seeing these other social media handles for MTG, do not follow them, do not go there. They've been removed. So they're not going to lead to anywhere. So very important. Do this right now. So later on in the course, when you see these other social media handles, you just disregard them. All right. So that being said, also, if you want to know more about the changes and about Bloom, just go on the YouTube channel or on the website. There is going to be a video there about the differences and the changes. There's going to be information on the website. So just go follow us everywhere and get that information. And that being said, I'll see you guys in the course. Hey guys, in this module, we're going to be covering orders and order types. So let me ask you this. What do you have to do when you want to buy or sell a stock? Now, we've already been through who you got to contact, which is your broker. But what do you got to tell him? And how do you tell him that? So it's very simple. You actually got to send him an order. Tell him an order of what exactly you want him to do for you. So back in the days, you'd have to send him a letter. With time, you could just give him a call. But nowadays, you can just go online and send your broker your order of what you want electronically. Now, even though the orders and what we put on them haven't changed over time, the way we transmit them has changed. And we're going to cover that in a later module. But today, let's talk about what exactly do I need to put on my order. Now, I'm pretty sure all of you know that already, but you're going to have to let your broker know what is it that you want to buy? What is the stock that you want to buy or sell? So the first thing is the name of the company. Now, we're not actually going to give your broker the full name. We're going to give him something that's called the ticker. Now, what is a ticker? A ticker is just an abbreviation for a name of a company. So, for example, Microsoft's ticker is MSFT. So if you want to buy Microsoft, you can just tell your broker, I want to buy MSFT. Citigroup's ticker is just the letter C. So whatever company you want to trade, buy or sell, you got to know its ticker, right? What is the second thing you got to tell your broker? Well, the side of your order. What is the side? Well, basically, is it a buy order or is it a sell order? Do I want to buy the stock or do I want to sell it? So either a buy or a sell. Now, another thing you gotta tell your broker is the type of order. Now, there's a wide variety of orders. We're gonna be covering the two basic orders today, the most basic orders, and we're gonna cover some more advanced order types in later modules. So in this module, we're gonna cover the two simplest orders. The first one, which is the market order, the simplest of all. The second one is the limit order, which is the second simplest type of order. So your type of order could be a market order. For now, we're going to cover market order, and we're going to cover, market and limits. So what's the difference between a market and a limit order? Very simple. A market order basically tells your broker that you want to buy or sell that stock immediately. No matter what price it's at, I just want to get my execution. I want to get that stock. A limit order basically tells your broker, I want to buy or sell that stock at a limit price or better. I do not want to get a worse price than the price I'm telling you to get it at. So when would you choose a limit order and when would you choose a market order? Very simple. You'll choose a market order when it's time sensitive, but it's not price sensitive. So if you really want to get the stock right away and you don't care what price it is, send the limit order so you get it. Now, if you care about price, but you don't care about waiting for the stock to reach that price, then you send a limit order. Because for example, if you send a limit order to buy a stock at $10, but it's at 11, you're not going to get it. You're only going to get it at 10 or better. The problem with the limit order is if the stock never reaches that price and continues going up and never reaches that price, you're never going to get it. And you might just miss the opportunity and miss that move. So the problem with a market order though is you might get the stock right away, but you might get a bad price. And if you would have been more patient, you could have gotten a better price. So you always gotta know when to use which one, and we're gonna cover that in another module. But these are the two most basic order types. Now, if you give a market order, you don't need to give your broker a price. But if you used a limit order, in this case only that you use the limit order, you're gonna have to give a price to your order, right? And you can say whatever, $10, whatever price it is that you want to sell at, or buy at, if it's depending if it's a buy or sell order. Now, what else do you need to put on your order? The quantity. So how many shares of that stock do you want to buy or do you want to sell? So quantity is another thing that you need to put on your orders. 100 shares, 200 shares, 300 shares. So let's say 200. So these are really everything that you need to put on an order that you send to your broker. Again, nowadays, very simple. You log in online, you can put all of these in, click send, and your broker gets your orders right away. So this is going to cover this module, and I'll see you guys in the next one. Welcome back. In this module, we're going to be covering what makes prices move. A lot of people think news or events make prices move, but the actual thing that drives prices is orders that people send. And we're going to see that through an example in this module. So make sure you look at the notes that are accompanying this module. We're going to go through an example. And let's say you've started your own company And we can use the same example that we've used before, the drone company. So your company has a ticker that's DRN, let's say. Now, the listing exchange, which we've talked about before, might be, let's say it's New York. So your stock is trading on New York Stock Exchange. Okay. The shares outstanding. Now, shares outstanding is something we haven't talked about yet. Shares outstanding is the amount of shares that your company has. Okay, now let's say your company had 100,000 shares outstanding. Again, we've already covered shares outstanding. It's the amount of shares that were issued by the company. Okay, so shares outstanding, let's put it up. Shares outstanding. You have 100,000 shares. Okay. Now there's something else that we haven't covered that's called the float. The float is actually the amount of shares that are currently trading on the market. So it's not because a company has 100,000 shares outstanding that it has 100,000 shares of float. Because a company might be holding some of its shares for itself, or some of its shares might be locked up somewhere and they're not trading. So the shares that trade on the market right now is what we call the float. For example, let's say that your company has 75,000 shares of float, meaning there's 75,000 shares that are trading on the market right now. If you want to buy all the shares on the market, you can buy 75,000 shares of that stock. So there's a 25,000 shares that are locked up somewhere, either by the company, either by some private investors somewhere that are not available on the market at this time. Okay, so if you look at the notes, let's say, and we're going to give an example that's very simplistic. Let's say the whole world, okay, the whole world is composed of 10 people. Now, obviously, this isn't the case in real life. There's millions and millions and billions of people, but a lot of people who trade the market. But let's say there's only 10 people in the whole planet that have access to trading and that can trade right now. And these participants, it's on your notes. You have participant 1 who has 40,000 shares in this company. Participant 2 has 10,000 shares, and make sure you're following along with the notes and filling it up as we're doing it here. Participant 3 has 2,000 shares. 4 has 0 shares. So not everybody needs to own stock in that company, right? Some people might not want any of it. Participant 5 has 2,000 shares. 6 has 5,000 shares. 7 has 1,000 shares. 8 has 0 shares again. Participant 9 has 10,000 shares, and participant 10 has 5,000 shares. Now, that being said, they own shares in the company, but they haven't traded that stock yet. If you go on the market to see what's the price of that stock, there's no price, right? Okay, so now this situation represents the whole world. Now, again, I only named 10 participants, but let's imagine that that's the whole planet right now. So these 10 participants own shares in your company, okay? They haven't traded the stock yet. So we're going to assume that your company IPO'd, which we covered earlier, and they got shares in the primary market for your stock, but now they haven't traded it yet. How do they trade those stocks if they want to buy more shares or if they want to sell some of their shares? They got to send an order to the market, right? So this is exactly how it's going to happen. So let's put it on here. Okay. So you'll see in the example, participant 1 wants to buy 3,000 shares at a limit price of $41. So how would he do that? He'd have to send an order, right? And on his order, it'll have to say the price, the limit, and everything we've covered in the previous module. So $41 is the price he would like to buy at. 3,000 shares. And that's it, right? Obviously, you're going to have to put on your order that it's a buy order. You're going to have to put the ticker on your order. And that it's a limit order. Now, you give this order here to your broker, okay? So, again, previously, You can mail it to him, you can call him on the phone, tell him. Even nowadays, some people call to buy something. But now you can just put it on your computer. It's going to go through your internet, goes through your broker, and he sends it to the exchange. Now, when it arrives to the exchange has a computer very similar to an Excel sheet. And that computer is actually a matching system, a matching algorithms that matches buyers and sellers together to get executions. Now, once that order gets there, it goes on their system. They have two long columns, a column on the left and a column on the right. In the column on the left, they put all the buyers. The column on the right, they put all the sellers. So since you're a buyer, they're going to go on this column and put your order in here. So you want to buy at 41, 3,000 shares. And they'll just leave it. And they'll wait until somebody else comes, matches your price to give you an execution. Now, participant number 2 here wants to buy 5,000 shares. So let's fill this one up at $39. Again, his order is going to come true, goes to the exchange. Now, where is his order going to go on the book, on the matching system of the exchange? Above it or below it? It'll actually go below it, because the way they set it up is there's a price priority for buyers. So the higher you're willing to buy a stock, the better your priority is. So you're going to get an execution before him because you're willing to pay more. And for the sellers, well, the lower you're willing to sell, the higher priority you're going to have. So their algorithm has a price priority, then a time priority. So the person who has the better price is on top. But if two people are at the same price, then the person who came first has priority. Again, we have participant number 2 who wants to sell 5,000 shares at $55. Now, you might ask yourself, well, participant 2 already sent an order to buy. Well, he can send orders to buy and sell, because remember, he has 10,000 shares. So he wants to buy some more if it goes to $39, but he might want to sell if it goes higher. So participant number 2 wants to sell 5,000 shares at $55. So let's put it here. So $55. I'll actually use this one. $55. He wants to sell 5,000 shares. Okay. So when the exchange gets this order, it'll actually go on the seller's side, right? Now, this is starting to look like something familiar, maybe for some of you. This is actually what we call the level 2, or the book, right? It's actually a large book like that. We call it level 2, or sometimes we call it the book. And what it represents is it represents every single buyer and every single seller that's out on the market. Okay? So, and from the book, we actually create something that we call the level 1, which most of you might be familiar with. Level 1 is actually the best price, the best bid, and the best offer that's available on the market. So the best price that somebody's willing to buy a stock at, and the best price that somebody's willing to sell a stock at. So it's going to be this price and this price, right? So this $41 and 3,000 shares and $55 and 5,000 shares is what we call the level 1. So whenever somebody calls their broker and tells him, hey, what's the level 1, or give me a quote on that, they're asking for this. At what price if I want to sell right away, at what price can I sell at? Well, $41 because there's a buyer here. And if I want to buy right away, what price can I buy at? Well, you can buy at 55 because there's a seller at 55. So that's the bid and ask. This is the bid, this is the ask, and this is the level 1, which is created from the level 2, from the book. And the book updates every time somebody sends an order on it. And the level 1 is going to update every time the best bid or the best offer changes, right? So again, seller 2 wants to send another sell order, this time at $59 for another 5,000 shares. All right, so we'll just grab this here. Right here. Okay, so this is where it goes because he wants to sell at $59, which is a worse price than 55. 55 is going to have priority. So this one goes down in the book. Right? So we have two buyers here, one at $41, one at $39, and two sellers, one at $55 and one at $59. Now, there has been no trading yet. So if you go online to look at a chart or if you go online to look at a price, there's only bid and ask, but there's no execution. There's no last price where the stock has traded at because there's no two orders that have matched together yet. Okay? And let me see here. So number 3, participant number 3 wants to sell 2,000 shares at $52. So $52, 2,000 shares. Where would his price go, right? So it would go on the sell side, but where would it go? Would it go here? Would it go in between these? Or would it go at the bottom? Again, $52 will go on top, right? Because if you're a buyer, you'd prefer buying from the guy who has $52, not from these guys. So he's going to have priority. So in the book, these prices are going to scoop on down and this order is going to get on top of them. So this happens on the computer of the exchange. Okay? Now, what does participant number 4 want to do? Doesn't want to do anything. Okay? And that's okay. Not everybody in the world is going to send orders. Participant number 5, what does he want to do? He want to buy 1,000 shares at $50. So $50, want to buy 1,000 shares. So let's bring it here. Okay, so where is this one going to go? Let's see, 50 bucks. 50, that's a worst price. Then, so if you're a seller, who would you want to sell to? 39, 41, or 50? You'd want to sell to the guy who's willing to buy at 50, right? So 50 is going to go on top. So these ones are going to go down. And you'll see here. And actually, before I put this one, when this changed, you see 55 changed and 52 came on top. Well, something had to change as well. The level 1 should have changed because if you want to buy, you don't have to buy at 55 anymore. You can buy at 52. So the level 1 updates at this point. So if you're looking at your computer screen, you're going to see that the level 1 updated. And now you can buy at 52 instead of at 55. Now this buyer comes in. He goes on top. Like this. Okay. Again, the bid changed. So what is going to happen? The level 1 needs to update again. So this changes. And here, the bid is going to be 50 and it's 1,000 shares. So the level 1 updates every time this updates and the book updates. So when you're looking at traders and their screen is constantly updating, that's what you're looking at. You're looking at orders coming in and these orders affecting the book or affecting the quotation for that stock. Participant number 6 wants to buy 2,000 shares at $48. So 48 wants to do 2,000 shares. Okay. Now, where would this go? Buyer comes in, goes right in between here, right? So it's worse price than 50, but better price than 41. So this one is going to go down. This one goes down, and this one goes in between. Again, no trades yet. Participant number 7 wants to sell 1,000 shares at 1,000 at 51. This one. 1,000 shares. Okay, now where would this one go? Again, as a seller, it goes on this side when it reaches the exchange, up, and it'll actually go above this one because it's actually a better price than 52. So this one is going to go down, and then this one is going to take its place. Now, what happens? Again, the level 1 is going to change. It becomes 51,000 shares. All right, very simple. Again, no trades happened so far. Now comes in participant number 8, who wants to do 5,000 shares at $46, and he wants to buy 5,000 shares at $46. So 46, 5,000 shares. Okay, so 46, where is that gonna go? It'll go right below 48, comes to the exchange, goes on the bid side, drops down, and goes right here. And that's it. Your book updated. Does the level 1 update? No, because these prices didn't update it. The best book, the best ask didn't update. So that doesn't update. Now participant 9 comes in and says, hey, I want to sell 5,000 shares at the market. So he wants to sell, right? He doesn't want to put a price, he just wants to sell. So he sends his order in, and on his order, it says, there's no price. It only says 5,000. It says market order, MKT, and it says 5,000 on it. So his broker gets it, sends it to the exchange, and again, what does he want to do? He wants to sell. Since he's not putting his order in, he's actually sending it to the buyer side because he wants to sell. So he wants to execute with these guys. He wants to sell them. They want to buy, he wants to sell. His order gets there and sees, oh, there's somebody who wants to buy 1,000 shares at $50. I'm going to sell my shares to him. So let's take him off. I'm going to sell 1,000 shares to this guy. And then as soon as that happens, we actually go on another item that's called the time and sales. Okay? And this is something else. So we have the level 2, the level 1, but we also have the time and sales. The time of sales is something that the exchange has to report on at every execution that happens. And on it, they gotta put the name of the stock that you're trading, the time that the trade happened at, the quantity, and the price that it happened at. So right now, there was 1,000 shares traded at $50. So they're gonna put, the time, let's say 1 p.m. They're gonna say $50, and then they'll put 1,000 shares. So that just happened. Now for this order, he wants to sell 5,000. So there's still 4,000 shares left. There's 4,000 shares missing. So his order keeps going down the line. Next person in line is a buyer who wants to buy he wants to buy at $48, 2,000 shares. So he gives him 2,000 shares as well, right? And in the time of sales, it has to update again. So it's still 1 p.m. This happened instantaneously, right? Within nanoseconds. So what price was it? $48, 2,000 shares. That's done. The order still needs another 2,000 shares to be completely filled. So it keeps going down the line. And oh, here's a buyer. This buyer wants to buy 5,000 shares, but it's $46. Okay, well, I only want to get 2,000 more. So I'm going to sell him the last 2,000 that I want. And he's still going to be wanting 3,000 more. So basically, I completely filled my order. And again, it's going to come up here, 1 p.m., $46, 2,000 shares that were executed. That seller, so participant number 9 is completely done. He got all his order. this participant who wanted to buy 5,000 shares at 46, well, he got a partial fill. Partial fill. So he got part of the fill that he wanted to get, and his order is still open to try and get the rest. So he still wants to buy 3,000 shares. Now, remark what happened. What happened is actually that because of the seller, we finally got an execution. Finally, somebody traded. And this came out on the time of sales. Now, if you actually go online and check, and let's say for this stock right now, what price is this stock trading at? You'll see that it's trading at $46 because this is the last price that the stock has executed on. So actually in the level 1, there's another line for price. And the price is actually the last price that the stock traded at. So in this case, $46. So $46 goes on here. So if you'll remark, the level 1 is actually an abbreviated quotation system for both the level 2 and the time of sales because it gets the best book. And again, the level 1 is going to update again because now what's the bid? It's 46. So it's not 50 anymore. So this updates. So this becomes 46 and 3,000 shares. So you'll remark that the level 1 is an abbreviation for the book. So it gives you the best bid and the best ask, okay, and puts them on here. And for the time of sales, so gives you the last price and puts it on. So by looking at the level 1, you can just get a general idea of the market. What's the bid? What's the ask? You know, the quantity that's on the bid on the ask, and the last price it traded at. But if you want to get a bigger picture of what's been going on, who are the buyers, who are the sellers that are available on the market right now, well, you need to look at the level 2. Okay, and that's available through a lot of brokers, which I'm going to name in other modules. And you also need to look at the time of sales because you want to see, well, how has the stock been trading in the previous, minutes, hours, or, day. You want to look at what is the execution that's going on. Obviously, we use the time of sales for short-term trading because we want to look at the order flow. How are people trading right now? Is it going down, up? But you would like to have these two tools to give you more information. Okay? So let's continue with the example. Now the book has changed. This goes up a bit. And this is the new state for this stock. These are the buyers, these are the sellers. Now, participant number 10 actually wants to buy 5,000 shares at $53. So let's put it up here. $53. 5,000 shares. Okay? So he sends his order to the broker. His order gets to the broker. Now this is a limit order. But now it doesn't go to the buyer side because it's at $53. Since it's at $53, it can execute with the seller right away. This person is willing to buy at $53. Well, there's somebody who's willing to sell at $51. So I can buy from him right away. I don't need to go here and wait. I don't need to wait in line. So it actually goes to the seller side and says, okay, well, hey, there's somebody who's willing to sell at 51. I'm gonna buy from him. So this guy is executed. Now, what happens? It's written on the time of sales. Again, let's say 2 p.m. now. Time passed. $51 is the last trade. And then 1,000 shares. Okay? Now, the order still wants another 4,000 shares. He only got 1,000 off this guy. So it keeps going down. Oh, $52. I'm willing to buy at 53. So I accept that price. So this guy gets executed. Okay. Here, still 2 p.m. $53. And 2,000 shares were executed. Okay. Now, this guy still wants 2,000 shares. Okay. You might not see it, but he wants 2,000 shares. Now, he goes here, but the next seller is at $55. So he can't execute with him because he's only willing to buy at 53. So he can't get executed with him. So his order is going to come back here on the buyer side and it's going to remain open for another 2,000 shares. So he got a partial fill. He got 3,000 shares out of the 5,000 that he wanted. The remaining 2,000 shares are going to stay open on the bid side, on the book, hoping that a seller comes in and gets the rest of the execution, right? So it stays here, and this becomes the new state of the book. Now, level 1 has to update again. The bid now is $53. The ask became $55. The quantity on the bid is 2,000, and the quantity on the ask is 5,000. Right? And the last price is now 53. So price went up. Right? So it was 46, now the price is 53. So if you think about it, what made this price change? Why did the price go up right now? It was 46 bucks, now it's 53 bucks. Is it because a news came out? Is it because this is a good company or a bad company? What is it really because of? It's because a buyer sent an order to buy. Somebody sent an order to buy. Now we can argue that somebody would send an order to buy because it is a good company or because there was good news. But sometimes people buy and sell for different reasons. So at the end of the day, it's basic supply and demand. Supply and demand is shown through the order book on the exchange that you can have access to very easily, a level 2. See all the buyers, see all the sellers. And the price is going to fluctuate based on solely the orders that people send. Now the orders can be affected by different ways and you can try and predict why people are going to buy or sell. But that's why price is going to move. So when people look at a price movement, they got to understand it's coming from these orders matching with one another on the execution system, on the matching system at the exchange. Right? So again, and this is one of the reasons a lot of people get confused when a company has good news and the stock plummets. And they ask themselves, well, why is the stock going down? Well, because maybe somebody sent an order to sell, a big order, and there wasn't enough buyers. So at the end, it is supply and demand. So a few things I want to cover, or terminologies basically, is first, the bid. So we talked about that several times. The bid is going to be the best price that you can buy at. The ask is going to be the best price you can sell at. Okay, so that's the bid, that's the ask. The spread is going to be the difference between the bid and the ask. Okay, that's the spread. So the difference between the best person who wants to buy and the person who wants to sell. Now, why is the spread something important? Imagine this. And I'm going to erase this right here. Imagine this. There's a stock and the spread, or let's say the bid here, is 50 and the ask is 52. Well, if you want to buy the stock right now, where can you buy it at? At 52. Now, if you buy it at 52 and you completely change your mind and you want to sell it right away, where are you going to sell it at? At 50. So you basically lost $2 right away, even though the stock hasn't moved. Okay? So you actually, what did you lose? And $2 on a $50 stock, that's 4%, right? Which is huge. There's actually not a lot of stocks that have such a big spread. But for example purposes, you're going to lose $2 right away, even though the stock hasn't moved. So you lose the spread. So when you have something that has a big spread like this one, you got to watch out by not sending market orders too often, because if you send a market order and you're buying at whatever price is available, and then you change your mind and you send another order to sell, well, you just lost this right away. But if you send a limit order and try to buy at this side, you can save a huge percentage return. So you gotta watch out for the stock you're trading. Does it have a big spread or a small spread? If it has a small spread, like a lot of companies, if you're looking at Facebook or other of these big companies, they have a 1 cent spread. So if you buy and then you decide to sell right away, you only lost a cent. But some more smaller companies or liquid companies, they're going to have a way bigger spreads. And there's a lot of stocks that have $1 and $1 something spreads. So you got to watch out for that. Now, level 1, we covered it. There's also the NBBO, which is the National Best Bid and Offer. The NBBO is basically the best bid available and the best offer available. For now, let's assume the NBBO is the exact same thing as the level 1. In the microstructure course, I'm going to cover more about bids and asks and ECNs, and we'll see what the difference is between NBBO and level 1. But for now, it's basically the same thing. The best price to buy at best price to sell at. Time of sales we saw, and level 2 we actually saw. And this is really going to conclude the level 2, level 1, and the time and sales. These are things that you really need to grasp. So really rewatch this video, and that's going to conclude this module. I'll see you in the next one. Hey guys, in this module, we're going to be covering the different players and how you got to trade against different participants. Now, in the last module, we've talked about the book and how orders affect prices. So let me ask you this. Imagine you knew what other people wanted to do, right? It would have been easier for you to predict where the stock market is going to go, right? So again, with the same example that we've covered in the previous module, imagine there's 10 people. And you know that one of these people is somebody who owns, and you can look at the notes from that module, there was a participant that owned 40,000 shares out of the company that had 75,000 shares of float. So he owned a majority of the shares. Imagine that you could have known that this person wanted to sell some of his shares. You would know that the price might drop because such a big player who has so much shares, if he wants to sell, we've seen that prices are going to fluctuate because of his order. So prices, if he sends an order to sell, prices will fall, right? Now, different players trade differently, and this is something you have to understand. A mutual fund or somebody who has a lot of shares is not going to trade like somebody who is just sitting at home, a retail trader. Again, the same thing in poker or in different sports and different sectors. Different participants participate differently. Okay, so in this situation, if you knew that that person is a big mutual fund, has 40,000 shares, what could you know? You could know that as a mutual fund or a big institution, he's going to try and sell his shares when there's a good news, because that's the only time he's going to be able to unload so many shares, right? He can't sell shares when the stock is going down because he'll just, make the stock tumble. So he has to wait when there's a good news for there to be enough buyers so he can sell them those shares and unload his shares. So if you knew that somebody was a big mutual fund and he wanted to sell his shares, you might sell in front of him. And if there's a good news that come out, you're not going to buy right away because you know that there's this seller. And this is why a lot of times you're going to see a stock that has very good news and then it's going to drop 10%. And people aren't going to understand, well, why? The news is good. Why did it drop? Well, maybe because a big mutual fund wanted to sell its shares. And they are known to sell on good news, right? So wouldn't it be helpful for you to have known that this specific stock has a lot of institutional ownership, has a lot of mutual fund and hedge fund ownership? Yeah, it would have. So, and this is information that's publicly available, but it never ceases to amaze me how many people don't know about it. And some people might tell me, well, I have this stock, and I ask them, well, what's the institutional ownership on that? And they'll be like, I don't know. Well, how can you not know? You're trading this stock. Wouldn't you want to know who you're trading against? Because at the end of the day, trading is a zero-sum game. And what it means is for every dollar that you put in your pocket, it came out of somebody else's pockets. So you want to know who you're playing against because that's the person you're taking money from. Same thing in poker. If you go play at poker and you're at the top level of poker players, you're extremely experienced. Well, at this top level, what do you think differentiates these players? They all know how to calculate probability, right? They can calculate the same odds of how much they can win or lose. They're all as good as playing their turn or their hand, depending on what position they're playing. So when they're going to play at that high level, they study the other players that they're going to be playing against. What's their style? Do they bluff a lot? How do they play? How do they call? So that way they have every advantage they can have, right? Same thing in sports. If you're getting to the finals and you're playing against a team, you're not just practicing to be a good basketball player. At that level in the championship, you're going to practice specifically for that team because they play in that particular way. Same thing in stocks. Prices are going to move because of the buy orders and sell orders that people are sending or the participants are sending. So you got to know who are those participants because they're going to send orders in a different type of manner, right? So that being said, for every stock that you're going to trade, you want to know what is the institutional ownership on that stock. Is there a lot of institutions that own that stock, like Facebook has 70% or higher? Or does it have no institutional ownership? So there's a lot of things that have zero institutional ownership. So it's all retail flow. It's all retail people who are buying it. And stocks trade differently for or strategies work differently for stocks that have high institutions and for stocks that have low institutions. Lower institution retail are easily likely to explode in a direction or another because on good news retail are just buying. They're not going to offload on good news and for different reasons which we'll cover in more specifics in other module. But keep in mind, this is something that you're always going to have to watch out for, the players that you're playing against. Now, really quickly, who are the different players? First off, you have proprietary trading firms, which is like us. Now, proprietary trading firms are what are smart. They're considered smart money. They know what they're doing. So they're trying to take advantage of small inefficiencies in the market and get in and get out quickly. Okay? So these guys have a lot of tools and information and access and commissions and fees. So they're very competitive. Another type of players are investors. Now, investors, they just come in and buy stocks, and they keep them for a while. Okay, so they're not trading; they're putting in money and leaving it for a longer term, a longer period. You have your retail traders. Now, retail traders are traders who trade from home, who don't have a lot of sophisticated tools or information or strategies. Now, for these people, that's considered dumb money because it's easy money to make. So as a trader or a professional trader, somebody who does this in a smart manner, you want stocks that have a lot of retail flow because, again, you're taking money from somebody, so you want to play against people who aren't as smart as you, right? Portfolio manager, which are, mutual funds. So these are big funds, okay? A mutual fund is a big fund that people put money in and has a portfolio manager. The portfolio manager oversees those funds and buys and sells stock with those funds. So it could be hundreds of millions of dollars, following a prospectus that the clients agreed on. So, he might say, I'm putting 20% in financial stocks, 20% in gold stocks, and he's going to follow that. But he's going to pick and choose the stocks that he thinks will make you the most money. Now, mutual funds haven't been performing very well in the past. They actually perform worse than ETFs. So if you just put, and we'll cover ETFs in more detail in another module, but if you just put your money in the markets, you'll actually outperform mutual funds. So, and the reason for that is because mutual funds, the portfolio manager takes a manager expense ratio. So he takes a fee every year, about 2%. And this kind of adds up. It takes away from the money you get. And he doesn't actually do well enough to beat the market. So mutual funds aren't really good to put money in. You're better off taking the time to select your stocks, even if you're an investor. But it is one of the big players because mutual funds are going to buy a lot of shares in a company. And when they sell a lot of shares. So you're going to have to know about that. And you can know which mutual fund has which stocks in their holdings. And you can know how they're going to trade those stocks just by knowing that they have it. Because it is known that when mutual funds have a stock that's been performing very well, they're going to try and remove money from that stock to take some money off the table, take some profits off the table, and put it in something that's still undervalued and that's not overvalued anymore. So we can guess what other players are going to do. And by guessing what other players are going to do, we can guess what the stock is going to do. Because at the end of the day, you're not trying to guess where the stock is going to go. You're trying to guess what other people are going to do. Because what other people are going to do is what's going to drive the stock to go in that or this direction. So don't try and predict, is that stock a good company? Is this stock not a good company? What you want to do is try and predict how are other people evaluating that stock? Because of their evaluation, that's what's going to drive their orders. And because their orders, that's what's going to drive prices. So you want to know what other people are going to do from now on and in the future. Okay? Other type of player is the hedge funds. Hedge funds are very smart money. They're like mutual funds, big capital. Not anybody can put money in a hedge fund. So you have to be somebody who's rich enough because there's very strict minimums. And hedge funds can do more than mutual funds, so they can go long or go short, which we're going to cover in another module, what going short is. So hedge funds can do all of that. They're way more sophisticated than mutual funds. They're smarter. They tend to make more returns. And they're very, very discreet. So we can't really know what positions they have up until, several months after. So when it's too late. So really, hedge funds we can't really know about. But these are the top players. And for every stock that you're going to trade from now on and every strategy, you're going to look at institutional ownership and base your strategy on that. So this is going to conclude this module, and I'll see you guys in the next one. Hey guys, in this module, we're going to cover the 3 ways to make money in the stock market. Now, the first way, very simple, is going long a stock. What is going long a stock? It basically means I'm buying the stock. So you buy a stock, you expect it to go higher, and you sell it at a higher price and you make money. That's the easiest way to make money, right? Again, if you buy it and it goes down, you're losing money, but that's going long. Now, there's another way to make money, and this way is the one that's less common. It's going short. And what going short means, it means that you're betting that the stock is going to go down. So you want to make money if the stock actually drops in value, okay? A lot of people go short, but not a lot of people know about it. So you might ask yourself, how do I sell a stock that I don't originally own, right? How can I bet that a stock is going to go down? Because by betting it's going to go down, what you're actually doing is you're selling it at a high price. And when it goes to a lower price, you buy it back at that lower price. How can you sell something you don't own? Well, by borrowing it. So the way it works is you actually have to borrow those stocks. Now, who do you borrow it from? You borrow it from your broker. So very simple. All you have to do is, if you're looking at a stock and it's trading at $10 and you think the stock is going to go down to $8. So you want to sell it at 10, and when it goes back to 8, you want to buy it back at 8. How would you do that? You call your broker, tell them, hey, I want shares of this company ABC. Can you lend me some? Now, your broker has a lot of other clients. Your broker is going to look around. He's going to see that, oh, some of my clients have shares in this company. I'm going to take it from them. I'm going to give it to you. Now, I'm not going to tell them that I took it from them. So they're not going to know anything happened, right? They're sleeping. They don't know. They think their shares are still in their account, but they're not. I'll give you the shares. Now, you go out, you go on the market, you sell those shares for $10. Now, you got $10 in your account. As predicted, the next day or the next week, the price falls down to 8. Now, you still have $10 in your account. You can buy back the shares at $8. So you buy them back at $8. You still have $2 in your account. And you have the shares. Now, you can call your broker, tell him, hey, here's the shares. I'm giving them back to you. Your broker gives them back to its original owner, puts them back in the account. The original owner never knew they were gone, so has no idea what just happened. And you're left with $2 in your pocket that you made out of thin air. Because you sold something that you didn't own, and when you bought it back at a lower price and gave it back, you made that difference in price. So you can short stocks. You need a margin account to short stocks. You can't short them in any accounts. We're going to cover margin accounts in another module. So you can short stocks when you expect the stock to go down. Now, there's dangers in shorting stocks. And it's only because of this. Because when you're shorting a stock, how much money can you make? What's the maximum amount of money you can make? Is the price that you shorted at. So if you shorted a stock at $10 and it drops down to $0, how much money did you make? You made $10. Now, how much money could you lose? Well, if you short a stock at $10 and the stock goes down let's say it goes up to $14. What happens? You're losing money. You gotta give back that stock. You're not gonna hold it an infinite amount of time. You're gonna have to give it back to its original owners. So if you buy it back at $14, you actually lost $4, right? So if you buy it back at $14 and then give the shares back to the broker gives it back to its owner, you had to buy it at a higher price than you sold it at. So you lost $4. Now the problem with this is what? Is that the price can go up not only to 14, it can go up to 20, 100, 200, it could go up to infinity. So the amount of money that you can lose is infinite, but the amount of money that you can make is limited. When you're going long, it's the opposite. The amount of money that you can make, that you can lose is limited, but the amount of money that you can make is infinite. So you really want to watch out for shorting stocks. And another issue is that in the long run, there's a natural drift of stocks going up. So stocks tend to go up with a little bit more probability than they are likely to go down. So it is something that's riskier. The very good thing about shorting stocks is when stocks go down, they go down extremely fast. But when they go up slowly. So a lot of traders, and this is one of my favorite things to do, is to pick stocks that I feel are going to break down and short them very aggressively because I can make a lot of money in a short period of time. But I never keep my shorts for a long amount of time because it's not a good thing to do in the long run. You just want to short for short amount of times because if there is something that's going down, it's going to happen quickly and then it might recover. Now, this is going long, this is going short. These are the two ways that you can make money, but now I add the third way. And that way of making money is called being flat. Now, what is being flat? Being flat means having no positions. A lot of new traders come in and they think they always have to be in the market. They always have to have a position, be long, be short, to be making money. But you can actually be making money, but by not being in a position. Because if you're not in a good position, you might lose money. So by not losing money, you're actually making money. So being flat, having no position, you're avoiding the risk of losing money. So you're actually making money by not losing it. So very important, if there's no good opportunity, if you don't have something solid, if you don't know, if you didn't do your research and you're just busy somewhere else, you don't need to trade. You can be flat. You can have no positions. And that is going to be a way for you to make money. Every good trader, if he's busy, if he's not focused, don't trade. Be flat. That's going to be a good position to be in. So these are the three types. These are the three ways that you can follow to make money. And that's going to conclude this module. And I'll see you guys on the next one.
Hey guys, this is a very important video that I wanted to make to warn you about something that's been going on for the past few months. For the past few months, there's been a lot of fake accounts, fake profiles of me online that are trying to scam individuals. So I want you to be extremely careful if you are following me online. Now, this is happening in two places, on Instagram and on YouTube. First, I'm going to talk about Instagram. If you're following me on Instagram, these are the only two profiles I have. These are the two only accounts. My personal account, where I post most often, and my company accounts. Now, I do recommend you follow me there because I do post about current positions I have and things that are happening in the moment. But if you do go and try to follow me, you're going to notice that there's a bunch of other people that are using my name online. Now, they're going to have the same pictures as me. They're going to post the same stories as me, same comments, same everything. The only way you can know if it's my account or if it's somebody impersonating me is the handle of that account. These are my only two accounts. Other accounts, even though everything else is going to be similar, the handle, the name is going to be slightly different. There might be an extra L at the end, an extra 7, an extra underscore, an extra dot, something very small that you might not notice. So you've got to be careful to not follow an imposter, somebody who's pretending to be me that is trying to scam you out of your money. Now, even if you follow the right account, even if you follow one of my official accounts, what these people do is they monitor everybody who follows me and they message them directly. So if you follow me on Instagram, somebody else is going to message you pretending to be me. Now, you might fall for this. A lot of people don't, but some people do. And it kind of makes sense because you follow me and then all of a sudden you get a message from somebody who has my picture, who has my name, who has everything that looks like me. It's only the account that looks slightly different. You might not notice that. Now, these people aren't me. I'm going to tell you how to figure out if there's a fake profile of me or if you're actually talking with me. Well, first of all, number one, I will never message you first. So if anybody ever messages you first with my name, it's a fake account. Please report that account. I will never, ever, under any circumstances, message you first. Even if you follow me, even if you comment on my picture, for any reason, I'm not going to do it. Number two, these people are going to talk to you and they're going to try and sell you something, right? The first thing they do is they try to get you off of Instagram. They're going to ask you to give them their WhatsApp number, or they're going to give you their WhatsApp number. Again, number two is I never give out my phone number. I never give out my phone number for any reason. When there's something very important, I usually do this by email, but most often I actually have somebody who answers my emails. So again, I do not give my phone number. If somebody gives you or tries to take your phone number, it's a scam account. Report that account right away. Number three, these people will try to sell you something. They'll try and sell you mentorship. They'll try and sell you an investment account, a trading account, a robot. Every time it's something different. I don't have any of these things to sell. Not one of them. Okay? Nothing. There's nothing for me to sell you. The only things that I have that I sell online are some online courses on Udemy, and those are available on Udemy's website directly. So if somebody messages you about selling you anything with my name, it's not me. Report them right away. But number four, these people will usually ask you to make the payment for whatever they're selling you via Bitcoin. So they'll ask you to send them Bitcoin. Don't ever do that. Don't send Bitcoin to anybody online. If you ever send Bitcoin, you're never going to see that money again. So this is a warning message that I wanted to give you, because if you are following me, they're literally messaging every single one of my followers. So just be extremely careful. Again, I don't have anything else to sell other than the things on Udemy, and that's done through Udemy directly. I will never message you first. I'll never ask for your phone number or, ask you for Bitcoin or anything like that. If anybody messages you with my name, please report them right away. Actually, before reporting them, if you want to mess with them for a bit, that would actually be really nice, because maybe if everybody messes with them for a bit and wastes their time, they're going to stop doing that. I don't know, but I wanted to warn you about that. Now, this isn't only happening on Instagram. This is also happening on YouTube. And YouTube, it's very tricky. So if you go on my YouTube channel and you follow me there, in the comment section, what these people will do is they'll create a fake account that looks exactly like our account. And they're going to comment their phone number under different messages. And I can understand people falling for that, because let's say you're watching one of my videos on YouTube. You go down in the comment section and you see a comment with the same picture as our channel picture, with the same name as our channel name, and it posts their phone number, their WhatsApp number. It says, contact me. This isn't us. These people are creating fake YouTube channels, putting the same name and same profile picture, and putting their phone number. So people see that phone number and they think it's us. And I understand you can think it's us because, again, same picture, same name. But that isn't us, and they will try to scam you. So be careful even on YouTube. This isn't something that's been happening just to me. It's happening to a lot of Udemy instructors. It's happening to a lot of YouTubers. Stephen Graham actually made a video about this. I'm going to actually link it here or put it down in the comment section, where he shows how it's happening under his channel.
We're talking about the comment section. What used to be a place for healthy discussion, back and forth banter, and honest criticism has now turned into a playground for scam artists who create a web of fake conversations for the sole purpose of trapping unsuspecting victims who believe that they could earn money using the techniques of insert name here.
So this is something that's very widespread. It's happening to everybody, everybody who isn't too popular, a little bit popular, who has a following, who talks about finance or different products. There's people who create fake accounts of that person and try to scam his following. So I want to post this video everywhere. I want to make sure that all my community knows about this and to be very careful, because even though 99% of people don't fall for this, there's that 1% that they just don't notice and it happens to them. So please, guys, be extremely careful. I'm never going to message you first. If somebody messages you with my name, please report them right away. Don't send Bitcoins to anybody online for any reason whatsoever. And I'll see you very soon.
Hey guys, so one of the most popular questions I get is, which broker do I most highly recommend? So here it is. Interactive Brokers is the broker that I most highly recommend by far. And I'm going to explain why. Now, we're actually in February 2019. If this ever changes, and for some reason I don't recommend Interactive Brokers anymore, I'll update this video and I'll say which broker I recommend at that time. But if this video you're saying, that means this is still the case. Keep going with Interactive Brokers. And this is a broker that I've been using for a long time. And it's still by far one of the best. Now, why? Let's see. First of all, you have access to a lot of exchanges. So, usually, let's say I'm living in Canada. If I go to my bank and I open an account with my Canadian brokerage account, I would only have access to Canadian exchanges and US exchanges. That's it. And if you live somewhere else, you might not have access to other exchanges that you would want to trade. Now, with Interactive Brokers, you have access to all these exchanges. So if you want to trade North America, well, you can trade exchanges in the United States, or you can trade Canada, Mexico. If you want to trade Europe, no problem. You can trade Australia, Belgium, Estonia, European Union, this is for bonds, France, Germany, Israel, Italy, all of these countries. Okay, you can even trade Asian countries, right? So Australia, Hong Kong, India, Japan, Australia's there, Singapore, South Korea. Yeah, so basically you have access to many exchanges, which is pretty good, right? Second, they have a huge select of shortable stock. So like we've said before, if you want to short a stock, you have to borrow them from somebody, and you borrow them because your broker lends them to you. So Interactive Brokers, since they have so many clients, you have access to borrow shares of almost any company, and there's usually huge availability for those stocks. And something else that they have that's pretty nice is that you can actually check how many shares are available. So if you want to share Facebook, if you want to short Facebook, you can put Facebook here, search, and we see, okay, Facebook. So Facebook Class A shares. Check availability. Oh, there's more than 10 million shares available to short. Just on Interactive Brokers. So huge. Let's say if you want to look for Snapchat. How many shares are available for Snapchat? Okay. Snapchat, they have about 950,000 shares. So obviously Snapchat less, and it is a highly shorted stock usually, so there's going to be less. But you can check, on their website. So pretty good. And again, they're able to do that because they have such a huge client base. So another point. Something else. Their fees. How can we forget about the fees? Commission. Their commissions are super low. So if you want to trade US stocks, $1 a pop. Doesn't get any lower than this. Canada, $1 a pop. So depending on which exchange, the fees are different, but they're very, very affordable. So again, a very good point. What else? Their platform. It's called TWS. It's an amazing platform. You can have the app for it, you have the web version, and you have the app that you can open. And it's a very complete platform. You have charting, you have volumes, news, you have integration with other things. You can put your order book in there. There's just a bunch of things. They have an API if you want to code the software that connects to it. It's a complete software. And there's a demo version of it that gets, I guess, made up data, so you can test and make sure it's connected correctly and you know how to send orders. And there's the simulation version, which is what I recommend you start with. The simulation version is going to be like the live version, but the difference is that you're going to be playing with fake money. So as you're practicing, you have to start with simulated trading, so you practice and make your mistakes while playing with fake money. And they have that. They have a simulation version. It's great. So 100% you should start with that. And the platform is amazing. Another point that I don't want to forget and I don't want to undervalue is their customer service. Usually online brokerages don't have really good customer service, but to be honest, with Interactive Brokers, I've always had such great experience. If there's anything, I go on the chat and there's a representative that comes and fixes whatever issue I'm having within a minute. And if they can't, I don't mean like they connect with me within a minute. It sometimes takes a bit longer, but they're there and they can connect you with somebody else through the chat and you get everything resolved, usually without even calling them. So That being said, this is the brokerage firm I recommend you start with. There's a lot of bad brokerage firms out there and a lot of good ones. So, if you don't like this one, do your research. But do your research well to make sure you're not going with a broker that's maybe even cheaper, but that's really bad and gives you really bad executions. You don't want that, right? So that being said, Interactive Brokers is what I recommend. Hey guys, so here is a shareable Google Sheet that I created to help you find resources, and that could be brokers, news providers, charting softwares for the country that you're trading in. Now, the reason why I did this is because, with time, I've had more and more students, and I now have students in more than 150 countries, I believe, or 140. So it's students from all over the world. And I often get questions about, which news provider do I use for this country? And I don't know, right? Because I don't know for each country what are the best tools you want to have, because there's just too many countries. So what I've decided to do is create this shareable Google Sheet where students can help each other and find resources and contribute by giving resources that they know about and looking at other people what resources they're using. Now I've created this in my third trading course on stocks, but now I've decided to add it again to the foundation stock trading course since it is a best-selling course and I'm updating it to keep it relevant always. So the way this sheet works, it looks like this. There's going to be a link for this sheet in the description, right? Once you open it, you'll have a section for brokers. Actually before going here, you'll see at the bottom there's different countries. So you have US, Canada, India, UK, Australia. And then if your country is not there, because this is a relatively new sheet, just post in the Q&A section under this lecture that you would want me to add this country and I'll add it, okay? So once you get into it, it's a shareable sheet. So if I add something, everybody's gonna see the new update at any time. So you'll see all the new updated information. For each country, there's gonna be a section for brokers, and this would be the brokers that I have, the websites and their commission and any information. There's gonna be screeners, okay, which ones you would want to use. Also, if they're free, if there's a subscription model, the fees, news providers, charting software, other resources, okay? And there's gonna be that for each country, right? Now, the way it works is since I don't know about all these news providers in each country, if you find or if you know a resource that is not on the list, all you have to do is go on here and let's say for, Canada, you think that there's another news provider that I haven't added. All you have to do is come here, right click and comment and tell me, hey, I think you should add, CBC news, whatever, okay? You tell me, you explain it, and you give me the website. You tell it's www.cbc, .ca, whatever it is, the website, okay? And you comment it. Now, that's the only thing you can do. You can just do comments, and you can't edit this, you can't do anything. Now, on my side, what happens is I have a version where I can, change things. So basically here I see that, oh, there's comments. I can go here and I can see that somebody said you should add this. Now what I can do, I can reply to him like, okay, I'm checking it out and blah, blah, blah. And I can reply. And then in the end, if I decide to resolve it and add it, I'll add it here. If I don't think that this is a good, resource, I'll just not add it and I'll reject it, okay? And if I reject something, I'll usually put it at the bottom here. So, so people don't ask me several times for the same thing. So if I reject something, I'll put it at the bottom. And in this way, you guys have, all the resources that you can need. It's easier for me because I obviously cannot, find all the resources. And it's also curated, so I'm always going to filter it. So if somebody tells me, this is a good news provider, I'll make sure it's a good one before approving it and before adding it to the list. So you'll know that anything on this list is, it's probably good. And then you also can help
other people that might be trading in your country. So yeah, this is it. Check it out. Look at the websites, go through them. You'll find things that are beneficial. And if there's something that you're using that isn't there, make sure to add it so you can help other students in the course that might, benefit from that. Hey guys, welcome back to the complete foundation stock trading course. Super happy for you to join us for the next chapter, which is going to be about technical analysis. Now, if you don't know what technical analysis is, don't worry. I'm going to explain it profoundly. So, in this lecture, what are we going to talk about? We're just going to do a quick introduction to technical analysis. I'm also going to go over all the material that we're going to learn in this chapter. So, we're going to be talking about charts. Obviously, you need to know how to read charts to be good at trading. Candlesticks. If you don't know what that is, don't worry. We'll go over it. Trends. So if you heard all those sayings, the trend is your friend, don't go against the trend. That's what we're talking about. We're going to go over support and resistance. We're going to go over chart patterns, volume, and why it's so important. We're also going to go over moving averages and indicators. So let's jump in, and we'll start off by doing a little introduction about what technical analysis is. So when you're looking at stocks, you have two ways to try and predict where a stock's price is going to go. And these two different type of methodologies that you can use are either technical analysis or fundamental analysis. So it's two different things. Some people only do fundamental analysis and they swear by it and they think technical analysis voodoo. And other people only do technical analysis and they swear that fundamentals don't work. So you have the two spectrums. Now, my belief is that both are useful in different circumstances. Ask yourself this question. Before you ask yourself this question, what is technical and what is fundamental? Fundamental analysis is when you're evaluating something fundamentally. So the stock fundamentally, right? So how many employees do they have? What's their tax system? How is the political environment for them? What's their revenue, their expenses, their debts? All of these things are fundamentals. When you're looking at technical analysis, you're only looking at price and volume. So you don't care about anything else. You don't care about who's the CEO, what's their revenues, how the industry is doing. You only care about the price and the volume of how many shares are being traded. Now, when should you use which method? Okay, that's the big question, right? And should you use both or just one, or, So let me ask you this. If you were to buy a house, what would you look at to try and evaluate if it's a good price or a bad price that you're getting, or what's the value of that house? Now, before you answer, it's going to depend on your situation. That's the thing, and what you want to do with the house. If you plan on buying the house just to flip it, sell it back the next day, the next week, are you really going to look at the material that was built for the house, if it's heat isolated, if the pipes are good, the neighborhood? No, you're not really gonna look at all of this stuff. If your objective is to flip the house, buy it today, sell it tomorrow, the only thing you're gonna care about is the price of houses nearby. How much did they sell at? Are they selling or not? Is their volume? Are houses selling in this neighborhood and at what price? That's the only thing you care about, because you're buying and you want to sell right away. Now, if you were buying and keeping the house for 50 years, then you wouldn't really care if houses in the neighborhood are selling right now and what price. What you would care about is this house gonna last? What's the material that it's built? Is it heat isolated? If you want to save on utilities, is there going to be new constructions around? All of these little things, right?
that will matter in the long term. So the way you're going to evaluate your property is going to depend on your time horizon. How long do you expect to hold that house for? If it's for 10 years, you're going to use fundamentals. If it's a week or two, then you're going to use technicals, right? And it's the same thing in trading. In trading, you're going to use fundamental analysis if you're a long-term investor. You want to know everything about the company, what's the prospects for the future, their revenues, their leverage, their debts, all of these things. So then you can evaluate the price of the company, and if it's mispriced, then you can either buy or short that security, or usually buy because you don't want to short long term if it's mispriced, because you'd expect the price to get to its fair value in time. Now, if you were just planning on trading it intraday, are you really going to care how many employees they have, or their revenue, how much revenues they're making, or their earning growth for 2 years or 5 years down the road? Or no, not really. All you care about is supply and demand now. How is it moving right now? What price is it trading at, and how many shares is it trading? So price and volume. So really, when we're going to be looking at technical analysis, day traders, swing traders love looking at technical analysis because we're short-term traders, right? If you go in long-term, then you got to do a lot of fundamentals. Now, I'm not saying that you shouldn't learn any fundamentals. You should know a bit of fundamentals because sometimes there's going to be news that comes out and it has to do with fundamentals. So you should know how that will affect the stock. But in terms of actually doing fundamental analysis, that's for long-term investors, okay? So really in this course and in this chapter specifically, we're going to dig deep in technicals and really understand how these chart patterns will tell us at what price and in which direction we should buy or sell, okay? So that's going to conclude this short lecture. It's just an introduction. Next lecture, we're going to be going on charts and then candlesticks. All right, see you next class. Hey guys, welcome back to our complete foundation stock trading course. Now in this lecture, we're going to be covering something very interesting, charts and candlesticks. Now, you've probably all heard of charts before. Some of you might have not, so we're going to go and explain it exactly what that is, right? So this lecture, we're going to be talking about line charts, we're going to be talking about candlestick charts, then we're going to be talking about candlesticks. Now, what is a chart exactly? Let me pull one out. When you're looking at something like this is a chart of a stock, and you've probably all seen a chart before. When you look at something like this, what are you actually looking at? You're actually looking at historical prices for a product. This could be anything. It doesn't have to be a stock. Let's say this is iPhone prices. Well, you can say, okay, well, this is how iPhone prices fluctuated throughout time. On this day, April 17th, the price of an iPhone was $234. And on this day, in June, well, it was $243 or $44. So all a chart is the transactions or the prices that a product traded at each time point in time. So it's really just a graphical representation of historical prices. So when you look at it, you just know what prices the stock traded at during those times. So it gives you an indication of supply and demand throughout time. If prices were going up at a certain point, then that tells you that demand for this product or the stock was higher than supply, and that's why prices went up. If prices are going down, that means more people wanted to sell that product and less people wanted to buy it. Okay, so that's really all it means. Now, when we look at charts, that's all nice, but the real reason we're looking at them is because we want to try and use them to predict where the stock is going to go in the future, based on how it moved in the past. Okay? So, and I'll talk more about this platform in a few moments. So let's get started. So what kind of charts do we look at? Okay, we're going to be looking at line charts and candlestick charts. So let's get right to it. And I'm going to tell you why we only look at line charts and candlestick charts. Because these are the two only type of charts that you're ever going to use. So there's like 6 or 7 different charting. There's Japanese charting and there's a bunch of different charting ways that you can use. None of them are useful. These are the two only ones that you're ever going to use. And actually line charts, you're not going to use that much either. It's mostly going to be candlestick charts. So in trading, there's too much information. You want to cut off the useless stuff and focus on the useful. So a line chart. A line chart is basically a chart like this one that connects every price point throughout time with a line. So you can know that on this day, the price was this. On this day, the price closed at that price. So the last trade of the day was that price. And here the last trade of that day was that price. And then you can see, in February, UPS had a plummeted, a few percentage points. So that gives you an indication, okay? Now, this isn't sufficient really to get the full picture of what actually happened. That's why most of the time, and always, honestly, we use candlestick charts. Candlestick charts are the same thing as a line chart, but they give us more information. Because look at this, I'm looking at the UPS stock, okay? UPS. And when I see a candlestick chart, it tells me more information than the same chart on UPS, but a line chart. Here, okay, well, prices dropped, but how did they drop, right? Well, here I have a better picture. And to understand this, you need to understand what a candlestick is. And that's why this is what we're going to look at. So what exactly is a candlestick? A candlestick is basically something that we draw for each day. Again, let's say for each day. And when the day starts, the first trade that happens, we're going to draw it. Okay? Let me see if I can draw this right here. Okay. So when you're looking at a candlestick, really what the candlestick is showing you is the opening price, close price, high price, and low price during a day. So when I'm talking about high, low, open, close, what am I really talking about? So in a day, and let me draw it out here. So the market opens at 9:30 a.m. Now, Eastern time. At 9:30 a.m. when the market opens, US and Canadian markets, what happens? The first trade that happens is what we call the opening price, because that's the first trade that happened on that day. So if the stock at 9:30 opens and the first trade that happens at $10, let's say 10, we'll call that the opening price. If then the stock price starts falling, goes down to 9, and let's say then starts going up, goes all the way up to 13, then drops a bit, and then closes at 12. And again, what do I mean by close? Close means it's the last trade that happened during the day. So at 4 p.m., the market closes. We take the last trade that happened, and that's what we call the closing price. So when somebody asks what did Apple or Google or Facebook close at, they're talking about the last trade of the day. So that we'll call that close. This price, the highest price that the stock traded at during the day, we'll call it the high. This price, which is the lowest price that happened in the day, we'll call it the low. And then what we'll do is we'll connect this and this. And sorry for my drawing here, but this is what we're going to call a candle. So a candle, by looking at it, like right now, you just look at this candle and you'll be able to know that this stock went up today. It opened at $10, okay? And when a candle goes up in a day, we actually color it the color green. So you look at this candle and it's the color green, so you know that the stock went up in price today, right? And you know that it opened at 10, you know it dropped a bit at one point during the day, you know it went as high as 13 and it closed at 12. So you know it went from 10, opened at 10, all the way to 12, 20% it went up during this day. Okay, so you get a lot more information by looking at a candlestick because it tells you what happened during the day. Now, there's another type of candle that you can see. Imagine the stock opened at $10. Okay, again, same thing. Then went up, let's say went up to maybe, I don't know, 12. But then it started to drop. And it went down, 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 all the way, I don't know, $6, then came back up and closed at maybe 8. Now, the 10 is when the stock opened, right? So it'll be the opening price. 12 is still the high, so this is the highest price that the stock went during the day. 6 is going to be the low, so that's the lowest price that the stock went during the day. And then if we connect these together, what are we getting? Again, a good representation of what happened during the day. Stock opened at 10, went all the way, closed at 8. It did drop lower, and at some point during the day, it did go higher, okay? And this candle is going to be the color red. Why? Because from the beginning of the day to the end of the day, it did go down, right? The close is lower than the open. So this one actually, it was a drop of 20%. This one was a gain of 20%. So just by looking at a candlestick, you get a lot of information, okay? And let's get back here to this. So all candles are composed of an upper shadow, upper shadow here, lower shadow, you have the close and the open. If the open is higher than the close, it's going to be a red candle. If the open, okay, so this is wrong here. The open should be down here. So this should be open, and I'll make sure to change that. This should be open here. The stock opens here and closes on the top. So this should be the close, okay? So open, close here. But if it opens at the top and closes at the bottom, then it's a red candle. So whenever we're looking at a chart, well, if I look at this day, 2017, month 3, day 21, I know that the stock opened at that price, okay? And I know that it closed at that price. So I know that there was a big down day on that day. It just dropped, okay? So you can tell by the candles what happened. And if I were to say, and a little parenthesis on this software that I'm using, because we haven't talked about this again, this website is called TradingView, okay? TradingView.com. And I suggest for all of you to go and play around with it, because it is one of the best charting softwares available, and it's the charting software that we use all the time and that most traders out there use. So you want to get to know this software, and if you want to know how to use it, we have a video on our YouTube showing you, a little bit how to use it. So make sure to go check this website out, because you're gonna have to use it. So when we're looking at a chart like this one, we have information about what happens on that day. I know that the stock had opened here, it closed here. But then the next day, it opened all the way up, right? So when the market closed at 4:30 p.m., it closed here. But then the next day at 9:30 a.m., when the market opened, it opened all the way up here. Then it didn't move during the day, but it was here. So maybe there was a news here, because the stock gapped, it jumped for overnight, like from 4:30 when the market was closed to the next day, okay? So this gives us more information than a chart. And again, here we can select which type of charts we want to look at. And all of the others are useless. This is the most useful one. If I looked at candle, I wouldn't have seen that. If I looked at the line chart, I wouldn't have seen all this information. Okay? So that's the same thing in this situation. When we're looking at UPS, the stock price dropped here, then continued, but I don't know really how did it drop. But if I look at the candlestick chart, I know that on this day, the stock opened lower, right? So on that day, the stock had closed at $116, but then at 9:30 a.m. the next day, when the market opened, people were trading it here. So the first trade that happened was at $111, at $110, $111 about, right? So something must have happened overnight. There might be a news or something that happened here. And that's why it opened the next morning at such a lower price. Then throughout the day, it continued to fall. And then the next day again, it opened lower, and then it continued to fall and really fell lower, but ended up closing here. So you can tell a lot about candlesticks, okay? And this is why we're gonna focus a lot on what different candlesticks mean, and then what candlesticks mean together when you put them in a chart, and then what patterns mean when you look at them on a chart, okay? So that's going to conclude this lecture. And obviously, follow us on our social media. We have a lot of other information about this kind of stuff. Other than that, I'll see you in the next lecture. Welcome back, everyone, to our complete foundation trading course. Now, in this lecture, we're going to be talking about candlesticks. We're actually going to cover every candlestick that we use and we find most useful. So, we're going to be talking about big candles. We're going to be talking about dojis, gravestone, dragonfly, shooting star, hammer, morning doji star, evening doji star, bearish harami, bullish harami, engulfing bullish, and engulfing bearish. So I know this probably doesn't mean anything to you, but trust me, it'll mean something at the end of this lecture. So we've already looked at what a candlestick is. Okay? We said that a candlestick represents the opening price of a day, the closing price of a day, and the high and the low. Now, in reality, a candlestick doesn't have to represent only one day. A candlestick can be for any period of time. So I can have a weekly candle. So it will be the opening on Monday and the close on Friday. And then the high and low throughout the week. I can have a 5-minute candle, which will be the beginning, the first price, and then the low and high within a 5-minute period, and the closing price after 5 minutes from the opening price. And then I can also have, a 1-minute candle. So it's going to be a candle for every minute. So you can have any type of candles really in terms of timeline. So let me get back on TradingView, and if I put a candlestick chart, here you see I have a daily candle. So each of these candles represents one day. So this represents the 29th of June. This here represents the 30th of June. Okay, this is July 3rd. So every candle represents a day. Now I can go here and say, hey, I want to look at 5-minute candles. And then what you see is candles that happened throughout the day. So this candle, for example, happened on July 5th at 5, and this is after hours. Let me look at this. Okay, so this candle here happened on July 5th at 2 p.m. and 5 minutes, right? And then the next candle happened at 2 p.m. and 10 minutes on the same day. And the next candle happened on 2 p.m. at 15 minutes. So I know at 2:05, the price opened here, went all the way up to here, went all the way down to here, closed here. And then I know that it closed here at 2:10, right? Because then at 2:10, you see this candle is 2:10. It opened here, went a bit down, went a bit up, closed here. And then at 2:15, this candle started. So I can see how the prices are moving at each 5 minutes. And I can see if, there's there's big movements. It's dropping here. Then I can see that it stopped. Then there's movements where it's going up. So, and all of this happens within a day. So depending on what time frame you're looking at, you can have candles for any type of time frame. Okay. So now, as I've said, different candles mean different things, and that's why we're going to look at all these different candles. So, the first candle we're going to be looking at, and let me see if I have this one here. Candles, okay. So, the first one I want to look at is big candles, and let me draw that here. Okay. Okay, so what is a big candle? It's exactly what it says, right? As its name says. It's just a big candle. Okay. So this would be considered a big candle. This would be considered a small candle. Both of them are dropping, are going down. Or you can have a green big candle, which means prices went up by a lot during the day, right? That's exactly what it means. It means the price opened here, went up a lot, and then closed here. So that's a big green candle. Or you can have a small green candle, which this means our price might have opened at $10 and closed at $10.10. But this one might mean, oh, okay, it opened at $8 and closed at $12. So it's a very big up day. But here's a small up day. So when we're looking at big candles, and again, we can go back to the chart we just looked at here when we went intraday during the day. This is a very big down candle. So prices in this 5 minute dropped by a lot. Okay, so that could tell you something, right? Like what's going on here? Is there news? So it tells you something about supply and demand, because a candle at the end of the day is going to be a graphical representation of supply and demand throughout its lifespan. If you're looking at a daily candle, that's going to show you supply and demand throughout the day. If supply was bigger than demand, so more people selling than buying, then the candle is going to be red because there was more sellers, so the price dropped, right? Because the way they draw the candle is they take every single trade that happened within that period and they put it in there, right? So if the prices fell, then it'll be a red candle. And if you had a candle that's green, then you would assume that during this period, in this case, during this 5 minutes, demand was higher than supply. So buyers pushed the price up, okay? So when you're looking at big candle, it just tells you that either supply or demand was very strong, okay? And that's why it's important to notice the size of the candle, okay? A bigger candle means a bigger imbalance between how many buyers there were and how many sellers, or how much they wanted to buy or sell, okay? So this is going to be big candles, okay? Which is very basic. Now let's get on dojis, okay? Dojis are one of the most useful candlesticks that you're going to have to use, okay? What is a doji exactly? A doji is basically a candle that opens at a certain price, goes to another price, or sorry, it opens at a certain price, so it opens here, goes up, goes down, but then closes at the same price that it opened at, okay? So opens at a price, fluctuates during the day, but then closes at the same price. So what that tells you about supply and demand is that there's very big indecision, right? Because during this time period, could be day, could be a 5 minute, could be a 1 minute, at one point, buyers were winning because the price was starting to go up. But then at another point, sellers were winning. But at the end of that period, the price closed at the same price that it opened at. So nor buyers nor sellers won. So there's indecision, right, at that point of where the stock should go because nobody won. Now, when you have a doji with a bigger wick, and a wick is the high and low, so what would that mean? A doji with a longer wick, it would just mean that buyers were winning by a bigger amount at one point, but then sellers were winning at a bigger amount at one point, but at the end of the day or the period, the closing price of the stock is the same as the opening price, which would mean that there's even more indecision about where the stock is going to go, because both parties, both sides were winning at a certain point, and at the end of the day, the price still closed at the same price it opened at, or at the end of the period, the price closed at the same price that it opened at. Okay, so big indecision. Now, I'm gonna get back to dojis, because by themselves they mean that there's indecision, but they can't really tell you what's gonna happen. But once you use them with other candlesticks, they might tell you more, and we're gonna get to that soon. Another candlestick we want to look at is the gravestone and the dragonfly. Now, this is what the gravestone looks at. Oops, sorry. This is what the gravestone looks like. Basically, you have a stock that opens at a certain price. Okay, opens here, goes all the way up. So what does it mean? It means that buyers or demand for the stock was strong, so prices were going up. But then it stops, and then sellers start selling, and then it comes all the way back down to the price that it opened at. Okay? Again, by itself doesn't mean a lot, but wait till I put it within a chart, and then you're going to see what it's going to tell you. Dragonfly, same thing, opens at a price, drops, then comes all the way back up, and closes at the same price it opened at. Okay? This one's called gravestone, this one is called the dragonfly. And I'm going to show you how we're going to use them. So, before I do this one, let me talk about the morning doji star and the evening doji star. So, remember when I told you the dojis mean indecision? Here's a doji. Here's a doji. When you look at them by themselves, they don't mean anything. But when I put them in a pattern, and let's say like this one. So if I had a stock that was dropping, and let me draw it out here so you can see this exactly. If I had a stock, let's see here, I have a chart here, okay, and then I have a stock that's dropping, okay, so red candle, okay, let's say it opened at $10, now it finished at $9, then another red candle, so price is going down, then I have another red candle, a bigger one, okay, and then let's see another one, and then at one point I have a doji. Now a doji is a candle that opened at a certain price, went high, low, and then closed at the same price. So this candle tells me there's indecision. But before this candle, I had a stock that was dropping, but now I have indecision. That still doesn't mean anything, because indecision could go down or up. But after the indecision, the next day or the next period, I have a green candle. Now, what this is going to tell me that this down move is over, because at one point we got indecision, and then the next period we got buyers who were winning. So that's going to give me an indication of trend reversal. Okay, so we're going to talk about trends later in another lecture, but trends means the direction of the stock. So if the trend was downward, okay, and we're going to really go over trends extensively later, but for for you to understand this part, if the trend just means the direction. So if the trend was down, the stock was going down, and then we have this pattern here where we have a red a candle of the same color, then doji, then a candle of the other color, that means there's a reversal that might happen. And what we're going to notice is that most likely the stock is then going to go in the opposite direction. Okay? And it would have been the same thing. Let me put it here. If the price was going up every day, we had green candles, and then at one day we get a doji, and then the next day we get a red candle. What is this going to tell me? It tells me, okay, well, look, I had a stock that was going up, but then I have this candle that means there's indecision, and then I have a red candle. So that means, okay, now sellers won. So buyers were winning, indecision, sellers won on this candle. What is that going to tell me? This is a reversal pattern, right? So when we're looking at the morning doji star and the evening doji star, that's exactly what we're looking at. We're looking, and sorry about this, this should be red, this should be green. So candles going down, and then doji, and then candles going up. Okay, that would be a reversal indicator if it was in a downtrend. And same thing here, if this one is correct. So if green candles going up, and then doji, and then red candles, that means trend reversal if the stock was going up. Okay, so the doji makes sense when you put it within a pattern. And these, the morning doji star and evening doji star, are two of the most useful patterns ever, right? Now, you're not going to use dojis as a strategy. You're not just going to buy every time there's this. No. But if you wanted to buy a stock that was going down, okay? If you wanted to buy a stock that was going down, like this one, okay? You want to buy this one because your strategy tells you it's a good buy. Well, if it's going down, you're not going to buy it because technical analysis is going to be useful for you to have price entries, okay? Your strategy might incorporate more than just technical analysis. But technical analysis is going to be very useful to tell you when to buy. So if you think that this stock should go up, well, don't buy it. Don't buy it here because it's falling. But then if you see this happening, if you see this pattern, then you know it's going to turn around. Plus, you already want to buy it. So this is going to be helpful as a price entry. If you're waiting to buy that stock and you see this pattern, then you have to go buy it. Okay? So you're going to use these patterns to time your entries. What time should I buy? Well, when you see this type of pattern, right? You're going to time your entries with that. Now, another candlestick we want to look at is the shooting star. Now, shooting star and hammer are these two. So you have one where the stock opens at a certain price, goes all the way back up, but then closes just above where it opened. So a small green candle. Okay. Then you have the other one where it opens at a certain price, drops all the way back down, then comes all the way back up and closes here. So what does this tell you? This one, again, tells you the same thing as the gravestone, right? So the shooting star, gravestone, it's the same thing. This one means buyers were winning at one point. Okay, buyers were winning here, but then sellers came in and took over and it closed at the same price. This one means exactly the same thing. Buyers opened here, buyers were winning, but then sellers took over and pushed price down, but it closed a bit higher. So here we have a small green candle. Okay, and here's the same thing. Buyers were winning, stock went up, opened here, sellers were winning, so stock went down, then buyers started winning, and it closed at the same price that it opened. Same thing with this one. Opened here, dropped, came all the way back up, but not quite. So it's still a small red candle. Now, they both tell us the same thing in terms of supply and demand. And this is why I don't like remembering these names. You don't have to remember that a candlestick is called gravestone or dragonfly or shooting star or hammer. What you need to do is understand what they mean. When I look at this candlestick, I understand that I'm looking at supply and demand, where at one point demand was winning, but then supply won at the end. Okay, so at the end of this candle, supply was taking over. Okay, sellers were taking over. That's the same thing in here. So I don't need to know the name if I know what it means. Because if you follow through and you want to learn every single candlestick that exists, there's hundreds of them. And there's books where they name hundreds of candlesticks. Now, is it useful? Absolutely not. In trading, as in much anything else you do, the more information you start using, the less value this information adds. And they actually start removing predictability. So if you're trying to predict something, you should be looking at maximum 6 or 7 things. If you look at too many things, your predictability is actually going to decrease. Okay, it's a weird thing in math where you cannot have a huge amount of variables to predict something. You need to have a small amount of variables. So you shouldn't look at too many things. Okay, you got to look at the ones that matter. A lot of the candles don't mean anything. Okay, these are the candles that mean the most on supply and demand. Now, if these are the same thing as these, why would you remember the exact name? As long as you understand what they mean. Because if being successful in trading meant knowing the most amount of candles possible, then the people who knew the most amount of candles possible would be the richest people. But it's not the case. Okay? So I tell you by experience that people who want to memorize all the candles, they never make it. Okay? You want to just know which ones are the most important, which ones are the most used, because at the end of the day, you want to know what other people are using, because that's what's going to affect their behaviors to buy or sell. And at the end of the day, other participants' behaviors or their orders to buy or sell, that's what's going to ultimately move the prices. So you want to look at things that enough people look at them to matter. Don't look at something that nobody else looks at, because then it's useless. Because it's not going to affect their behavior, and at the end of the day, you're trying to predict what other people are going to be doing, because that's what's going to move stock prices. Okay? So, not a fan of remembering names, okay? So, actually, let's get back on the chart here that I was looking at and try and see if we can spot some of them. Oh, look at this one. We had a huge down, okay? And let me actually draw it here. We can draw, right? Had a huge down movement here. Okay? Nice drawing. And look at this. I have, this kind of looks like a doji. There's a little candle in it, but again, as I say, right? When we're looking at something like a doji, it doesn't have to be perfect. It doesn't need to be exactly like this. Sorry. It doesn't need to be, it doesn't need to be exactly like this. It could be, you know, it could have a small body. It could have, so this one, this candle, and let's zoom in. This candle, yeah, opened here, closed a bit lower, but it went higher at one point, lower at one point. So there's indecision in this candle. And then green candle, green candle. So what is this telling me? That this trend was over. So if you were looking to buy this stock, you wouldn't have bought it here or on this big candle. No, you gotta wait until you have something like this that tells you, okay, the down move is over. So then you can buy here. Okay, and then take that as a profit. So really, the candlesticks are going to be very good as entry points, to help you with your entry points. When do I want to enter? Okay. Let's go to the next one. Next one is going to be, here we go, big candles. So big candles, small candles, that we covered earlier, so I'm not going to do it again. Now, next one is bearish harami and bullish harami. What is the bearish harami? So bearish harami is basically when you have a very big green candle and then you have a smaller red candle that opens within the body. The body is basically what's between the open and close. So this is open and this is closed. This is the body, right? See? Get back here. This here is going to be the body. Okay, so you have a big green candle and then it opens here, closes here, but then the next day or the next period, the candle opens lower and stays with and closes a bit lower. And bullish harami is the other one. Now let me show you, sorry about that. Let me show you what they would mean within a chart. Because again, by themselves, they don't mean much, but once we put them in a chart, they start meaning a lot. Okay, so let's say we have a chart here. Okay. And on this chart, I have a stock that's been going up lately. Okay, going up. Big green candle. Oh, it's really going up. Big green candle, really going up. So every candle tells me that, okay, the stock, there's more demand for the stock than supply, right? Here, people were buying at that price. Let's say this is $5. Then they started, it closed at 6. Next day, went from 6 to 7. The next day, went from 7 to 10. Big move up. The next day, went from 10 to 14. So buyers are really pushing the price up. Now, if on the next day or the next period, the stock doesn't open at 14, but opens lower, opens at $13, okay? Somewhere here. $13. What is this telling me? It's telling me that the momentum, that the strength of the buyers is not there anymore. Because now, the stock at the open of the next period opened lower. So people are trading it lower here. And then instead of going up during this day or this 5-minute period or 1 minute or whatever time frame you're using, if it goes down by a bit, and let's say it closes at the end of that period, let's say at, I don't know, 12, okay? Then this is telling me that this movement is exhausted, right? This up movement is exhausted, okay? This is done. So what I expect to happen is for a reversal, right? Trend reversal. So when I'm looking at this here, this is really a pattern that by itself doesn't mean much, but if I put it within a chart that's going up, it'll tell me that there's a reversal that's very likely to happen and that this move is exhausted, okay? So when you're looking at this, bearish harami, again, they say bearish. What does bearish mean? Bearish means we have a view that the market is going to be going down, okay? And bullish means we have a view that the market is going up. So when somebody's saying, hey, I'm bearish, basically it means that he thinks that the market or the stock is going down. When somebody says I'm bullish, it basically means they think that it's going up. And the reason why, and that's why they have the bull in front of the New York Stock Exchange. And the reason why they actually call it like that is because a bull attacks from down to up. So they say it's bullish, it's going up. And a bear attacks from a position of up to down. So when the market is going down, they say we're bearish. And you say that this one is called bearish harami because this one means that the market might go down, right? Or the stock price might go down. So here, this is bearish, a bearish indicator. Again, if we had the other chart, if we had another chart where in this case, the price was going down. Big candle. And then at one point, the next day, instead of opening at the same price it closed at, it opens higher. And then instead of dropping, it even goes a bit higher and closes within this candle. So it's engulfed within this candle, right? It's engulfed by this candle. Okay, it's all within it. And these two candles together will signal a reversal. And this one is going to be a bullish harami because I expect the stock to go up after that. Okay, and it really makes sense, right? Because at this point, sellers are pushing the price down. Prices are going down because there's more sellers than buyers. But then if at one point the price opens higher and then even goes higher, that means sellers are exhausted. The move is done and now buyers are about to take over. Again, you use that to time your entries within a strategy. If you wanted to buy this, don't wait until you see something like this and then buy. So then you time it. So then it'll save you money because instead of buying here or here, you wait and then you might buy here after you see this, right? So you'd get a better price. So timing entries, very important. Okay. Another one we want to look at is going to be the engulfing bullish and engulfing bearish. Again, very close to this one, engulfing because this candle engulfs this one, bullish because we expect it to go up. Okay, engulfing because this one engulfs this one, bearish because we expect it to go down. Now let's look at it within a chart so you see exactly what it means. Let me draw it out. Okay, so we'll do engulfing bullish first. Let's get on here. Okay, so let's draw a chart. So engulfing bullish, if you had several candles going down, okay, so this stock is going down, then you have a small candle here going down, and then the next day, so now sellers are winning, right? Prices are going down. The next day, the stock, or the next period, the stock opens lower, okay? So let's say here it had closed, the last price it traded at was, let's say, $7. Let's say the next day it opens at 6, or the next period. So lower. But then instead of going down, it actually starts going up. And it goes up so much that it engulfs the previous candle. It engulfs it. Okay? So it's really, the previous candle is within the body of this candle. So what is this telling me? It's telling me that the sellers have no more power. The buyers are overpowering them. Okay, demand is now stronger than supply, and by a lot, because it engulfed completely the last period. So when I'm looking at this pattern within a chart, again, it signifies trend reversal. Okay, so if the price was going down and you see this, then that might mean it's more likely to go up. Okay. Now, if we had it the other way around, green candles, stock is going up, going up, going up, everybody's happy. Then the next day, it opens higher, but then instead of continuing higher, it actually starts dropping. And it drops so much, it engulfs completely the previous candle. And again, this is gonna tell me this is a bearish one, because it tells me that I expect the market to drop now, or the stock to drop now. So even though in the beginning demand was winning, buyers were winning, they were pushing the price up, on that day
supply was so high and buyers couldn't support it, so the prices fell, and that tells me that this move is exhausted and now I can expect a reversal. So some people, okay, and I don't know why they do that, they just remember these patterns by heart, and when they see them, they try and predict where the market is going to go. That doesn't work, okay? What you need to do is understand them. And that's why when I talked about them, I didn't say, oh, when you see this candlestick, it goes up, and when you see this candlestick, it goes down. I'm explaining supply and demand because that's what they're showing, right? So I've been trading for 9 years now, and I don't remember that this is a Dragonstone. And actually, let me give an example of these two because I haven't given an example of these two. I don't remember that this one is the Gravestone and this one is the Dragonfly because I know what they mean. So I don't need to remember their names. Okay? If you just want to remember names and try and find them in charts, you're going to misuse them because they should be used only in situations when they mean something. And for you to know when they mean something, you need to actually understand them. And if you understand them, you don't need their names because you're going to see them and you're going to understand what they mean, right? So if you ever want to remember a name, that means you don't understand it properly. Don't remember the name, understand what they mean. Again, when I look at a chart and I see this, I don't remember a name. I just see that there was a lot of buyers, but then sellers, the buyers couldn't keep pushing the price up. So it fell and then sellers are taking over. That's what it tells me. So if I see this within a chart, it tells me that there's trend reversal and it's going to fall. I don't need to remember the names. I understand what they mean. So please don't do this mistake. We looked at Gravestone and Dragonfly. And again, they mean something. By themselves, it doesn't mean anything. But when I put them in a chart, you're going to see that it does. Okay, so let's do the Gravestone first. So Gravestone. Imagine we have a chart and we have candles that are going up. Candles going up, going up, going up. And then we have a candle. Okay, it opens here, starts going up, but instead of closing here, then it comes back down and it stops. It closes at the same price as it opens. Okay, so what is this telling me? It's telling me that supply was winning in the beginning, demand was winning in the beginning, buyers were pushing the price up, and on that day or period, buyers were pushing it up, but then sellers came in and pushed it back down to the same price it opened at. Now, if I see this starts being like, okay, whoa, maybe buyers aren't going to continue winning anymore. Now, if this one, the next candle actually opens here and then closes down, then this pattern tells me that this move is over and now sellers, supply is taking over and the price is it's most probably going to go down, right? And this looks extremely similar to the one that we had with the doji, right? We had a green candle, but then we had a doji, which means indecision, and then we had the red candle. Okay, you see the similarities, but this one isn't indecision. This one actually is better than the one with the doji because it really shows me that, okay, sellers came in force and they were taking over here. There's not too much indecision. So buyers were winning, but at the end of that period, seller had taken over. So this is a very, 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 very strong pattern that we look for and most traders look for, even if they're trading intraday or if they're trading long-term, whatever you're trading, because you can look at a daily chart where each candle represents a day, or you could look at a 5-minute chart where each candle represents 5 minutes, and it's gonna be the exact same thing. It's going to tell you the same thing, right? So no matter what time frame you're looking at, you can use these same type of candlestick patterns to predict your entry, okay? And to come up with the right entry price and the right exit price. So that was this one. The other one, again, same thing. You have your chart over here. Let's put it back here. You have your charts. And then you have red candles. But then you have a stock that opens at this price, drops, but then at one point buyers come in and they start buying, and they push the price back up to the same price it had opened at. And then on the next period, you have a green candle. What is this pattern telling you? The down move, sorry about that, the down move is over. And now I expect prices to go back up. And I'm really being honest about this. This is the most consistent pattern of all of them. Okay? We see this often, and when you see this, it's a go to get your entry. Again, it's not a strategy. You're not going to buy every time you see this. But when you have a strategy, if your strategy tells you, and we'll cover that, we don't have a strategy course. This is the foundation course, but in our advanced course, or if you do your strategies by yourself, you have a strategy that's going to tell you when to buy and sell, right? And there's a lot of work that goes into building a very profitable and consistent strategy. Now, some courses will tell you that you can get away with doing this. It's not true. Okay, this is too easy. So this is going to be helpful for your entry points. You're going to use these for your entry points. But your strategy has to be based on something more robust, okay? So if your strategy tells you, hey, buy that stock, okay? Buy this stock. Well, when do I buy it? That's the question. And charts and indicators that we're going to look at, and these candlesticks, they're going to help you to figure out what price, okay? So in this case, if you wanted to buy this one, wait, I'm not going to buy it here, not going to buy it here, not here, not here, not here. Oh, here, whoop, okay, this is nice, I'll buy here. So it gives you, so you already wanted to buy it. This just helps you to figure out when, okay? That's really basically what I mean. Okay, so let's see here. So the dojis, again, Gravestone Dragonfly. And you see, don't need to remember the name. When you see them, it'll make sense to you. Okay? It'll make sense to you. Haramis, engulfing. Yeah, so that's basically it for the candlesticks. Okay? Now what we're going to do is we're actually going to do a lecture on patterns that are formed with way many more candles, and then on indicators, both part of technical analysis. This was the easy part, okay? So that being said, follow us on our social media. We have way more stuff, way more content. And other than that, I'll see you guys in the next lecture. Hey guys, welcome back to our complete foundation stock trading course. In this lecture, we're going to be covering everything that has to do with trends. Now, I know you probably heard about trends before. If you haven't, don't worry, we're going to go through it. In this lecture, we're going to talk about everything that has to do with trends. So at the end of this lecture, you're going to be an expert in trends. Now, you've probably heard a lot about trends. The trend is your friend. Don't go against the trend. All these sayings, right? What are all these sayings? So trends are actually something that are at the core of technical analysis. So the principle of technical analysis are that prices move in trends, and that history tends to repeat itself. That's what's at the basis of technical analysis. So when we're looking at prices,
we're saying, okay, prices move in trends and history repeats itself. That's why we do technical analysis. Now, what is trends? What's a trend? A trend is just a direction. You know, when people are saying this is the new trend, this is the new direction people are going in, right? There's this new type of music, there's this new type of dance, this is the trend. It's a direction, right? And stocks is the same thing. Stocks can have trends. They can be going in a direction. They can have an uptrend, which means they're going up. They can have a downtrend, means they're going down. They can have a side trend, means they're going to the sideways, right? Other than that, we're going to be talking about channels. We're going to be talking about trend lengths, how long they can stay. We're going to be talking about support and resistance. So we're going to cover everything that has to do with trends. So let's get to it. What are trends? So the way we define each type of trend, so an uptrend, a downtrend, and a side trend, is basically by looking at the lows and highs of price movement. So if this is a chart that has prices, and if the prices, every time they go up, and again, prices don't just move in a straight line, they fluctuate. If in their fluctuations, every time they reach a high, okay, the next high is higher, and every time they have a low, the next low is higher. So higher lows and higher highs, you see, this is a low, the next low is higher, the next low is even higher. And this is a high, the next high is higher. So when you have higher lows and higher highs, we're in an uptrend because the movement is going upwards, okay? If, on the contrary, we had lower lows, so here we have a low, then a high, then a low, then another high. You see these two lows here. This low is lower than the previous one. And this high is lower than the previous one. So if we have lower lows and lower highs, then we're in a downtrend, right? Because the prices are going down. Every time there's a high, it's lower than the previous one. So we're going in a down direction. Now, if the lows were at the same price and the highs are at the same price, so the stock price is just moving in a sideways manner, then we have a side trend. So basically these type of movements encompass all the movements that exist, right? A stock can't move in any other way than these three movements. It could be in an uptrend, could be in a side trend, could be in a downtrend. Nothing else exists, right? And stocks do move in that manner, right? So they say that in technical analysis, trends tend to persist. What does that mean? It means that if something is in an uptrend, it's very likely that it's going to remain in an uptrend. Again, that's why they say the trend is your friend. So yeah, go with the trend. If it's going up, then go with it. And that's why they say don't go against the trend, because they're saying, well, if it's going up, it's more likely to go up. Don't bet that it's going to go down. So how do we use these trends, right? So now that we know that trends tend to persist, and it has been proven mathematically that when a stock is in a trend, it's way more likely that it remains in that trend. So how would we use that to our advantage in our trading, right? So when we're looking at stock prices, okay, and I can be looking at something like this, okay, so if I'm looking at this stock and I see that this stock is moving in this direction, right? So I see that there's a trend here, and we see that it's moving upwards, right? So I know it's in an uptrend. So if I'm looking at the stock, I should go long. I should buy it because I expect it to keep going up, right? And it is going up. Now, something that we often do is we draw a line. A line that can help us see the direction of that trend, right? And we call that a trend line. Very surprising, huh? So this is what we call a trend line. We draw it on the lows of the trend, dependingly. We'll talk about it later, sometimes on the highs. And it's going to give us the general direction of that trend, right? So in this situation, you see that we're in an uptrend and we draw a trend line to tell us, okay, the stock is going up. But you're going to see that trends don't stay forever. They're not going to last forever, right? But they're going to last for a while. But then if the price of the stock breaks that trend line that we drew, then the trend is over. Then it's not going to continue that way, okay? So let's actually open up our charting software that we looked at previously, TradingView, right? I hope you've already played around a bit with TradingView. I've talked about this software in an earlier lesson. So if I want to go see a chart, okay, and I've already looked at this symbol before, and I'm looking at the symbol MPWR, monolithic, okay? So if I'm looking at this chart here, and I want to know, is it moving in a trend or no? And obviously you can see here, it's going up, right? You can see that the trend is upwards. So this stock is going up. And let me actually see if I can draw something here. And you can see that each low, here we have a low, here we have a low. Each low is higher than the previous low, right? So this is exactly what we call, this is actually a pretty nice chart. So each low is higher than the previous low. So this is low 1, low 2, low 3, low 4, low 5, low 6. And then each high, so this high here, then the next high is higher than the previous high. So each high is higher than the previous high, right? So you're saying that this is in an uptrend, okay? Now, what I can do to help me see this is draw a trend line. And this is what everybody does, right? If you think that there's a trend, you're gonna draw a trend line, okay? And in TradingView, you can just click on this trend line, you put it where you want it to start, all the way up. So you see, by drawing this trend line on all the lows, I can see that this stock is moving in that direction, right? So if I wanna bet if that stock is gonna go up or down, what am I gonna bet? I'm gonna bet that it's gonna go up, right? Because it's in that trend, and trends persist. So I wanna go with the trend. If I have to bet, if I have to put money, I'll buy that stock because it's very likely that it continues going up. And I'll explain why that is, right? Why do trends tend to persist? But now, if at one point it breaks the trend line, I know that the trend is over, okay? So when we're looking at trends, okay, something we also want to understand is when a stock is moving, okay, and it's going in a direction, again, either upwards or downwards or to the side, it doesn't only have a trend line at the bottom of it. You see, this is a trend line. We actually always draw, or most often draw, two trend lines. One to the lows and one on the highs. And we call it a channel. So a stock, even though it moves in a direction, it moves within a channel. So you'll see that it goes up, it fluctuates within a channel, okay? Where you have a lower trend line and an upper trend line. So you can have up channels where the stock is going up, or you can have a down channel, okay? So you have here your downtrend, but it's within a channel, okay? And you have your side channel where, okay, it's going sideways, it's a side trend, but then the prices are moving within this channel, right? Why is that important? Because if you were to buy your stock here at the lower part of the channel, then where would you sell it? Because if the price is going up and it gets to the upper side of the channel, we know that it's very likely for the stock to stay within the channel. It's not going to go up further. So here would be a good place to sell it, because then it's going to go back down and then you can buy it back again here. And then if it goes back up here, you sell it again, right? If you just hold it, it's very unlikely that it moves away from the channel. And again, same thing, if we were looking at this uptrend, okay, well, if I bought here, maybe the good thing to do is sell it when it reaches here and then buy it again when it touches the lower trend line, and then sell it again here, and then buy it again here and sell it again here and buy it again here and sell it again here, right? Not too complicated. So you have to look at the channel itself. And even in the example we just saw, let me open it again. In the example we just saw, look at this. Let me take another trend line and voila, right? Voila. I just took this example. Let me see if I can take these off here. Let me delete these ones. We'll have it a bit cleaner. Here we go, here we go, here we go. Here we go, here we go. So I actually just took this chart randomly to look at because I saw it had a nice trend on it. But look at this. If I take two trend lines and I put them on here, this looks like a perfect channel. The stock is moving within that channel. So where would you buy? Where would you sell? Again, you'd buy at the lower bands, sell it when it reaches the higher bands. Then go trade something else, put your money elsewhere. Oh, it touched here again, you can buy it again. Sell it again, make money. You know, if, here, again. So we have opportunities because yes, it's going up, it's in a trend line, but where should I buy? Should I buy, I know it's in an uptrend and I know it's going up. So when should I buy? Should I buy here? No, wait until it touches the lower band of the channel and you want to get it there, right? That's the idea, because then if you buy it here, then it's not a good entry. Because again, we're using technical analysis to get our entries, right? Now, that being said, let me get back here to our slide, okay? What are we realizing about the channels and these trend lines? Okay, what we actually realize is that they serve as support and resistance. Okay, so trend lines, the reason why we draw them is because we use them as support and resistance. Okay, so what is support and resistance? Okay, support means something that supports a price, doesn't let it fall below it, right? I'm supporting the price. Resistance is something that the price can't go through, okay? So when I'm looking at, again, let's put this, let's get back to our example here. This trend line, the lower trend line, I can consider that this trend line is a support line because every time the price of the stock hits it, it supports the stock and the stock bounces back off of it. Okay, every time the price hits this support line, boop, it bounces back off of it. Every time it hits it, bounces back off it, bounces back off it, bounces back. So the lower support line, the lower trend line is going to be your support. Now look at the higher trend line. This trend line is actually going to be your resistance, right? So this is going to be your support. Can't really write on my mouse here. This is your support and this is going to be your resistance, okay? So and you'll see that every time the price goes up, it can't break through that trend line. So it comes back down, right? Every time it hits it, it comes back down. Can't break through it. Goes up, hits it, oh, comes back down. Goes up, hits it, comes back down. Same thing up to here, hits it, comes back down. So we have a support and resistance. So if we're trading a stock within a support and a resistance, what do we want to do? We would like to buy on the support and sell on the resistance. So if I want to buy a stock, I'm not going to try and buy it here because the price is probably not going to be able to go through this support. I'll buy it on the support. And if I want to sell it, I'm not going to try and sell it here because the price is probably not going to be able to go through this resistance. So I'll sell it on the resistance. Okay? That's very important. So channels and trends, we use this all the time. Okay? Whenever you're in a position, you want to know what direction is it going in. Okay? And go and be in that direction, right? And the nice thing about trends is that you can do them on any time frame. I can be looking at the daily chart as I'm looking right now, or I can go on a 5-minute chart. So if I'm trading intraday, okay, during the day, and I can see that there's different trends that are happening, within the day, okay? I can see that, I'll see that there's different channels and trends that happen within the day. Okay, let me take this one off. So if I'm looking intraday, and I'm looking at today's trading, so from here 10 p.m., 10 a.m., 9:30, market opens. Here is 4 p.m. So this is today, just intraday. I see that it moved within this channel, right? So no matter what time frame you're trading, if you're trading 5 minutes or if you're trading 1 day, okay, you are gonna see trends, okay? And you are gonna see trends, and you can use that to decide on your entry points and your exit points, okay? Now, why? That's the question. Like, the big question is, why are these trend lines supporting the price of the stock? Why does the stock bounce off that? Does it make sense? Is there a reason for it? Is it just random? The thing is, it's been proven that trends persist. Now, why do they persist? Okay, is it a self-fulfilling prophecy? And when I'm talking about self-fulfilling prophecy, I'm saying basically this. If I tell you that trends persist, and you see that there's a trend here, because you see that there's a trend, what are you going to do? You're going to buy, you're going to put an order to buy here, right? On this line. Why? Because you don't think that the stock is going to break it, and if you can buy here, you're probably going to make money because it's going to go up. But you're not the only one who's doing that. Everybody sees the same trend. Everybody sees it. Everybody knows that trends are going to persist. Everybody knows that you should buy on the trend line. So everybody puts orders to buy on the trend line. Now, because everybody has orders to buy, what happened? There's so much demand to buy here that when the stock price goes to that level, it can't break it because there's too many buyers, so it goes back up, right? So it's a self-fulfilling prophecy. Yes, the trend is supporting because we all believe that it is going to support. Thus, we send our orders and it supports, right? So it's really like, it's a funny thing, right? Because if everybody believes something and they do it, then that's why it's happening. So in this case, the support and resistance are caused by people buying on this trend line. That's why it's supporting the price. And there's so many people selling on this trend line, right? So they put orders to sell. And since there's so many people who want to sell here, when buyers are pushing the price up and they reach here, there's too many sellers. They can't push the price up higher. Too many people are selling here. So it goes back down. And then when it goes here, there's so many buyers here, it can't go up, it can't go down. So it goes back up. So it's really a self-fulfilling prophecy where it's the orders to buy and sell securities that is making this support and resistance, okay? Super important to understand. Now, that being said, let me get on here. So what causes support and resistance? Again, it's the orders that people send. The support and resistance aren't there for no reason. The only reason why there's a price there's gonna be a support or resistance is because there's orders to sell or buy at that price. That's the only reason. There's nothing else. Prices, okay, move. When a price moves, it's just because there's a buyer or seller that came in. Okay, supply and demand. Okay, so and that goes, like we've seen in other courses, through orders. They send orders in the market. So if there's a lot of orders at one price, that's what's going to cause the support and resistance. If there's too much demand or too much supply, okay? Nothing else. Now, where do we see most of this support and resistance? What you'll realize is we see it a lot around round numbers, right? And it makes total sense. It's going to be around round numbers. Why? And I'm not talking just about the trends. Now I'm talking in general. You're sometimes going to see stocks. Let's get on the drawing board here a bit. I haven't used that today. Let's see. And so, here we go, good. So, sometimes you're gonna see a stock, and let's see. Let's say here is the price 100, and here is, let's say, 80. You have a stock that's, you know, going up in price, but then when it reaches 100, it can't break it, and it goes back down, and then it goes to 100 and tests this price level again and can't break it, and it goes again and it can't break it. Now, why is that? Why is that? Okay, why is this price level, okay, the 100 price level, acting as a resistance? Okay, so price was going up, everything is good, but it can't go over the 100 price. Very simple, because so many people, when they want to buy or sell stocks, they send their orders, right? They send their orders to the market, you know, with the name and then the quantity, 100 shares or 1,000 or 10,000, and then the price. Not a lot of people say, hey, okay, I want to sell it at 99 and 72 cents. No, people send it at round numbers. They'll be like, I'll sell it at $100. So they send an order to sell their stocks at $100. So many people send orders at round numbers like 100 or 50, 25, you know, 10, 20, 30. Then you have even round numbers like 12, 11. And then even, so it's really like the best round number is going to be something like this. Ends with a 0, ends with a 0, 25, 75. These are strong round numbers. Then you can go in these round numbers, and then you can start going in, you know, less important round numbers like this. But these ones are super strong. And why? Because so many people send orders at that price. So tell yourself this, there's probably, okay, maybe somebody sent an order to sell 10,000 shares here. And then maybe another person sent an order to sell 20,000. But there's so many people that are going to be sending their orders at that price. There's going to be hundreds and thousands, if not millions of shares to sell at that price. Okay, so many people that bought here, they all want to sell here. So if there's 1 million worth of shares to sell here, okay, what is it going to take for the price to go over the $100? It's going to take buyers who are willing to buy 1 million shares. Unless buyers buy these 1 million shares, the price is not going to go over it. Okay? So then if buyers are buying, price is going up because there's a lot of demand, but then it gets here and then buyers are still buying, but they only want to buy like 100,000 shares. So they buy 100,000 shares, there's still 900,000 shares to sell. So then, but there's no more buyers that want to buy. So then as sellers come in, the price is going to fall back down. So you're going to see that round numbers are often going to be support and resistance. And in another situation, maybe you have a stock that's trading at, you know, I don't know, $7, and it's dropping, and then it gets to $5. And as soon as it touches it, bam, it bounces back. And it comes back, it bounces back. Why? Because maybe a lot of people who wanted to buy that stock think that they're sending their orders at a round number. So a lot of people will be like, okay, well, if this drops, I'm going to buy some. But what price are they sending? They're not sending 572, 534. A lot of them, retail traders, are just going to be like, put an order to buy at $5. So they'll send an order to buy at $5, right? They'll send an order to buy at $5. So then when the price reaches there, it can't break it. So you're going to see that in this case, this round number became a support. And this round number was a resistance. Okay? So very important for trading. Okay? Because when you're trading, and if I'm long this stock, right? If I'm long this stock, okay? And I bought it, let's say at $90. And I want to sell it at one point. Where do I sell it? If right now it's trading at $99, How longer am I going to hold it? Am I going to hold it until 101, 102? No, because I know it's very unlikely that it breaks this price. So I should sell it just below this resistance point. I want to sell it here at 99 and 99 if I have to, right? But I know it's very unlikely that it breaks this price, so I want to sell it within it. And if I want to buy this stock, or let's say I was short the stock and I think it's going to go down, well, if I shorted it, I want to take my profit. Where do I take it? Well, don't take it at 450, right? Makes no sense because it's going to have a hard time breaking 5. So maybe buy it even just above it, 5.01, $5.01, because I know I might buy it here because there's not a lot of buyers. But if I go here on $5, I'm going to have a hard time buying it because there's too many buyers. So I always, when we're looking at support and resistance, why do we care about that? Because we want to buy things above support, because we want there to be enough people behind us to take the hit and to support the price of that stock so the price doesn't go against us. So where do we buy? We buy above support. And where do we sell? We sell below resistance, right? So we're always going to be buying above support because we want something to support us, okay? So it's unlikely that the stock goes against us. And we want to sell below resistance because we know that it's unlikely that it goes above that resistance, okay? So very important to use, and we can use these on any time frame, daily, intraday, and it's honestly, it's something that we always use. So my traders here, if one of my trader ever, okay, sends an order at a round number, I'll fire them straight away because it makes no sense, right? If you want to sell a stock, if you're long this stock and you want to sell it, don't sell it at 100. Sell it below the resistance because it's probably not going to go. If you want to buy the stock, don't go and put your order to buy it at $5 like everybody else. Go in front of all of them at $5.01, right? So these are very important things. Now, let's see here. Let's get out of this. Another important thing to understand about support and resistance is role reversals. So when you usually have a support or a resistance, if that support or resistance breaks, it actually it inverses, right? So if you had a support, it becomes a resistance, and if you had a resistance, it becomes a support. So let me draw it out here. Okay. So in this situation, imagine I had this stock, okay? It goes up, goes down, goes up, goes down, goes up, goes down, goes up, okay? And then I look at it, I'm like, oh, this is in an uptrend, okay? This is an uptrend. I like this uptrend, and I'm gonna draw this uptrend. Oh, didn't change my color. My bad. So this is in an uptrend, okay? So it's going up. I think this is gonna keep going up. So I draw my trend line, but then my stock, bam, breaks it, okay? We have a break. It breaks this support, right? Because this was a support. Why is it a support? Because the price was being supported by it. Now, when a support breaks, what happens is it now becomes a resistance. If the stock price starts going up, bam, it's gonna bounce back off of it to the low side. So support, resistance, I don't know how I write that. So support and resistance, they reverse roles when they break. If you have a support and it breaks, it becomes a resistance. If you had a resistance and it breaks, it becomes a support. And in round numbers, that's extremely common, right? So in the same example that we had where a stock went from 80 to 100 and it couldn't break this round number, okay, came, hit it, bounced. Well, if for finally it was able to break the $100 level and then it came back, this $100 level that was usually a resistance here now becomes the new support. Okay? Becomes the new support. And this is extremely common, right? It's very known. So, and it makes perfect sense, right? Because you gotta tell yourself this: if everybody was looking at this level and saying, "Oh, it's not breaking," everybody was selling here, and a lot of people were selling, and then at one point it breaks and it goes over it. Okay, so now it's trading somewhere higher, like $110. Now everybody who was looking at selling here at 100, or who was long, that who wanted to buy it, now that it's 110, they don't want to buy it here anymore. But then if it goes back to 100, the human mind is like, okay, well, now it's a good price. Because before, this was like a bad price. Oh, it's not going to break it. But now that it broke it, this becomes the new, oh, okay, good price. I want to get it here. So a lot of people are going to start buying here, and it's going to be support. And again, it's a self-fulfilling prophecy. Again, everybody knows this. So once it breaks, everybody assumes this is going to be the new support. So everybody sends their order here, and thus by sending their orders and increasing demand at that price, it creates that support. Okay? It creates the support. So let's see here. So actually, and yeah, when you're looking at charts like this, again, you see the support, resistance here, any kind of chart, you're going to see support and resistance, and you can do that on a lot of charts. You look at them and you're just going to see those. Now, trends are so common that if you go on Finviz, and we've already talked about Finviz, I believe. Yeah, we've already talked about Finviz, so I hope you got used to it, because you should use it, honestly. Last time we just looked the symbol up. Now, on Finviz, there's actually a part here. Here, right here, okay? And this part, look at this. They have a part that says signal trend line support. Stocks with the current price near strong trend line support. So they actually have a section where they find stocks that are trending for you. So if you want to buy them, you can, right? So, oh, look at all these stocks are in a trend, okay? All these stocks are in a trend. So you can go through them and see if you like one of them, and then purchase that, right? So this one actually is in a downtrend, okay? So this one you'd expect to continue going down. So at this price, it's at the upper band, it's at the upper resistance. It should have a hard time going over it. So this should be a short from here, because you'd expect it to keep going down, right? So they actually have their own section for it, okay? A section for it. And then you have trend line, resistance. Again, same thing. And it's honestly the support and resistance is the same thing, because it's in a channel. So the lower one is support, the higher one is resistance. But then you can just look, you can use this and have way higher probability of success than a lot of people who have, other strategies that are overcomplicated. This is just simple and it's proven, right? Again, I don't recommend having this as a strategy, because that's too basic. A strategy needs to incorporate way more. Like if you just do this, if you find charts that have strong trends and just go with them, like let's say here, you see that the trend is persisting, you just buy here, nice, you sell here, you can even short here, expecting it to go back down, good. You're probably gonna make money, right? But not crazy good money, right? So if you want a fully developed strategy, you have to do more. You need more. But like just something as simple as that is way better than a lot of the other strategies that I hear people talk about. So this will actually be like, if you have strong trend lines, you just go with them. Honestly, it's still good. You can make money off that. Now, you see, you have your trends, you have your channel up, channel, and channel down. And again, the fact that you have these on Finviz and everybody sees them, it proves to you and it shows you that this really works, right? Like the fact that so many people see it, and because so many people see it, it affects their orders, then it's going to persist, right? Sorry, the light closed here. My man Omid getting the lights. Okay, so when you know that a big website like Finviz that everybody uses, okay, has a section for these channels, you know that a lot of people are using them, right? And if a lot of people are using them and a lot of people are looking at them, then what does that mean? That means they're more likely to persist. So again, in trading, you don't want to look at something that nobody looks at. Because if nobody's looking at it, then what's the point of using it? Because truly prices are going to be moving because of other people. Because if other people are buying or selling. They're not moving because you were able to predict by looking at this if it's going to go up or down. They're moving because you're able to predict by looking at this what other people are going to be doing. And because of what other people are going to be doing, that's what's going to help the price move in the direction that you think it's going to move in. Re-listen to that part, but truly, you never want to look at something that nobody looks at. Because if it's not affecting other people, it's not going to be affecting the price of the stock. Because the price of the stock is only going to be affected by what other people are going to be doing. Okay? So, I said it well this time, so re-listen to that part. Super important. Okay? That being said, okay, let's go over a few of them. So I recommend that you go see that and side channels. Let's go side channel. I really recommend that you go and look at these patterns and in a paper trading account, okay, with fake money, trade them. Come on one of them, look at it, and try and see if you're able to make money just doing something as simple as that, you know? Going in, seeing a side channel and saying, okay, well, you know what? Next time it goes here, I'm going to buy, or next time it touches here, I'm going to short, and I'll see how much money I make, okay? Okay, so that being said, trend lengths, okay? What is the length of a trend, okay? The thing is, you're gonna have different trend lengths within the same chart. So I might have a chart that's going down in the long term, right? If I'm looking at, you know, a year or, you know, half a year, it's going down. But then I might have a medium-term trend within the long-term trend that's to the opposite direction. So here I have a medium trend where it's actually going up for a few weeks, right? And within that medium-term trend, I can have a little short-term trend that's even the other side of that, right? So you'll see that there's different length of trends that you can look at. So which one should you look at? Okay, I recommend that you look at all of them. Don't go against the whole general trend. And again, it depends how long you expect to hold the stock. If you're holding the stock just during a day, you don't really care about the long-term trend. You're going to be caring about the medium-term and the short-term trend. Okay? But if you want to buy a stock for a few months, then you want to make sure that you're looking at the long-term trend, right? But the best ones are going to be when all these trends align. So if I have a long-term trend that's going down, I'll say, okay, well, I only want to short. I don't want to buy. So I'll wait until I have a medium-term trend that's also going down and a short-term trend that's also going down, and I'll short here. So that'll be a good position, right? So when everything is aligned, my long-term trend is going in a direction and my medium and short are also going in that same direction, stars aligned, let's take it, right? If you're trading intraday, you don't need to look too much at the long-term trend. You're going to be focused more on medium and short-term trends, okay? And another thing that I wanted actually to talk, just to wrap up this lecture, to talk about when we're looking at support and resistance and we're looking at round numbers, and we're actually going to be talking about support and resistance again in the next lecture when we're talking about chart patterns. So we're not done with support and resistance at all yet. But something about round numbers. When I said earlier, round numbers, okay, like the $100 here. Let me just erase this one. Okay, so the $100 at the bottom chart. Okay. Oh,
Let's see here. Why is this a resistance? Because a lot of people have orders to sell here, right? Maybe millions of shares. Now, if this was in June, okay, and in July, do you think, like getting a month later, right? A month later, if the price is reaching 100 again, would you expect the people that were there to sell at 100 to still be there? Yeah, maybe, yeah, probably, you know. And then if the price comes back, do you still expect a lot of people? Yeah, I still expect a lot of people at 100. Is it the same people who are there? I don't know. Maybe they just sold at the end, or I don't know. So when you're looking at daily and from month to month, the people who were there at that price, they might not be there anymore. But if I'm looking intraday or within the same week, okay? If I'm looking intraday, so at 10 a.m., the price went up to 100. It didn't break. It came back. And then at 1 p.m., the price is going again up to 100. Do I think that this guy who was there to sell, or these guys that wanted to sell their shares at $100, are they still there? Okay, and do they still want to sell? Yeah, it's just a few hours ago, right? So when you're looking at intraday, supports and resistance tend to be way stronger, because the person who caused, or the persons who caused that support or resistance, they're probably still there, and they're probably going to still cause that support and resistance, right? So very important. So in any time frame, it's important, but when you're looking at short time frames, round numbers are extremely important. And when we're trading intraday, I always send orders if I want to buy something just above a round number. If I want to sell something, just below a round number, because I know there's a lot of people buying there and a lot of people selling there. So I want to use them as support and resistance, right? Now, that was a long lecture here. So if you didn't understand something, go over it again. If you didn't understand something still, write it in the comments. I'll answer all the questions. And other than that, I'm going to see you in the next lecture. Hey guys, welcome back to the Complete Foundation Stock Trading course. Now, in this lecture, we're going to be talking about chart patterns. So what are chart patterns exactly? Chart patterns are just patterns that you see on a chart, literally, that can give you an indication of either continuation or reversal. So they tell you if the chart is going to continue in the direction that it's going, or if it might go in another direction. Okay, so why would they tell you that? Well, because in technical analysis, we say that history tends to repeat itself, and it is true. So some patterns that historically have shown a type of movement after that pattern, well, we'll believe that it is more likely that they will continue showing this type of movement after that pattern. And it makes sense. And you might say, well, no, it doesn't really make sense. How is that possible? Well, tell yourself this. Why are these patterns on charts? Because of people, right? People buy and sell stocks. And people and their emotions don't change throughout time. So if people act in a certain behavior in the past, they'll act within the same behavior in the present and in the future. So if that behavior caused certain type of patterns to be drawn on charts, well, those patterns are going to be drawn again in the future. And really, at the end of the day, like a chart, when you're looking at it, it's just an indication of historical supply and demand, right? Because it's just the prices that the stock or whatever product you're trading, the prices that that product was trading at a certain time. So, you know, a chart really gives you a story of what the stock has done, okay? And that story, again, since it's driven by supply and demand, and because supply and demand by people, by traders, and traders are still the same type of people, you know, their emotions hasn't changed, the same type of charts and patterns will repeat themselves. So some of the patterns we're going to look at: head and shoulders, okay, not the shampoo; double top, double bottom, double top, multiple tops. Then we're going to look at double bottoms, multiple bottoms.
We're going to look at triangles. So ascending triangle, descending triangle, wedge, upward wedge and downward wedge. We're going to talk about cup and handle and the rounding bottom. So one thing really quickly. These are the most popular chart patterns that everybody uses, all traders use, and they're the ones that I have seen to work the most. Okay, now if you want to know about all the chart patterns that exist, there's literally hundreds. There's hundreds of different chart patterns, but you don't need to learn them, and I'm going to explain at the end of this course why. Okay, why you only need these ones mostly. So let's start. First chart pattern, called the head and shoulders. And this is one of the most famous patterns actually. And why is it called head and shoulders? Well, basically because it looks something like this. So let's see here, let me get this on. So you have a chart where the prices goes at a high, comes back down, goes to another high that's higher than the previous high. Price goes down again to the same level, goes back up somewhere approximate to the previous level here, and then drops. So in this pattern, you have what we call two shoulders. This is going to be the left shoulder, this is going to be the right shoulder, and this is going to be the head. So that's why it's called head and shoulders. Okay, here we go. And it actually makes sense, right? Because if you see here, the price is going up, so there's increased in demand for the stock. Then demand stops and there's increased in supply, so the price drops. Then demand comes back in, kicks in, goes way higher. Supply comes back in, but there's support here. And this support here, that price level, we call it the neckline. So you have your head, your shoulders, and you have the neckline. So there's support at that price. And then the price goes up again because demand comes up, but demand isn't able to push it higher than previously, right? So it actually stops at that same level and it drops again. And now the theory behind head and shoulders is that after the second shoulder, since it wasn't able to go as high as the previous one, there's more supply, it's going to break the neckline. And if it does break the neckline, it gives us an indication or to sell the stock. So we would expect the stock to drop if it breaks this support. Now, why does it, like, you know, the example that I talked about supply and demand, does that really make that much sense? The thing with chart patterns is that these patterns have proven themselves historically, right? And because of that, everybody looks at them and looks for them. And because everybody's looking at them, what do you think happens when everybody sees this pattern and then the stock price breaks here? Everybody shorts it. Everybody sells it because they think it's going to go down. So what happens? It goes down. So does it go down because it's head and shoulders, or does it go down because everybody believes it's going to go down because it's head and shoulders, right? So nobody really knows, but you know, it's a self-fulfilling prophecy because everybody believes it, it happens, right? So it could be it happens because it makes sense, or it could be it happens because it's a self-fulfilling prophecy and everybody's doing it. But regardless, it happens, right? So you have to follow it. And it's so it's so popular that let's actually get on Finviz. So if we go on finviz.com, and there's actually a section here for indicators, right? This section here, you can look, and we looked at that before for trend lines. There's actually a section for head and shoulders, right? It's super funny because this website, everybody uses it. And they have a section specifically for that pattern. And then you can look at charts where they believe that there's a head and shoulder. Oh, left head and then right shoulder. Obviously, well, this one never broke and it doesn't look really good. So you gotta make sure you go through them and find one that looks good that everybody else is gonna see, right? Obviously, Finviz, they have their algo that looks for them, and it's hard for them to find for a computer to look at charts. But regardless, why you want one that looks good? Because you want one that everybody else is going to be able to see. Because if you're the only one who sees it, then why would it work? You need other people to see it. Because at the end of the day, your objective is, it's not just to predict where a stock is going to go. Your objective is to predict what other people are going to do. Because what they're going to do is what ultimately is going to drive prices. So if you see a pattern that nobody sees, well, what's use is it for? It's not useful. You want to make sure you see a pattern that other people are going to see. Or if you can see it before they see it, that'll actually be even better, right? Because what you want is to have a position before the supply or demand comes in, right? So this is one of the patterns. You're not going to see this one as much, but when you see it, a lot of people do follow through with it. So make sure to look for it. Okay, now this pattern is actually called the double top, and this is actually one of my favorite patterns, and there's a reason for that. The reason for that is it actually means something. There's a fundamental reason why it works. It's not just a self-fulfilling prophecy, or we don't know. There's legit reason why this works. On top of everything else, on top of the fact that everybody looks at it, on top of the fact that it's self-fulfilling prophecy. So a double top is basically what its name says, right? I guess you all know what it means by now, and it's pretty clear here. It's a chart that topped at two different locations. So it went to a high, then traded somewhere else, then came back to that same high, wasn't able to break it, and came back down. So now what do you have? You have two tops. So what that tells us is this price level is a resistance for the stock. The stock is unable to break it. Hits it here, isn't able to break it. Hits it here, isn't able to break it. So then you know that this is a resistance, so the stock is going to have a hard time breaking over it. So you would think that it is way more likely to fall down than to break that level. Okay? And what are the reasons behind that? Well, maybe there's a big seller at that price. Maybe somebody has a big order, right? Because we've talked about orders before. Prices move up and down because of orders. If there's a lot of people who are selling, or one person who's selling a huge amount of shares at $70.50 here, well, every time the price goes up, there's too many sales to sell. So even though a lot of people are buying, they're not able to push the price up, and then the price goes down. Again, comes up here, maybe the seller is still there, right? So the double tops and the other multiple tops and all of that we're going to talk about, there's actually a reason why they hit a price and they're not able to break through it, right? And that creates the double top. It's a resistance point, okay? So there's a reason why we would think that if this price goes back up here, it's probably going to bounce off this resistance again and fall back down, okay? And why? Well, is it because we saw a double top? Well, it's more because there's resistance and there's probably a seller there. But we see that through the double top, okay? Now, this is super strong. And again, if you go back on Finviz, okay, there's actually a section right here, double tops. And they have a bunch of charts where you see stocks that double topped, right? And this one at $15. Again, $15, a round number. Might be a lot of sellers at $15 willing to sell the stock at 15. So every time the price goes up there, bounces off of it. Okay? And then goes up there, bounces off of it. Okay? And it's funny for this one. So this stock actually is trading within a channel, which we looked at in the previous lecture. And this channel has the lower part of this channel is at $10. And the highest band of the channel is at $15. So two round numbers, right? And we actually talked about that in the previous lecture. This is funny because this is a random chart I looked at. And in the last lecture, we said, well, support and resistance and channels, they tend to be, well, not support and resistance, but we said that a lot of support and resistance tend to be around round numbers because a lot of people send their orders at round numbers. And here we go, a round number, $10. Every time the stock price goes down, bounces off $10 because probably a lot of people have their buy orders there. And again, bounces off again, and it goes to 15, bounces off 15 because maybe a lot of sellers have their orders to sell at $15, and again, bounces back off on 10. So you see how all of these are making sense. And even the double top, well, look, happened at $15 at a round number. So what we would expect if this stock was to go up again and go to 15, it's very likely that it bounces off of it and drops back, right? So that's what a double top would tell us, that if you want to get into a short position, get into it somewhere here, because it's very likely that it's not going to be able to go above that line, that resistance line, and then it's way more likely that it'll just fall down, right? So how I love these double tops. So when you're looking at double tops, we just looked at a daily time frame. We're looking at a daily chart, right? But the thing is, you could look at double tops on any type of time frame. You can look on a daily chart, on a minute, on a minute to minute chart, on a 5-minute chart. So you can look intraday, what happened within the day. And you might see that a stock, let's say at 9:30 a.m. is trading at, $9. And then by 10, it goes, so this is 9:30 a.m. It's trading at 9. And then by 10 a.m., let's say let's say it's trading at $10, and here's price, and time, and up until the close of the day, which the close is, let me put this here, the close is at 4 p.m. Well, the stock fluctuates, and maybe every time it goes to 10, it bounces back off of it. So we have a double top here, right? One top, two tops. Now, when you're looking intraday, within a day, double tops actually mean way more than if you're looking on a daily chart. Why? Because let's say in the example we looked at, the double tops, the first top happened, in June. And let's say the second top happened in September. Well, if this resistance, okay, let's call this the resistance, okay, which this resistance here is probably caused by a lot of sellers, right? High supply, a lot of orders to sell. The supply that was here in January, these guys that were selling, are they still here in September? Or if it has a double top, maybe June, July, okay, let's say this is July, and then September is here, let's say, a few months later, the stock, fluctuates and it comes back and it tests this level. Do we expect that this resistance, okay, do we expect it to hold? Do we expect that the same sellers that were here, that supported that price, made the price, were a resistance to the price couldn't break through them, are these orders still here several months later? We don't know, right? Maybe not. Maybe they got their positions and they're done and now things changed. But when you're looking intraday, if at 9:30 if at 10 p.m. at 10 a.m. there was a big seller here and the price couldn't break that and came back down, then at 10:30 a.m. 30 minutes later, again it came back up and it couldn't break that price because maybe that seller is still there. With maybe at 11, let's call this 2 p.m. A few hours later, if it goes back there, well, it's still very likely that the seller is still there and that this resistance is still going to be there, right? So it's actually stronger in the shorter term, because in the shorter term, whatever caused that double top is still there. It's very unlikely that it's not there anymore, okay? Now, on the other hand, when you're looking at daily charts, everybody's going to see that support and resistance, right? Because this is intraday. So within the day, not a lot of people are looking at it to see that price. But everybody looks at the daily chart. Everybody looks at the long-term charts. Okay, so if there is a double top at one point and you see this resistance, a lot of people are seeing it. So a lot of people are using it as well. So they both work in their own way, and they both mean something, even on the longer term or even in a short term within the day. So you can use it across the board in terms of time frames, and this is why it's a very useful pattern. Again, if everybody sees a double top at a certain price, okay, double top, then what is everybody gonna do if they want to sell the stock? If they want to sell it somewhere around here, they'll sell it here, because they know that it's very unlikely that the stock goes above it. It's very likely that the stock goes here. So they'll all send their sell orders here. And by having so many sell orders here, well, the stock is not going to be able to break above that price, and it's probably going to top at that price again. So again, it's a little bit of a self-fulfilling prophecy again, but it actually relies on something fundamentally true, and that makes a lot of sense. So this is why, this pattern specifically makes a lot of sense. Okay. Now, let's check another one out. Next one, multiple tops. What a surprise, right? So multiple tops is exactly the same thing as double tops, but you've guessed it, there's more than two. So you have a top here in this chart, another top, and then another top. Now, what's the difference? Well, the difference is the fact that it actually tested that price another time, and another time it failed at breaking it. So it makes that resistance or that top even stronger, right? Yeah, if it hit it twice, it means something, there's big resistance. But if it hit it 3 times, 4 times, 5 times, it gets stronger and stronger and stronger as more and more people see it, and more people believe in it and put their orders at that prices and make it even stronger, right? So, and again, on any time frame that would work, any time frame. Let's get back to Finviz. Again, in Finviz, there's a section for multiple tops. And you can look through them, and you're going to see a bunch of different charts where you have something that hit a top several times and it couldn't break through it. So this stock, for example, every time it hit that $2.50 range, couldn't break over it. Here. Okay, then comes back, tests it again, can't. Tests it again, can't. Tests it again. So when you're looking at, and again, you see this channel, moving within a channel. When you're looking at a chart like this and a stock it's unable to break a price level, okay? In this case, the $250 price level. What is it telling you? Like, how can you make money off of this? Well, you can short the stock somewhere here, okay? And let's see here. Let's draw here a bit. Let's put a blue color. Okay, so you can short a stock here at, let's say, okay, well, this pen isn't really working well. So let's say you short here at 250, okay? And you try to get out somewhere here at, let's say, 220. So you can make a 30-cent profit if the stock drops, right? So you can make 30 cents just as the stock drops. Because it's extremely likely that the stock drops from here to here, then the stock breaking over that huge resistance and going up, right? At the end of the day, to make money in trading, it's all about probabilities. You're taking a bet that a price goes in a certain direction. And you're never going to be 100% right? You're going to be wrong sometimes. But what you want to do is be more right than you're wrong. And when you're looking at something like this, what do you expect to happen? Is it more likely that this price falls, or is it more likely that it breaks a resistance line that it was unable to break before. Obviously, we'd all agree that it's way more likely that it goes here. So you can short the stock here, 250. If it drops from 250 to 220, you take out your profit here. Obviously, you take it out here. You don't try to make more money because here also there's a support. So it's unlikely that it falls below here. So you make 30 cents profit. And if it breaks over here and it goes to 261, let's say, above 260, because it never went above 260, well, take your loss. Then you lose 11 cents. So you either make 30 cents or lose 11. And honestly, just simple strategies like this, okay? You can make way more money than some overly complicated strategies that nobody knows about. Because the thing is, you want something that other people see. Because always put this in your head. Why a stock is going to go in a certain direction is because other people believe it's going in that direction and they buy it or sell it expecting it to go there, right? So if you're doing something that, you know, not other people are going to be doing and helping in that, you know, in making that move happen, then it's not going to happen, right? So something like this that everybody looks at, and again, you know, if anybody looks this stock up on Finviz, Finviz literally shows them the multiple top right away. So everybody's seeing it. There's actually a section for it and it pops out, right? So this makes a lot of sense, okay? All right, so let's clear this out. Let's see here, clear. Okay, so next pattern. Let's take this off. Next pattern. It's double bottom. Okay, so double bottom, you guessed it, right? Same exact thing as double top, but it's at the bottom. Okay, so stock price is fluctuating, falls down to a certain level. Oops, can't break that level, goes back up. Oops, can't bury that level, goes back up. And again, look at this, how funny. At $14 is the support. Again, a round number, right? Probably a lot of people have their buy orders here. Price wasn't able to break through. A lot of people think that it's a very good price, $14 to buy that stock. So they're buying it there. They're not letting it go below. Too many buyers at that price. And it goes back here. So again, that stock, if you're looking to buy it, buying it at 14 is an extremely nice place, right? Because it's very unlikely that it breaks below it and goes down. So if you buy it here, you have a lot of chance of making money as it goes up. A very low chance of it breaking down and then losing money. Okay? You guessed it. Multiple bottoms. Same thing as double bottom, but you have multiple ones. So touches a support level, touches a level, goes back up, touches that same level again, and touches again. So 3 times or more. Again, if you're looking to buy that stock and you put a price just over here, if you get it, it'll be a good price because unlikely that it falls below. So it's the same thing as double tops and multiple tops. And if we go again on Finviz, you'll see that there is a section for double bottoms here. So same thing. Look at this one. This one is at $5. So it's going in a downward channel, but then when it touches $5, it goes back up to $6. Touches $5, and now it's here. So this is a good place to buy it. Why? Because if you buy it here and it goes up, you make some money. If it breaks down, well, you take a loss, a really small loss, right? And that's it. So your potential for gain is way bigger than your potential for loss, and your probability of losing is way smaller than your probability of winning. And if you keep repeating this type of trade, you're going to make money. Why? Because yes, sometimes you're going to lose, but not a lot of times. And those times you're not going to lose a lot. But the times that you're going to win more, and they're going to be more often. And even though sometimes you lose, if you keep repeating those those trades, if you keep repeating it, just the amount of money and times that you'll win compared to the amount of times and money that you lose is going to be way bigger. So you're going to be profitable, right? The important thing is to keep repeating it. So that's a double bottom. And again, they have a section, multiple bottoms. Okay. And in that section, Same thing. Stock touches a price level, touches a price level, touches a price level, is not able to break that price. So really, I suggest you check out this website, check out Finviz, check out some of the charts they have, and see if you can recognize some patterns and paper trade them. Okay, paper trade those patterns and see if you would have made money by just following simple, robust, meaningful patterns like these ones. Okay, so give them a try. Now, next pattern we're gonna look at is gonna be, let's see here, put this up, triangles. Triangles are also some of my favorite and most useful patterns. Why? Because they're actually meaningful, right? They mean something. When you're looking at a triangle, what are you seeing? What is it telling you, right? When I look at something like this, again, first of all, the reason why they're called triangle, because you can see here, it looks like a triangle. You have this line, which is a resistance line, and you have a support line. Now, there's three different types of triangles. You have the ascending triangles, you have the descending triangles, and you have your regular triangles. Ascending triangle, and this is the first one we'll cover, is one that is the support is going up. Okay, so you can see that triangle is going up in a way. Now, when I'm looking at this, what does it mean when you look at something like this? What is this chart telling you, right? Because that's what really you wanna understand is what is this chart, you know, what is its story, right? So when I'm looking at this and I'm seeing the price going up, okay, and then I see it goes up a bit, comes back down, but I see here it doesn't go as low as it was here. So it seems that buyers are being more aggressive and wanting to buy it at a higher price than they were willing to buy it in earlier, right? So let me put this on. So buyers, at this point, people were buying it here, then it goes up, they're buying it at a higher price. Okay, they're being more aggressive. Now the price goes up at this price level, and then sellers start selling. Okay, a lot of selling pressure here, so the stock price goes back down. Now buyers start buying, but again at a higher price than here, and this one at a higher price than here. Price goes up back again at the same price. Sellers, too many sellers here. Downward, more supply, so price goes back down, and it doesn't go as down as it was here, right? It doesn't go as down as it was here at the same price. So buyers are being more and more aggressive. They're willing to pay more and more for that stock. Okay? Not sellers though. Sellers are always selling at that price here. They're being more aggressive at that price. So here again, goes back up, sellers sell. Sellers are selling. You see here, the price is unable to break that level, the 96, 95 level. But then it falls here and you see buyers are being more and more aggressive. They just want to buy it. So what do we expect to happen on an ascending triangle? Well, we're seeing that the price is getting wedged within the triangle, and it's getting, really the buyers are being so much aggressive that they're nearing the sellers, okay? So at one point, somebody's going to win. Either the buyers are going to be like, hey, we're going to buy everything at that price, or the sellers are going to be like, hey, we're going to sell everything you need and we'll sell some more, so the price is going to drop. So somebody's going to win. But from this chart, we can see that the person who is being more aggressive, who's being more impatient, are the buyers, because they keep buying at a higher price. So what usually will happen is that the triangle will break to that direction. Okay? Prices will break over here and then it'll fly. Obviously, it doesn't happen all the time. Sometimes it breaks down, but most often, again, it's a probability thing. Most often, this is what happens. So what would you do and how can you profit from that? You just buy it here and expect this to happen? No. You wait until it breaks over this level, right? So Let's clear this. You wait until the price breaks over here, and then you buy. Because at that price, everybody sees that there's an ascending triangle. Well, everybody saw it already, but nobody buys before there's a break. Because people know that, okay, well, hey, it has to break at one point here. Where is it going to break? Is it going to break for above, or is it going to break below? So everybody's watching that. And as soon as it happens, what do you think happens when the stock price breaks here? Well, everybody who was short the stock, okay, who was using this as a resistance point, you know, because they thought the price was going to go down. Well, if it goes up here, they'll be like, okay, I lost. I'm going to take my loss. So they're going to buy it. They're going to buy back their short position. They're going to cover their position. And when they do that, what happens? Well, the price is they're going to buy it. So they'll push the price up, right? And other people who weren't short, who just wanted to buy, that didn't buy here because they know that there's resistance. Well, once that price breaks that resistance, they'll want to buy it. So also they're going to be buying it here. So again, more upward pressure here because there's so many more buyers. So what you want to do is you don't want to buy in advance. When this happens, that's when you buy. When it breaks, okay? So you want confirmation before doing what you want to do. So if you buy here and it goes up, you make your money, super good. If it doesn't and it actually comes back down, well, you take a small loss, right? But more often than not, you are going to be making that money. Now, another pattern, and let's take this drawing off, is going to be, let's see here, descending triangle. So descending triangle is exactly the same thing as ascending triangle, but you guessed it. So the sellers are the ones that are being more and more aggressive, right? So it's a triangle, but you can see that it's going down in that direction. So you have buyers who are buying the stock at a certain level. They're consistent in the level that they're buying at, okay? This is what they perceive as a good price. Now the sellers, they were selling here before, but then they're selling at lower and lower prices every time, okay? They're being more impatient. They're willing to sell at a lower price. And that's why you see this type of pattern, right? So this is what this chart is telling us as a story, that, hey, the sellers are being more and more impatient. They're selling, they're selling, they're selling, they're selling. So now what do we expect to happen here? Well, obviously, either the stock price, okay, either the sellers are going to be so aggressive that they're going to sell, and they're going to sell so much that these buyers aren't going to want to buy anymore. And the sellers are going to push it down finally, right? Or maybe not. Maybe the sellers are going to come and they're going to sell, but then there's too many buyers here, and then the price is going to go up again. So that's why you don't take a position before the break happens, because you actually don't know. Yes, it is more likely it breaks down, but you don't know if it is or if it isn't. So what you want to do is wait until it breaks down, okay, and then get in, you know, because then it could then short here, you know, wait until it happens, it breaks, you have a confirmation, and then short. And then if it keeps going down, you make your money, okay? So again, you don't want to take all the trades. You want to take the high probability trades, right? Because there's so many stocks out there. There's so many opportunities. You don't need to jump on anything unless it looks really good, okay? So if it doesn't look as good, find something else. You're going to find something that looks good, okay? And just take the best trades. So this is, and again, it makes sense, right? And not only does it make sense, but tell yourself this: a lot of people are looking at it, so that's why it'll work. Okay. Okay. So another pattern. Let me take this one off, and they're all the same, right? So a regular triangle. Okay. So this isn't ascending or descending, and we actually call this one a wedge. Okay. So since it's a triangle. But it's not ascending or descending, we call it a wedge. And in this one, you'd see that, okay, well, sellers are selling at lower and lower prices. They're being more impatient. And then buyers are buying at higher and higher prices. So they're also being more impatient, right? So you'd see that the price is getting wedged here, right? It's getting wedged because they're both being more and more aggressive. So what is going to happen is at the end, somebody's going to win, either the buyers or the sellers, right? And it's going to break out in one direction. So a lot of people are going to be watching this, right? A lot of people are going to be watching this pattern and waiting to see which direction is going to break in. Because once it breaks, then they're all going to be going in that direction. Okay? In this case, it broke upwards. So the buyers won and whoop, went from $32 to 34. Now sometimes it keeps going, and sometimes it comes back and it tests this level, and then it keeps going, right? And sometimes it might just come back again, but this is again way less likely, and we're not in the business of always being right. But being right most of the times, okay? And again, what did we talk about last course? Resistance, once it's broken, becomes the new support. So when you buy above this resistance, you're pretty good. You see it went up. In this case, it didn't keep going up. It came back, but it's supported there, and it's way likely that it keeps going up. So very good patterns. And again, if you go on Finviz, look at this. There's a section for it. Ascending triangles. Here we go. How good does this look? Okay. Here we go. Okay, so if it does break over that price level, which is 39, right? It never broke 39. Tested it every time. Buyers are being more and more aggressive. Okay. Tests the 39 level a bunch of times, is unable to break it. What do you think happens when it finally breaks it? Right? And again, you see buyers are being more and more aggressive. This is a super nice chart. Again, there's a bunch of them. There's a bunch of them, and they all, look at this one. Here we go. Look at this pattern. You cannot not be seeing this, okay? So imagine if it breaks over that level, okay? Right now, imagine it just breaks. You know this can go, right? And again, this is ascending triangle. You can go and look for descending triangles, okay? Same thing. You'll find some pretty nice charts for ones that are descending, okay? Wedges. Here you have wedge down, wedge up. So you have all the wedges as well, right? So you can see symbols that are being wedged in a zone, okay? And that are very likely to now explode. You know, the further they go within the wedge, right? The further they go within the wedge, the stronger they'll explode. So if I have a wedge, and let's see here, if I have, let's say I have these two wedges, okay? I have this wedge and this wedge. If I have a wedge where, you know, the price went up, went down, and then it broke here, yeah, it might go a bit. But if I have another wedge where, the price went up, went down, went up, went down, went up, went down, went up, went down, and now it's so, it went so far in, when it breaks, it'll really explode. And this is just something that we see all the time. The further they go, the further they're wedged, the longer they stay in it, the stronger the explosion, okay? And again, we see this on every type of time frame possible. We see it on daily time frames, and we see it on intraday, right? So you can have something that's from 10 a.m. to 1 p.m. we might have a wedge. Prices goes up at 10 a.m. then by 10:30, 11 a.m. By noon, and then by 1 p.m. it breaks, So we see this on within a day, on 1 minute charts, and sometimes on daily charts, on every type of chart. You're going to see it. And again, these are some of the best patterns that you can look for, because they make a lot of sense. So very simple, and they work. So why not? So other than that, again, triangles. So this is the wedge up. Again, wedges, you can have them going up or down. It's the same. And you know what? And this is why I already talked about this in the other lecture. And this is why I don't like to remember exactly which one is called what. I don't care if it's called an upward wedge, a downward wedge, an upward triangle, a downward triangle. It doesn't matter. You just got to understand what it means. When I look at this, I don't need to know what it's called. I just look at it and say, okay, well, look, buyers are being more aggressive. Oh, sellers are selling here, but buyers are buying at a more aggressive price. Oh, sellers are selling. Buyers are more aggressive. Sellers are selling. Buyers, they keep pushing the price up. oh, this is very likely that it breaks up because of that, without knowing the name. So don't try and know the names, try and understand, because knowing a name by heart isn't going to help you make money. But understanding the reason, that's what's going to help you make money, right? And that's why, I never ask any of my traders to remember any of those names, but I ask them to understand it, right? Because if the people who knew the most chart patterns, or they knew by heart all the names, were the ones who made the most money, everybody would be just learning the names. But it's not. It's the people who actually understand the meaning, right? What is behind it. So you have, in this situation, same thing as the triangle, okay? And you have a wedge down, same thing as the other ones, right? Price going down, but sellers are the ones that are being more and more aggressive. They're wedging them. And, oh, look at this. Looks like it's about to break. So if this breaks here a bit further, this can really go. So, again, same concept as the other ones. Okay. Now, those were the triangles. Another chart pattern that is way more rare and that you're rarely going to see, but when you see, it does hold pretty well. And like this one and the head and shoulders, I don't like as much as the other ones, but they are valid. So I have showed them to you, right? I have showed them to you because they are valid and they are consistent and they've proven themselves throughout time. This one is called the cup and handle. Why? Because it looks like a cup here and you have a handle. So the reason I also like this one, except the fact that all traders know about, is the fact that it also makes sense. So you have price that's dropping, but then it starts dropping slower, and it's slower, and then it stops, and then it starts picking up, and it picks up way faster. And then after it does that, it actually reconciliates and then breaks up. And as it breaks up, then you expect it to go up as much as that distance. So this distance could make it up after it broke here. So again, this pattern is proven throughout time, and a lot of people look at it. And you can see it again. You can see it in any time frame, right? Harder to spot, harder to see, but it makes sense in terms of the behavior. You see something dropping and it slows down, so buyers are coming in, and it goes back up to the same level. But then it doesn't drop; it reconciliates, which is a healthy thing to do after a stock makes a move, right? Because it needs to regroup and then it can keep going. So it makes sense. It reconciliates and then it breaks up again. So that's when you say, "I want my entry." Okay, and so this is very consistent. And the last one is the rounding bottom, which is again. The reason I put this one on is because it looks like the cup and handle, right? Because you have prices that are dropping, but then slows, then picks up, and this very likely. So it doesn't need to have the reconciliation. Very likely that it can keep going up. Now, something I want to say about all these patterns, okay, is you can get books that have hundreds of patterns. I've met people who knew by heart 70, 80 different patterns, and they never made money in trading. Never. They thought, if I can learn all the patterns, I'm going to make money. No, because most of these patterns are useless. Why would you want to learn something that's useless, right? There's patterns that nobody ever heard of before. Like you look at it, but you're the only one looking at it. What's the use, right? Because that pattern is not going to affect the behavior of anybody else. And your purpose as a trader is to predict the behavior of other market participants who are going to be trading that security and thus moving it. So you looking at a pattern that nobody looks at is not you being smart. It is you being, dumb. So don't look at something that nobody else looks at. And there's something in math, okay, that says that if you look at too much data, if you have too many variables to explain your results, you actually start losing in precision. So you can't say, okay, to predict the stock of a price, I'm going to look at these 20 indicators. It's too many indicators. you're going to do worse by looking at so many indicators than you would do by looking at just 3 or 4 indicators. So the maximum, I think the max is like 7 things that you can look at. But even that's too much. So you want to look at the most important things. If you look at too much information, you lose precision, you lose value. Okay? And then you actually get more confused. And then you look at things that don't really matter. So honestly, these patterns that I showed you here, these are the ones that we use. These are the ones that I've seen traders be profitable with consistently. And again, just for example, you go on Finviz, and these are the ones that are here. They're all here. There's nothing else. Okay, so these are the most popular ones. So don't go and try and learn all these other ones thinking that, okay, well, if I learn these, I'm going to do better. No. Instead, master these really good ones and let the other ones go. Okay? So that was a bit of material here, but that'll do it for chart patterns. That being said, we're going to continue in the next chapter by looking at some indicators. See you in next class. Hey guys, welcome back to our foundation stock trading course. In this lecture, we're going to be talking about volume. Now, what is volume? When we're talking technical analysis, we're talking about the study of 2 things, price and volume. So it's not just prices. When you're looking at a chart, you actually see 2 things. You're seeing the price movement and the volume. The volume is basically the quantity of shares that were traded. You know, when we said that when you have an order to buy and you have an order to sell, and the 2 prices match with each other, you have a trade, an execution, a fill. All of these mean the same thing. You have stocks that change hand from one person to the other. Okay, a trade occurred, and that trade generates what we call volume. So if 100 shares traded hands, well, that's 100 shares of volume that stock had. So when we're talking volume, we're talking about how many shares were bought and sold. So somebody can ask, well, this stock made 1 million shares in volume today. That means that stock had 1 million shares that traded hands within the day. You can say this stock just traded 5,000 shares in the last hour. So that's really what volume is. Now, when you're looking at a chart, and an example in this chart, you see the price here. This is where the price is at. Where is the volume? Exactly here. So the volume is always at the bottom of the chart. Okay? So when you're looking at this chart, you see on the right side the prices of the stock. So here is the prices. Well, on the left side, you're going to see the quantity of shares. So you see here, it's about 1 million shares, 2 million, 3 million, 4 million, 5 million. So you can see on each day, because this is a daily chart, how many shares were traded on that stock. Now, why do we care about how many shares were traded on our stock? Why do we care about the volume? Shouldn't we just care about price? What does volume have to do with anything? So let me ask you this. If in your neighborhood, okay, let's say you live in a regular neighborhood, and a house costs, let's say, $500,000. Let's say at one point there's a house that sells for 2 million. Can you say that houses in your neighborhood now are valued at 2 million? Not really. But if 100 houses were sold around 2 million each, then can you say, well, the housing, real estate, or a house in this neighborhood is worth that much? Probably, yeah, right? So the quantity does matter. If you just have one thing that happened at that price, does that really say anything? Maybe somebody just wanted to buy a house and, got a really bad deal, But if you have hundreds and hundreds of people who bought at that same price, well, that's the current price. So it's the same things with stock. Imagine you have a stock that not a lot of people trade. And again, we've done the course about the book, the level 2, and how prices work. So if just somebody went and said, okay, I just want to buy 100 shares of this thing, but there was nobody selling it except somebody at a really high price. So the person got executed, got filled at a really high price, bought a stock at a really high price, but it was just one person who bought 100 shares. So would you say, okay, this stock is worth that price now? No. So you need enough people to trade it, enough quantity to be traded for that price to mean what you want it to mean. Okay? So quantity or volume actually confirms price. If there's a price movement, but there's no volume to support it, it's not as meaningful as a price that has volume. Okay? So you can see that there are situations where volume increases. A lot of people trade it. You see that came when there was a drop. And another here, a lot of volume that came when there was a drop. And let's actually just pull up a chart. So let's see. So let's go on Apple here. Okay, I have Apple on this chart. Okay, so if I'm looking at Apple, well, look at this. This is the volume at the bottom, right? And you can see like, okay, here there's an increase in volume, okay? So over here, let me see if this will work on this. Let's see here. So over here, we have an increase in volume. Here, regular volume, here increase, and you see it's associated with this drop. So something happened here and a lot of people traded, okay? And also here, if you look here at this side, and I just realized you probably didn't see this because my face is probably covering this right now. So let me put it here. All right, so here you can see it. So you see the volume here, okay? Increased. There was a lot of volume. It was due to that drop. So a lot of people traded here, way more than usual. Way more shares exchanged hands than usual. Usually there's about this many shares that exchange hands. Here, twice as much more. And if you look at this situation too as well, where volume really spiked up, and rightfully so, because look at the stock. Here it was $120, and here it opened way higher, $128. The stock went way higher. Why? Because there was earnings, right? And they beat earnings, which we'll cover in, I don't think it's in this course. It should be in our more advanced course where we talk more about earnings and how you can play those. But you can see that on a news, something came out and it affected the stock. The stock went really up, but there's a lot of volume that came. A lot of people traded that. So the important thing to know and to understand really about volume is the fact that volume actually precedes price. And what that means is when something happens and the stock is going to move because of this thing, you're going to see a lot of volume coming in before even the price moves, right? If the housing market is going to explode before the prices actually go up, you're going to see that a lot of people are buying houses. There's a lot more volume. A lot of houses are exchanging hands. More buyers are coming in to buy. And then prices start going up, right? So it's the same thing in stocks. Before prices go up, you're going to see volume coming in. A lot of people buying. And then after that, that's when the prices starts moving. And then it can just, skyrocket. So you always want to be looking at volume because volume is always going to precede price. But then if price goes up, but it's not supported by volume, there's not enough people pushing it, then there's very low probability of continuation, right? So if you have a stock, let me take another color. If you have a stock here, let's say, let me get this back. Sorry, give me a moment. So if you have stock fluctuating, and then at one point, let's say this is $9, this is 10, 1 point, and the volume is always, let's say, relatively low. And then you see volume coming in, a lot of volume, okay? then you're like, oh shit, something is happening, right? Is there so many people coming in to trade the stock? You know, something is happening. And this is always going to happen before the price move. And then the price is going to start moving. And then obviously volume is going to increase again and price might increase. You know, again, volume doesn't mean that the price increases. It could be an increase in price, or, you know, it could be also a drop in price. Okay, you don't know, but it is going to be supported with high volume. Big moves are supported with high volume. Okay, big moves either to the downside or upside are going to be supported with high volume. Now, let me see, if there was not high volume, okay, if there was not high volume, and then all of a sudden, prices go up to, like, you know, $13, and there's no high volume, do you expect these prices to keep going up? No, because they might have just gone up because there was not enough buyers and somebody just wanted to buy some. There was not enough sellers, sorry. There was not enough sellers and somebody just wanted to buy some. So for him to buy some, he had to push the price up a bit because nobody wanted to sell at the low price that he wanted. So he had to push the price up. And it's just that, right? It happens. It's a timing thing. Maybe a fund wanted to buy, 1 million shares, but there wasn't enough people and the price got pushed up. You know, so if there's not enough volume, it's less meaningful and the price is very, very likely to get back to where it was, as this wasn't supported by volume. So always make sure that volume supports your direction. Now, when we're looking at volume, how do you know if it's a lot of volume, it's not a lot of volume? Like, how would you know? Is 1 million shares a lot of volume? Is it not a lot of volume? Right? So stocks have different volumes. So if I'm looking at something like Apple, and let's go on Finviz here, Apple, well, how much volume did it do today? How many shares did it trade? There's a place on Finviz, you can actually go and see that. And it's right here. Okay? So here, you can see that it made about, and let me see, I want to make sure that you guys can see this part. So let me actually, let's put it here. So on Finviz, okay, I'll put it here in case my face is covering it. So you see volume here. This stock makes about 25 million shares today in volume. Okay, that's just today. But what does that tell me? Does that tell me anything? Is that a lot of volume? Is that not a lot of volume? Okay, well, if I look at, I don't know, any other company, let's say I'm looking at Ford. Well, Ford made 33 million today. Okay, I don't know, if I'm looking at, let's go just find a random company here. Maybe let's go in these channels and take a random company, this one. This one only traded 10,000 shares, right? So you have a company that we just looked at, traded 35 million shares in a day. And then you have a company that only traded 10,000 shares. So you have companies that trade amounts of shares that are, in all kinds. You have companies that trade 100 shares a day that are almost nobody trades them. Now, the volume that it did today doesn't mean it does that volume every day. So what we usually want to look at is the average volume. What's the average amount of shares that it does in a day? Okay, because every day is going to fluctuate. So what you want to know on average, okay? And usually everybody looks at the 3-month average. So the last 3 months worth of volume, what's the average of that? And on Finviz, here you have it. It's right here. Average volume, 3 months, right here. So this one actually on average does 28,000 shares a day. It happened that today it made 10, but some days it does way more. So it makes about 28,000 shares a day. If I go back to, let's say, Facebook on average, well, we actually didn't check Facebook, but so Facebook on average does 17 million a day. Okay, so when I'm looking at high volume, is there a lot of volume to support a price movement? Well, what does a lot mean? Because if I'm looking at Facebook, and Facebook did 13 million today, is that a lot or is it not a lot? I can't compare this volume to the 10,000 that I just saw of the other company, right? Because the other company always trades about 30,000. This one always trades about 17 million. So how can I say if this is a lot or not compared to the other one? By looking at what's called relative volume, okay? Which I'm going to tell you this right now. This is one of the most important things that you want to know about. Relative volume, okay? Write it down, put it on a piece of paper, draw it on your wall, tattoo it on yourself, you know, whatever it is you have to do, but you're going to have to look at relative volume all the time on anything that you trade, okay? Anything, okay? So relative volume is actually comparing the volume that a stock did to itself. Because that's the only metric that matters, is did I trade a lot compared to what I usually trade, right? Because if Facebook usually does, again, if Facebook here usually trades and about 17 million shares, but today it did 13 million shares. Did it trade a lot? No, not too much. It didn't trade a lot relative to how much it usually trades, right? Because usually, and let me bring up a calculator. Usually it trades 17.6 million shares, but today it traded 13.9 million shares. So if I do 13.9 divided, or right here, let's see, 13,908,894 shares, that's what it did today, divided by, usually it does 17,620,000 shares, right? So it actually only did 0.789, so 0.79 times the usual amount of shares that it does. So if usually one is the stock doing exactly the amount of volume that it usually does, if it did 0.79, it means it only did 79% of the volume that it usually does. And you can see on Finviz, it actually calculates that for you here, relative volume. So you actually have the relative volume for the stock. So today it wasn't high. But imagine that stock had traded a lot today, and it had traded, let's say, instead of, you know, this is about 14 million, let's say instead of 14 million, it traded, you know, 28 million, okay? Imagine that. Imagine this stock today traded 28 million. So 28 million divided by its average volume, which is going to be 17,620, gives you 1.6. So that would mean, okay, well, you know what? That stock traded, 160% what it usually trades, 158% what it usually trades. Okay, so 55% more than what it usually trades. So then you can say, okay, well, something unusual is happening with it, right? Because the only thing you can compare volume to, you can't compare volume from one stock to volume of another stock. It makes no sense, because they're two different separate stocks. What you can compare to is the volume of a stock relative to itself. Okay, so that way you can know if there's something unusual happening with it. If a stock usually does, let's say, again, so let me pull this up here. So this is the relative volume. If a stock usually does, let's clear this up. If a stock usually does 1 million shares, okay, its average volume is 1 million shares. Okay, and today it did 5 million shares. Or let's say actually its average volume is 2 million, okay, just to make it more interesting. Average volume is 2 million, and today it did 5 million shares. What is my relative volume? And the function is very simple. The function is average volume Sorry. Yeah. Very simple, and I botched it. So the function is the current volume, so today's volume, okay, which is this, divided by the average volume, which is exactly what we calculated earlier in the Finviz example, right? So the volume that it did today is 5 million. Okay, so I'll put 5 million here. Divided, how much does it do usually? Okay, well, it does 2 million. So what is the relative volume? 2.5. It did 2.5 times what it usually does, right? So, oh, something's going on, right? And if I look at maybe in another situation where it didn't do as much volume, let's say today it only traded, so it does, again, it does 2 million average, but today it only did, I don't know, 0.5 million. So what's the relative volume? Then it would be 0.5 divided by 2, which how much is that? 0.25. So 0.25. So it only did 25% of what it usually does, right? So not very meaningful. So if the price is going up on today, right, and there's a big price move, but there's not a lot of relative volume, you'd be like, okay, well, why is it going, like, there's no support, there's no volume. It's not a lot of people who have decided that, the stock usually trades more than that. So it might be that the stock went up or down just because of a big seller, because there wasn't enough buyers or sellers to support the other side. Maybe there was somebody selling and there wasn't enough buyers, and that's why the price went down a lot. Or maybe there wasn't enough sellers but somebody wanted to buy and he pushed the price up. But it didn't happen on a lot of volume. So it wasn't the decision of a lot of trades. So it's less meaningful. But if the price went up on high relative volume like this, then it's way more meaningful, right? And when we're looking at relative volume, again, and let me go on Finviz and actually see, there's a section here for the top gainers and top movers. So let's see, like on something that moved like this today, like this thing went up for 65%. Okay, this went up, and let's see if I can get it. This went up 65%. Okay, huge. Okay, so on something that went up a lot like this, look at the volume here, and I'll try and zoom in again a bit, as much as I can. Look at the volume here. You see how high it is compared to usually? So usually it's not a lot of moves. Look, there's not a lot of volumes, but you see on the days that it really moved, because again, you got to see that like this went from $3 to like $5, which is a huge percentage move, right? But look, on those days that there was big moves, look at the volume. So the volume is extremely helpful when there are big moves, okay? And you can see here, for this stock, what is its average volume is usually 200,000, but today it traded almost 1 million shares. So its relative volume is almost 5 times its usual volume. So it's meaningful, something is going on. You're comfortable going in that direction because it's supported by a lot of people, okay? And by a lot of transactions. And again, so you always want to make sure that, you don't want to make sure that there's high volume. It depends the trade that you're taking. But again, look at this, in this situation, again, something that moved up a lot, okay? And let me zoom in a bit. Again, something that moved up a lot. Look, almost no volume on these days. And then here, on the days that it went from 60 cents to $3. So that's something huge. Came up with a lot of volume. And came with a lot of volume, right? And today, again, let's see this one. Okay, so that's hilarious, right? This stock usually does 154,000 shares, but today it did 8.9 million shares, right? So a lot of people are buying. So that's 57 times more volume than it usually does. So if there's a stock going in a certain direction on high volume and you want to go in that direction, that's good. Okay, if you want to go in a direction that something is going at and it's having strong volume, it's good because it needs volume to keep pushing. But if something is going in a direction with no volume, then you might want to go in the opposite direction because it's probably not going to be sustainable and it's not going to stay there for a while. Okay? So think about it, re-listen to this class because honestly, volume is one of the most important metrics to look at, and relative volume, and a lot of people bypass it. And it's honestly extremely an important part of technical analysis, and you should always have an eye out for volume on anything you trade. Okay? So that being said, hope you enjoyed this lecture, and I'll see you guys in the next one. Welcome back, guys. In this lecture, we're going to be talking about Bollinger Bands. Now, what are Bollinger Bands? Bollinger Bands are just one of the multiple indicators that we have access to when we trade stocks. There's a bunch of indicators out there, and an indicator is basically just a tool that we use that's calculated based on the price and the volume of the stock, and that we can use to try and predict where a stock might go. So there's a bunch of different indicators. Again, indicators are used for technical analysis, and technical analysis is the study of charts. So charts have prices and volume. So that's the two things we can use: prices and volume. Okay. So all indicators are built with either price or volume and price. Okay. But that's really what they're built with. And we can build those different indicators to try and gauge, which direction the stock might be going. There's hundreds of different indicators out there. And to be honest, I would say more than 80% of those indicators are useless. Okay, they add no value. So you got to make sure that you're using the right indicators that work best. So in this course, I'm going to be introducing a few of the indicators that we use and that we've seen being more consistent and helping us make the most profits. So we've honestly tried most of the indicators out there, and these are by far the ones that work best. In the advanced course, I'm going to be showing a few more. But yeah, that being said, let's just start. So Bollinger Bands. What are Bollinger Bands? Very simply, a Bollinger Band is a band that's drawn around your chart that tells you that your price should remain within those bands at a certain probability. So it might tell you, hey, it's 95% sure that the stock should not go out of this band. So in that sense, you know that it's very unlikely for it to go up here or down here, right? It will happen, but it's just unlikely. Okay. Now, why would you want to use a Bollinger Band? Well, maybe you want to know when something is way overextended. So if this went down all the way here, well, is that too much? Should it come back now? If it came all the way back here, well, is that too much? Should it come back now? Here, oh, is that too much? So if you can find like a channel, but it's a moving channel with the stock that tells you within which range that stock should be, that's why you would use the Bollinger Band for. So Bollinger Bands, and I'm going to explain the calculations, but you have to understand that different indicators have to be used under different circumstances and for different types of strategies. You cannot take the same indicator and use it across the board, across stocks, across strategies, across events. You have to have a set of an environment, a specific environment that's suitable for that indicator, right? So I know a lot of people that they tell me, hey, I like to use the MACD. So that's one of the indicators. And they just use the MACD all the time on any stock, on any strategy, no matter what's going on. It makes no sense, right? The MACD is going to be good to tell you something specific so you should use it when that something is present, right? So in this case, a Bollinger Band is an indicator that you would want to use when you're running a mean reverting strategy. Now we're talking more about mean reverting strategy in the advanced class, but a mean reverting strategy really quickly is just a strategy when you think that something fluctuates. And so whenever it goes you know, down here, it should come back up again. And then if it goes back up, then it goes back down, back up. So there's always fluctuations. It reverts to the mean. And when you're doing one of those types of strategies, which again, you have to do that strategy on stocks that are good for that strategy, the Bollinger Band will help you because it'll tell you, hey, okay, it's too high now, it should come back down. Hey, it's too high now, it should come back down. Okay, now it's too low, it should come back up. It's too high. So that's a very useful indicator for that type of strategy. And since, you know, most of the stocks just fluctuate like that, this could be very helpful. So let's see how it's calculated. Okay. So first off, you have, let's see here. So if you have a stock fluctuates with time. Okay, sometimes it fluctuates less, sometimes it fluctuates more. You can tell the Bollinger Band. The Bollinger Band has two inputs. Okay, the first inputs is how many days do you want to use. So how many days do you want to use to compute the lines that they're putting. Usually the default is 20. You can change that. And number two is the standard deviation. Default is at 2, but you can change that as well. Now, what is, and again, stick with me, you'll see that it's really not hard. It's quite simple and it makes absolute sense. So before actually I get into this, what is standard deviation if you don't know? Standard deviation is basically a measure for volatility. How volatile is it? Volatility, okay? So why did they use standard deviations? Okay, let's give a simple example, and that's one of the examples that, you know, everybody learns at school. So if I have two classes, okay, and I'm gonna draw a bell curve for probabilities. Again, you're gonna see and you're gonna understand, so don't worry if it looks a bit advanced. Okay, so let's say I have this class, okay? And the average grade in this class, okay, is 80%. And you got 90%. Okay, so let's say here the average is 80 and your grade, let's say G, is 90%. Then I have another class. This is class ABC and class XYZ. So it's the same class, same teacher, but it's just two different groups, okay? So in this class, your grade is 60%. Okay. Now, that being said, or let's actually exaggerate this. Let's say you have, no, not 100. Yeah, let's say let's say you have 80. Let's say you have, let me take this off. Okay. Let's say you have 90%. Okay. If I say there's these two classes, one student here has 90% and one student here has 60%, does that mean that this student is better than this student? That this student is better than this student because he has 90 and he has 60? No. A grade by itself doesn't mean anything. The same as a price of a stock by itself doesn't mean anything, right? What you have to do is compare that grade with the group. So let's say here the group had 80%, yeah, so 80%. And the group here had 50%. Okay. So both of them, so in this situation, the student had 10% better than the average of the group. And in this situation, the person also had 10% better than the average group. Okay. Now, can I say which student is better? Again, no. Why? Because yes, he has 10% better, he has 10% better, but I don't know how volatile the students were, right? I don't know how volatile the students were. Is it all over the place? So do I have students who have 100 and then some students who have 0 and everybody's all over the place? Because if I have a bunch of people who have 100% and 95%, and then a bunch of people who have 40%, and you have 90, well, you don't really stand out. You're not an outlier. But in this situation, imagine if all the students had about 50%. Some had 48, some had 52, but they're all it's very homogeneous. So they're all close together, and you're by yourself above. So you're an outlier. Then yeah, you would be way better. So there's actually something that we call the standard deviation, which calculates, which looks at the dispersion or volatility between the whole sample. So if there's 100 students here, it'll look at all the students and it'll say, okay, well, maybe in this situation, one standard deviation is equal 10%. And when I mean one standard deviation, it means if I put one standard deviation above and below the mean. So if I want to see all the students who got between 70% and 90%, okay, that's one standard deviation above and one standard deviation below. Well, that amount should give me about 65%, okay, of the students. 65% of the students should be between that and that. So if you got 90%, okay, you're good, but you could have done better. You're only one standard deviation above the mean. It's not, you're not that good. Now I can go further and say 2 standard deviation above the mean. So this would be 100% here, and then minus, 60%. So between 60% and 100%, well, in this situation, you're going to have 95% of the students, okay, are going to be in that zone. So 95% of the students are within here. So you're somewhere here, yes, you're better than a lot of the students, you're better than all these guys, but there's still people who are better than you. In the other class, where the mean is 50%, imagine that the standard deviation is actually just 5%. So then between 45 and 55%, okay, you have 65% of the students. And this is just, this is how the calculation works. This is the probabilities of standard deviations. One standard deviation gives you around 65%. 2 standard deviations is about 95%. And then 3 is about 99 point something percent. So almost 100. So very unlikely to happen. Now, if you had 10% more than the group, and one standard deviation is 5%. So it's like you have 2 standard deviation more than the group. So 2 standard deviation is here, 60%, which is your grade, and 40%. Okay, so between this and this, there's 95 or 96% of the students, okay? So when you're looking at this student, he's way better. He's way better than that student, because look at this. He's better than all these students. Like, there's very few students who are better than him, okay? Very few. But him, there's a lot of students that are better than him. So by using, the standard deviation and using this table, we can gauge if a student is being an outlier relative to the mean. And it's the same thing in stocks. I can look at the stock and I can draw a bell curve around the stock and say, you know what? What is the probability that the price of the stock remains within 1 standard deviation? Okay. Or what about 2 standard deviations? Okay. Or 3. So I can be pretty sure that the stock is gonna remain within. Let's say I wanna know the bands for a 2 standard deviation band. Well, I'm gonna draw a band here, which is gonna be 2 standard deviation away from the mean. So basically, I can predict that the stock is gonna be within that range at that time, right? So in the same way, where I can tell if a student is being an outlier, if this is very unlikely, I can predict if the price of a stock would be an outlier if it reaches that price, right? So exact same thing. So the way it's calculated, okay, so the way it's calculated, they use X period of days, so usually it's 20, so the average 20 last days, so they draw a 20 period moving average, okay? And we saw that in one of the other lectures. It's a moving average, so it smooths out the prices here. And then over this moving average, they're gonna draw a upper band and a lower band, okay? And the upper band could be 1 standard deviation above, okay? 2 standard deviations, 3 standard deviations, 4, whatever, however you want. And same thing for this one, -1 standard deviation, -2, -3 standard deviations, you choose. So obviously, if you want to have 1 standard deviation, so you're saying, okay, I wanna be sure that 65% of the time the stock should be within this range. 2 standard deviation, 95. 3 standard deviations, 99. You can say 4 or 5. So it's extremely unlikely that the price goes there. And the higher standard deviations you use, the further or the wider your Bollinger Bands are going to get. Okay. Now, this is why this is so nice, because the standard deviation changes with time. So if at one point here, let's say, the stock started moving a lot, right? Here it wasn't moving and here it moved a lot. Well, the band is actually gonna adjust, okay? The band will adjust with you. So let's see here. Okay, so if this was the band, okay, so prices weren't moving a lot here, okay? So since prices weren't moving a lot, the volatility decreases. And since the volatility decreases, 2 standard deviation here is not that far, okay? So the band will narrow. But then when the stock started moving a lot, well, the standard deviation also became bigger. So 2 standard deviations becomes bigger, right? So you'll see that the Bollinger Band narrows when the stock is not volatile and widens when the stock is volatile. And this is good because then if it's volatile, you know that it's more likely that it reaches one of those levels, and you want to make sure, either you're not on those levels or you want to get a position when it reaches those levels. So in this situation, you see here, the band was not too big, but then when the stock started moving, look at how the band got wider, right? Look, this is how wide the band is. And then when it started, converging again and not moving a lot, you see the band isn't that big. Here, so big. Here, not that big. Okay? So let's check TradingView. And TradingView is super nice to use on the Bollinger Bands. So if I'm looking at a stock, and the stock was just here, let's see. Let's say if I go to Dollarama, let's say, this is a Canadian company. Okay, why not? Let's say I'm looking at this company here, okay? And let me just take this out, okay? So if I'm looking at this company, so we go in indicators, okay? And one of the indicators is Bollinger Band. So I can put BB. A lot of people use that for Bollinger Bands, or I can just write it in Bollinger Bands. And you see they have so many different types of Bollinger Bands, so many types. That's just for Bollinger Bands, right? We use the regular Bollinger Band, and bam, look at this. It drew it already on the chart, right? So what did they use to draw it? Let me double click on it, see the default. Okay, so the default is 20 days and 2 standard deviations. You can change that. You can put whatever you want. And you can see it does go, you'll see that the price hits these bands. And an easy strategy to do, and I don't want to say easy, but a common strategy is you find things that mean revert, or strategies that mean revert. And when the stock hits the upper band, this is an indicator for you to go short, because it's very likely, it's very unlikely that the stock should be there. It shouldn't be there. So it's very likely that it comes back. So you short here when it hits the upper band, and when it comes back to the middle point, you buy it. You cover your position, you take your profit. And when it touches the lower band, you buy it again, sell it. Same thing, buy it again, sell it. Here, buy some, sell it again. Sell, buy, sell, buy, sell, sell, buy. Sell some here, and buy again, buy. So, again, you can't just do it on any random stock. You got to make sure that the stock is a mean reverting stock and whatnot, and the strategy has to be, quite defined. But the Bollinger Bands will be very good for you to predict if, this is a good range and the stock should be there or not, if it's likely or not likely to be there. Now, if you're less risky and you only want to take very good trades that are extremely unlikely to happen, I can say, okay, well, I want to put 3 standard deviations. And look at this, the bands will widen, right? Because they're going to be 3 standard deviations away from the middle point. So if I put 3, bam, you see, they got way wider. So in that situation, you're going to miss some trades, but the trades that you get, you're going to get like this one at a way better price than you would have gotten it usually. And you're going to get this one, and you not here. So, all the trades you got way fewer trades, but they're way better at a way better price. So you can decide how risky or how not risky you want to be. If I put 1 standard deviation, I'm so close. It's just 65% of the time that it's going to be within it. So it's going to get out of that zone too often. So really quickly, that being said about Bollinger Bands, go play with it, see how it works. It's actually, it works across products. So you could use it not only for stocks, but for Forex, for anything that is kind of mean reverting. And again, mean reverting, we'll talk more about that in the next class. But that being said, when you're looking at indicators, okay, look at how many indicators there are. Parabolic SAR, moon phases, Hull moving average, chop zone. Okay, so all these indicators are built with these charts, right? And often you don't even need the indicator you can just look at the chart, right? Just looking at this chart, I can tell when it's too down or too high. I don't need the Bollinger Bands, because the Bollinger Band, it's built by the prices of the chart anyway. So I can just look at that and predict it. It just makes it easier for me. So I don't actually have to put in the work. I'll just see it, okay? Now, there's too many indicators out there that are going to tell you different things. They're not useful for several reasons. One is because if not enough people use that indicator, then you don't want to use it. The thing with stocks is that it's based on supply and demand. Prices will move based on supply and demand. So your objective isn't just to predict, to try and guess where the stock is going, but you want to predict how other people are going to be buying and selling, because ultimately it's their buying decisions and selling decisions that are going to affect the price of the stock, right? It's supply and demand. So how are other people going to trade that stock? So you want to make sure that you're looking at the indicators that other people are looking at, okay? Because again, the objective isn't for you to predict where the stock is going to go. The objective is for you to predict how other people are going to be acting. Are they going to be buying or selling? Because that's what's going to move the stock. So you want to look at indicators that everybody looks at, like the Bollinger Band, which is one of the most popular ones. And you also want to make sure that you're looking at something that makes sense, because you can actually come up with an infinite amount of different indicators that are going to look at different stuff. Do they make sense or not? Unless they make real sense, don't use them. Okay? And also keep the amount of indicators that you use to maximum 5. Don't go over than 5, right? Because at a certain point, if you use too many indicators, you start losing value, where instead of predicting better because you have more things to look at, you predict worst, right? And that's proven in math. There's a maximum number of inputs that you can use to predict something, and if you start using more, your prediction starts becoming worst or less predictive, right? So you don't want to use too much, and make sure that different strategies have their indicators that work well for that strategy. Okay. That being said, if you have questions about the Bollinger Bands, or anything else, just put them down in the comments and I'll be sure to answer them. Other than that, see you guys in the next lecture. Hey guys, welcome back to the complete foundation stock trading course. In this lecture, we're going to be talking about the relative strength indicator, or the RSI. Now, the RSI is another technical indicator that we use that is extremely popular and extremely useful to predict price movement. Now, you might have heard about RSI before, or you might have used it before. Even if you haven't, I'm going to explain exactly what it means and when and why you would want to use it. Okay? So you might have heard a lot of times people saying, hey, this stock is overbought or this stock is oversold. So to figure out if a stock is overbought or oversold, one of the indicators that we can use for that is actually the relative strength indicator. Okay? So how is the relative strength indicator calculated? Because if you look at the chart I have here on the screen, you can see the fluctuations of the chart. And then at the bottom of the screen, you can see your indicator. Okay? And this indicator, again, like all other technical indicators, they are calculated using the prices of the stock, right? So they use these prices to calculate the indicator. Now, the RSI actually is going to be an indicator that fluctuates between 0 and 100, okay? And the actual function for it, let me go here on Google, I'll get this up. Okay, RSI formula. So the actual formula for the RSI is going to be 100 minus 100 divided by 1 plus the relative strength. And the relative strength is just going to be your average gain days divided by your average loss days. Now, you don't need to understand the formula. You need to understand how they come up with this number. And that's what I'm going to explain right now. So when you were looking, and let me actually put this back up here. When you were looking at the average gain and average loss, you're actually looking at the previous days, right? So what they actually do, and let me actually draw it up here. What they're doing is they're taking a stock and they're looking over X number of days, okay? So again, like with all indicators, X can be, 20 days, 100 days, 200 days. Different indicators usually have a default, and most people like to use that default because everybody else is using it. For RSI, most people, and the default is usually 14. So a lot of people use the last 14 days in the RSI. Again, you can change it, you can try other things, but most people use 14 days. Now, when we looked at the function earlier, and it's RSI equals 100 minus, and let's pull it up here just to make sure I got it correct, because at the end of the day, honestly, you don't care about remembering how they calculate something, but you just want to understand the meaning behind it. So let's put it up here. 100 minus 100 divided by 1 plus RS, and where we said RS is going to be your average gain divided by your average loss. So what do we say? What do we mean about average gain? So what we actually mean is we're going to look at our green candles, okay, when the stock is going up, okay, and then we're going to be looking at our red candles, so when the stock is going down. So maybe here it goes down a bit, here it goes down a bit again, and then we have a very big green candle, and let's say we have a bunch of small red candles, and let's say another green candle up to here. So let's say this is 14 days, okay? So what we're gonna be doing, we're gonna actually be taking all the gains, all the green candles, okay? So this one, this one, this one, this one, this one, we have 1, 2, 3, 4, 5, and red we have 1, 2, 3, 4, 5, 6, so 11 days. Let me add 3 more, just like that. So another green one, and let's say 2 other red ones, okay? So we have 14 days, 14 trading days. We're gonna be looking at the average gains. So over these 14 days, we're gonna take all the positive days, all the gaining days, and we're gonna look at what is the average of their move, okay? And then, so let's say the average here is about, X percentage, right? So, it could be 2%, could be 3%. But then we're gonna look at the losing days, and we're gonna see what is the average of the losing days. And here we see that the losing days are always, the average is way smaller than the winning days. You can see that the winning days, the candles are way bigger, right? Okay? That means that buyers were way more aggressive buying the stock. They were impatient. They were willing to buy at a way higher price, okay? So demand was extremely high because you see that the candles are bigger, right? So when you end up computing the RSI, you're gonna get a number that's gonna fluctuate, like we've said, between 100 and 0. The lower the number is, okay, the closer it is to 0, that means the stock has a lot, or actually let me say this, the higher it is, the closer it is to 100, that means the bigger the green candles were compared to the red candles. So if the green candles are very big and the red candles are very small, well, the number is going to be bigger. Okay, we're going to get closer to 100. And that means that the stock is overbought. Okay, so when you have a number that's close to 100, which is the upper band, that means that the stock is overbought. Okay, so in this situation where you see the green candles are way bigger than the red candles, it might tell me, okay, this stock is overbought. A lot of people are buying it. Okay, so it's really up. They're way more aggressive in their buying. If the RSI gives us something that's closer to 0, that would mean that it's oversold. And if it gives us something closer to 0, it would mean that the red candles are way bigger than the green candles, right? Now, general rule of thumb, we usually look at the 70 line and the 30 line. And again, the RSI is going to fluctuate with time, okay? It's sometimes going to go higher as, green candles get bigger. And then as, if red candles get bigger, then it might fall down. So they're going to fluctuate. And the rule of thumb is if it's below 30, it means that it's oversold. And if it's over 70, it's going to be overbought. Okay? Again, when we're saying oversold, that means the red candles were way bigger, so people sold them so much more aggressively that they took a beating. Okay? It's too much. Shouldn't be as down. And when the green candles are way big, means it's overbought. Now, what should you do knowing this? Should you buy something when it's oversold? And the actual answer is no, because something can stay oversold for an extremely long time. Stocks that go all the way to 0 are they were oversold for a long time. And does that mean you should short when it's overbought? No, because also it could just it could stay overbought for a long time. The stock can just keep going up. The way you should do it is this. Once a stock becomes overbought, don't short it yet. But if it stops being overbought, so it became overbought, but then it stopped being overbought, which means what? Which means, you know, the momentum stopped and now there's bigger red candles. That's when you short. You short as it stops being overbought. Okay? And then as it goes down, then you make your money. And if it becomes oversold, you don't buy right away. Okay? You don't buy right away. You wait until it stops being oversold. So you wait as it breaks from below the lower price target. And that's when you buy. Okay? So a little example here. Let's see right here. In this situation, you can see that the stock is going that. Okay, well, actually, let's see here. We're looking at the RSI, 14 period RSI, 14 days. And you can see that the RSI becomes overbought. So we don't short the stock because it's overbought. We're going to wait. But then as it stops being overbought, that's when we short. And you can see it would have given us a good entry here. And would have made some money. Now, the stock drops. And you can see that it became oversold. Now, why did it become oversold? Easy. Look, the red candles became way bigger than the few green candles that there are in this last 14 days. So it became oversold. Now, at one point, the red candles become smaller and the green candles became bigger. And you see red candles became way smaller. So what happened? The RSI stopped being oversold. Okay, so bam, that's when we buy. And again, good entry. Again here, became overbought. And you understand, it became overbought. Why? Because the green candles compared to the red candles are way bigger in these last 14 days. So it became overbought. Again, stopped being overbought and went down. Oversold again, don't buy right away because you don't know. But as it breaks up, that's when you get your entry. So that's the way you should use relative strength indicator. Now, you've realized from this indicator, like the other indicator we talked about in the last lecture, the Bollinger Bands, that you don't actually need this. You can see everything through the chart because all technical indicators are derived from charts. So if you look at the chart close enough, you can see the size of the candles and you can know if it's overbought or oversold. But the indicators are very good because they help you see this more easily, right? So you have to use them. I'm not saying don't use them. I'm just saying understand them, right? Because then when you look at the chart, you're going to understand why it's that. Now, should you use this indicator on anything? And actually, let me pull up. Let's go on TradingView. Okay, what is this stock? Okay, let's like. I don't know what that stock is, but let's try it on that stock. So compare. Let's see. Nope, not compare. Sorry, indicator. We're gonna put relative strength indicator or RSI. Oops, RSI, and here we go. First one. Click on it. Here's the RSI. Let's see if it would have worked. Okay, so we have RSI dropped. And let me just close this a bit. Let me take this here. RSI drops below, breaks over. Okay, so that gives us a buy indicator here. Buy indicator is here, and whoop, perfect. So that's a good buy. Let's see here again. Buy indicator here. Perfect. Okay. Again, nothing here, nothing here, nothing here. Oh, so here it drops, right? So we don't buy it because imagine we bought it here. Look, it kept going down. If we bought it here, as soon as it broke and it became oversold, right? We shouldn't have bought right away, right? Because look, it kept going down. But when do we buy? When it stops being oversold. So here, this is our buy entry. And wow, it's working like a charm on that stock, right? So super nice, okay? And again, here, another drop. So buy entry here. Honestly, all of these buys were good. Not even one losing trade, so super good. And that was a random stock that I looked at. So let's see at this RSI here. I'm gonna double click on it. Okay, so this RSI is actually using a 7 days instead of a 14 days. Is it that right? It should default at 14 days. Let's see. I'm gonna put it again. Insert indicator. RSI, relative strength. Yeah, it's using 7 days. Okay, if we put it at 14, we would have got a trade here. Okay, so a few less good trades. So you might want to play around with, okay, well, I'm not actually looking at the same stock anymore. Which stock were we looking at? Obviously, now we're on Forex, so it's not going to work well with Forex, obviously. But what I want to say is you can play around with different lengths, you know, how many days, but usually people keep it at 14. So you want to stay with what other people are using as well, because again, like we've talked, and I keep drilling that in because it's super important. It's not just what you look at, it's what other people look at that matters, right? The reason you're looking at it, the reason you're trading is you're trying to predict what other people are going to be doing. So you got to look at something that other people look at. So 14 days is super good. And that being said, something that's very important, okay, is what type of stock you're going to use it on, right? You can't use all indicators on all stocks, right? So this type of indicator is going to work extremely well for a specific type of strategy and specific type of stocks. On the one we just saw, and I don't remember which one was that, it was randomly on my chart, but it looked good on that one. Okay, I don't know what company that is, but it depends what type of stock, which indicator you should use, and what type of strategy. So obviously, you're not going to use a overbought or oversold indicator like the RSI on a biotech company, right? That's that might get a new drug patent, or it could get FDA approval at any time, or can go up 50%. You know, if a biotech company is overbought and it stops being overbought, it doesn't really mean anything. These things can move in any type of way at any time. So you're not going to use it on that type of stock. Are you going to use it on a momentum strategy where you think something is going to keep going in a direction? No, you're going to use it on a mean reversion strategy where you think something is coming back. Now, again, mean reversion strategies, momentum strategies, we talked about that in our advanced course. It's more advanced material, but you have to know that all indicators all work under different strategies and different stocks. So make sure that you're going to be using this. And again, this one you should use for mean reverting strategies and value stocks. Now, again, this is a little bit outside of the scope of this course. Check it out in our advanced course if you're interested in that. But just make sure that you don't just use it across the board. Okay? There's too many stocks out there. You got to take your universe of stocks and subset it into many parts, many symbols that work well with different indicators and different strategies. All right. So that being said, this is going to cover the RSI, and I will see you in the next lecture. Hey guys, welcome back to the Complete Foundation Stock Trading course. In this lecture, we're going to be covering another technical indicator. This time, it's going to be the average true range, or the ATR. So, what is the average true range? What is the ATR? It's an indicator that we use and every single professional trader uses out there. Okay, it's not an indicator that's going to help you, predict too much where a stock is going to go, but it is going to help you predict how far it can go. Okay, so this is one of the main reasons we use it, is because if you're trading a stock, okay, and you have your strategy and your strategy tells you, hey, I want to buy, I think this stock is going up or this stock is going down. Well, how much do you think it's going to go up? How much do you think it's going to go down, right? Where do I take my profit? Where do I put my loss? Okay, and again, stop losses, take profits. We're going to talk about that more in other lectures. But how do you decide on that? Well, what you're going to use is this indicator, the ATR. The ATR is going to help you figure out how much a stock moves in a day in dollar value, right? So it's average true range. which actually stands for the average amount that it moves in a day. Okay, so if I'm looking at let's put it up here, let me take this off. So if I am looking at a stock, okay, stock price, let's see here, and the average true range, I believe is done over the past 14 periods, or maybe 20. We'll check it out. Again, all indicators have a default period, but you can play around with them. So the way it's calculated, it's going to be looking at the average range of the last 14 days. So let's say this is a candle, then it gaps up here, and this is another green candle, and then okay, stock might fall down a bit, go up. So then what we do is we actually add all these days up. We check the range of this stock. Okay, this one moved, I don't know, $1 on this day. The next day it gapped up and moved all that. That's $2. This day it went down 50 cents. Okay, so we add all of these up. Okay, we add all of these up. 1 plus 2 plus 50 cents plus all of them. We divide them by the total quantity, and then we get the average. And this is exactly what we call the average true range. So it's going to give us the average amount that a stock moves in a day in dollar value, not in percentage. Okay. And why is that helpful? Because if you're trading a stock that's super expensive or super volatile, well, it might have an ATR of $5. Means it moves about $5 every day. Sometimes it moves 10, sometimes it moves 2 or 3, but on average it's going to be $5. But then if you're trading a not too risky, safe company that has an ATR of, let's say, 20 cents, well, that's different, right? The way you're going to trade this stock is not going to be the same way you're going to trade this stock, right? The amount of shares that you're going to buy in this stock is not going to be the same amount of shares that you're going to buy in this stock. Why? Because this is way more risky, can move way much more. And if you're making money on this one, well, how much should you make, right? Let's say this stock is a $20 stock, and you bought it at 20, and then it goes to 20 and 18 cents, and you want to take your profits off the table. Would you take your profits off the table or no? Probably yes, because on average that stock moves 20 cents a day and it already moved 18 cents. It's very unlikely, or not very unlikely, but not too likely that it's going to go way higher. But if you had bought this stock, and let's say this stock is a $50 stock, and it has an average true range of $5, and you bought it at 50, and now it's trading at $51, and you want to take your profit. Should you take your profit? Maybe not, because it still has way more room to go. This stock moves. $1 isn't too much, right? And where do you take your loss? If it went against you and it's at $49, is that too much? Is that not too much? So as traders, and in any trading firm, when we start trading a stock, somebody might come in and say, hey, I'm trading the stock ABC, it's super nice. I just got in at that price. First thing I ask, and first thing everybody asks, is what's the ATR on that? What's the ATR? Is it $1? Is it $2? How much money can I make on this, Oh, it's already up 50 cents. What's the ATR on it? Oh, $2? Okay, yeah, I'll buy some too. But if you tell me, it's up 50 cents, but the ATR is only 20 cents, well, maybe it's already too much up. So it's not an indicator that you're going to use to know if you should buy or sell, but you're going to be able to know, how much profit should you take on that? How much loss should you take on that? Again, you shouldn't try to make, if you're trying to make, $2 in one day on that stock, well, the probability that this happens is extremely unlikely because this thing moves about 20 cents a day, It'll take you 10 days for a move like that approximately to happen, right? So just so you can decide how much you want to buy, how much you want to sell, we're always going to be looking at that. So if I pull out trading view and I go on indicators and I add ATR or average true range here, first one comes out, ATR, and let's actually double click on it, see what they use. Okay, so they use the 14 days average, so the last 14 days. And look at this, the ATR right now, you can see it. So the ATR fluctuates with time, right? Because sometimes here the stock was more volatile, so the average true range was about over $3. Here it started to slow down, it wasn't moving that much. You see the stock wasn't as volatile as here. So it was about, $2. So you see that there's spikes in moments where the stock moved a lot. You can see that the ATR also increased because the average true range increased. It was more volatile, right, at that time. So you can by looking at the ATR, if you're trading that stock at that time, well, on average it trades about $2 a day, But if you were trading it here, it wasn't moving that much. It was moving about, $1.30 per day. So as of today, if I'm looking at Apple, which is the company Apple, the average true range is about $2. It's a $150 stock. So if you buy it and it moves $2 in a day, that's what it does on average. It's not something big. If I look at another stock, let's say I'm going to put at Sirius XM. Well, I know that this is an extremely stable stock, doesn't move a lot. Okay, this is a scalping stock. People buy and sell bid ask, huge quantities of shares, and we'll talk about that in the advanced course, this type of strategy. But on a stock like this, look, the average true range is 10 cents. It's a $5 stock, moves about 10 cents a day. Okay, before at one point here, it moved on average about 5 cents a day. That's how not volatile it has been, right? So if somebody comes out and tells you, hey, I want to buy the stock, I think it's going to 6, well, really, because this thing moves about 10 cents a day. Okay, or obviously it might have earnings, something could happen, you never know. But if you were trading it, if you bought on a small pullback and now you bought at 520 and it's up to 540, it already made a good move. Okay, but if it was Apple and it only made 40 cents, it's not a good move. So you always want to look at the ATR, know how volatile your stock is, so you're able to place your stop losses and take profits appropriately, which this is something that we're going to be doing in maybe not next lecture, but one of the following ones. All right, so that's going to do it for the ATR. It's our third indicator that we just saw. And that being said, I'm going to see you guys in the next lecture. Hey guys, welcome back to the complete foundation stock trading course. In this chapter, we're going to be talking about risk management and money management. Now, risk management and money management are probably the most important thing that you need to grasp if you want to be successful in trading. Regardless of how good you are at everything else, technical analysis, fundamental, anything else, if you're not good at money management and risk management, you have zero chance of being successful. And the reason for that is, regardless of how much money you make, if you don't control your losses, at one point you're going to lose it, right? So, and that's why a lot of companies, hire full-time risk managers, that their only job is doing risk management and money management. So understand that it is part of your job as a trader to look at that and to be good at it. Okay, so it is the most important thing, because a lot of people want to look only at the gains, and it's fun to look at the gains. It's not fun looking and analyzing your losses, but it's actually the most important thing, right? Whatever you don't feel like doing is probably what you should be doing. So risk management, money management, super important. So that being said, this is how we're going to go through the chapter. First, we're going to talk about expectancy. Then we're going to follow up by talking about what's the difference between gambling and betting. Afterwards, we're going to look at some metrics that we use, like the batting average and the win-loss ratio. Then we'll jump into risk management and end up with money management. Now, that being said, in this lecture, we're going to be going over expectancy. So what is expectancy? And if you guys have done math or probabilities, or if you play poker, you're gonna know what expectancy is. Okay, so this is something that obviously if you haven't, we're gonna go through it now and you're gonna understand it. It's super important to understand whenever you're playing any type of game of probabilities, which is the game of the stock market. So what's the definition of expectancy? The expected value is an anticipated value for a given investment. In statistics and probability analysis, the expected value is calculated by multiplying each of the possible outcomes by the likelihood that each of these outcomes occur, right? And then we sum all of that together. So when you're looking actually at this, and don't be scared about the function here, because it's actually pretty simple. All this is saying is basically the sum, the expected value, okay, of something, okay, is equal to the summation from 1 to infinite. So the sum, adding up everything together of every single x, which is the value, times its every single p, which is its probability of happening. So let's actually do an example so you understand this. Okay. Imagine I offered you a game. Okay, let's play a game. And in this game, I meet you and I give you 2 envelopes. Okay, and I tell you, look, there's one envelope here that has $1. For sure, there's $1 in it. Okay, but there's this other envelope that has $10, but you only have 10%. There's only 10% chance of that envelope having $10, right? So I give you 2 options: envelope 1, envelope A, and envelope B. Envelope A has a 100% chance of having $1 in it, and then envelope B has a 10% chance of having $10 in it. Exactly. So which one would you take? Okay. So throughout this example, pause the video, think about it, and then continue, because honestly, you really need to understand the reasoning behind this. So in this case, which one would you take? Right? You need to have a certain function to be able to calculate, right? Because imagine I tell you, okay, well, you know what? I'm going to switch it up. No, it's not going to be $1 and $10. It's going to be $1 and $20, or maybe $1 and here's $30. Like, at what price do you say, okay, well, I'm going to take A over B or B over A? There has to be a logical price, right? It's just not by how you're feeling. So imagine I had $11. Which one would you choose? Okay, so you can actually use the expectancy function to calculate that. Okay, because you don't know which one is better exactly. Like how much do you gain to make if you play this one, right? Because if you take the B envelope, if you decide to take the B envelope, you're only going to be winning once out of 10 times, right? So if you play this, if we play 10 times and you play, let's say 1, 2, all the way up to 10, you're probably going to lose. You're going to win once probably, and you're going to lose the rest. So on average, you're going to win 10% of the time, once out of the 10 times. But that once is going to be equal to $11. In the other situation, if you play 10 times, you're going to win every single time because it's a 100% chance of winning. But that's only going to add up to $10. So in this case, actually choosing B is better because, here's 11. Because you're probably going to make a bit more in this one, okay? So in every situation, you need to make these calculations when you're offered different games of probabilities, okay? And to do that, we always use the expectancy function. And expectancy function in this situation for A would have been expectancy equals, so every single outcome, so what's the outcomes that are possible? Well, $1. And what's the probability of $1 occurring? 100%, so times 1, equals, your expectancy is to make $1. Now, what is the expectancy for B? Well, the expectancy for B is gonna be, okay, well, you have a chance of making $11 times, what's the probability of that happening? 10%, so 0.1. And then you have another outcome that's possible is that you make $0 that you lose, so plus 0 times the probability of that occurring, which is going to be 90%, 0.9. And how much does that give you? 11 times 0.1, which is 1.1, plus 0 times 0.9, which is 0. So that gives you an expectancy of $1.1. So your expected gains every time you play this game is to make about $1.1. That's why if you play 10 times, you're expected to make $11, right? And the expected gain in the scenario A would be 1. So obviously, if you have a choice, you're going to choose the game that has the highest expectancy possible, right? Because you have to assume that you're not only playing this game once, you're going to be playing it a huge amount of time, right? An almost infinite amount. You're going to keep playing it, keep playing it, keep playing it. So whatever the probabilities say are going to materialize over time. Yes, you might play B and you might lose all 10 times and make 0 in the first 10 times. But then in the next 10 times, you might make 2 gains. So it's going to average out to the actual probabilities. So in this situation, imagine I had changed the game again. And instead of having $11 here, we only had $9. So then in this case, which one would you choose? Well, the expectancy for the first one is the same. The expectancy for the second one now changed, right? The expectancy for the second one changed. And the expectancy for the second one would be now, well, outcome would be 9, probability 0.1, so 10%, times making $0, and the probability of that occurring is still 90%. So that makes you 0.9 plus 0, so 90 cents. So now your expectancy for B dropped to 90 cents. In this case, which one would you take? You would take A, the envelope A, because that would make you, every time you play, it would make you about $1, which is exactly what it would make you. If you play B, every time you play, it's like if you made 90 cents. And yes, there's no option of making 90 cents, but you either lose and make $9 once every 10 times. So it's like if you made 90 cents every time you played, right? So that's the way you have to view it. Now, if I had $10 here, okay, then what do you do? If I had $10, because now that's where it gets tricky. If I had $10 in the second envelope, and then you had the choice, $1 here, which has an expectancy of 1, or $10, but 10% chance of that $10 actually being there. Well, that would be 10 times 0.1, which is the 10%, plus getting $0 times the probability of that happening, which is 90%, and that would give you, that would give you 10.01, that gives you $1, plus 0.90, that gives you 0, so expectancy of 1. So what you see here is that both situations give you the same expectancy. You expect to make about $1 every time you play while playing these games. So which one would you choose? The answer is B, right? And why? Because if you have a situation where you can make the same amount of money, you choose the one that's less risky, that's less volatile. If I can make $1 every single time here, why would I choose this that's going to average me to about $1 for every time I play? But there's more volatility in how I make my money, because in scenario A, I would make, every time I would play, I would make, $1, right? So if I play 5 times, I'm going to be making $5. If I play 10 times, I'll make $10. But in scenario B, well, it depends. Maybe I play 12 times and then I win once and I go to 10. And then maybe I play, maybe I play just a bunch of time and then I win a lot. So it's gonna be more volatile. Okay? They're gonna end up at one point converging with each other, right? Because in probabilities, when you play a big amount of time, long enough, the probabilities are going to converge with one another, which is the expectancy is 1. So, you know, if you're playing a million times, both this one is going to be exactly a million and this one is going to be very close to a million. So they are going to converge, they might converge differently. This one might be higher, but in the end, they're gonna converge. So why choose the volatile one when you can have the safe one, right? So why would I be talking about expectancy if we're looking to trade stocks? Because in any type of game that has to do with probability, you have to play with the numbers that work, right? You're not going to go against the numbers, because if you go against the numbers, yes, you might be right once or twice or a few times, but in the long run, you're gonna lose. Okay, so you want to have the numbers on your side, and this is something you can ask anybody who's in any field that has to do with this. If you want to be successful at it, you gotta be systematic in your approach, where you find something that works and then you just keep repeating it and keep adding revenue that way, right? So if I am looking at a stock, okay, let's say I give you 2 stocks, stock ABC and stock ABC actually. So imagine this. Imagine you're looking at both stocks. You have company ABC and you have company XYZ. Okay, and you've done your research and you think that company ABC has, and let's say company ABC is trading at $20. Okay, let's say you think it has a 60% chance of going up. So 60%, so 0.6 of going up, and if it goes up, it's going to go all the way up to $23. And you also think that it has a 40% chance of going down, so 0.4. But if it goes down, it's going to go down to $13. Okay. Now, when I say you think it has probability of going up and then probability of going down, there's always probability of a stock going up and then going down. You're never sure which way it's gonna go, but you can be more confident in one direction to another. So when you're buying a stock, you're never certain that it's going up. Nothing is certain, right? But you can say, oh, well, I think it's going up with a very high probability, which is good enough to be successful. So if you're looking at then XYZ, and XYZ is trading at $10, XYZ, on the other hand, you only think it has 40% chance of going up compared to the 60. But if it goes up, it's going to go up all the way to $16. And on the other hand, you think it has a 60% chance of going down. So very high chance of going down. But if it goes down, it's going to go to $8. Now, which company would you buy? You have these 2 options. You're pretty sure of these probabilities and these numbers. Which one would you choose? Which one would be best? So pause the video and do this exercise, because this is super important. And as soon as you come back, tell me which one you want to do. Okay, so you're going to have to use the formula that we just looked at, right? The expectancy. So the expectancy for ABC is going to be what? Well, the amount of money you made, so the value times the probability of that occurring, right? So making $3, but the probability of that occurring is 60%. 40% times the value that would happen. Now, one thing that is super important and a lot of people make mistakes with is when they do expectancy on stock prices, they do it on the dollar value, which is not the right way to do it. And the reason for that is because if you have 2 different stocks that have 2 different prices, well, you can't say like, okay, well, this stock is going to go up $3. And since it's going up $3, I want to buy this one because this one can go up $6, or because this one is only $10, right? So you gotta compare the price of the stock as well, because if you have a stock that's twice as cheaper, well, guess what? The stock that's twice as cheaper doesn't need to go up as much as the stock that's twice more expensive because you can buy way more in the cheaper one. So even if it goes up by a smaller amount, you'll be making the same amount of money, right? Again, if you have a $10 stock that goes from $10 or $100 stock that goes from $100 to $105, okay, that's a 5% return. But if you had a $1 stock that goes up to $1.20, well, that's a 20% return. So, you know, yeah, this one only went up 20 cents. This one but this one went up $5. But still, the 20 cents is a bigger, percentage return than that $5. So what you actually want to do is look at percentages, okay? Whenever you're working with stocks, always look at percentage, never just at prices. And that has to do with most of the calculations that you're going to do on anything, honestly. So let's get to it. So what would the expectancy be? Well, the value, what is the value? $3 over 20, that would be 3 divided by 20 would be 15%. Okay, so there 15% gain. If it goes from if it goes from $20 to $13, that means it's going down $7. $7 over 20, so 7 divided by 20 should be 35%, 35. 15 or 45%. Here, 45%, yeah. 45%. So when you're looking at it number-wise, here you have a chance of losing 45%. Okay? So when I'm calculating this, my values are what? Okay, I can make 15%, so 0.15. And what's the probability that happens? Well, it's 60%, so times 0.6. Plus, I could lose 45%, so minus 0.45 times the probability of that happening, which is 0.4%, 40%, right? So 0.4. So what is my expectancy? Okay, so this one first. So 0.15 times 0.6, which is going to be 30, 60, 90, 0.9. Plus, then you have a minus, so that becomes a minus here. And then you have 0.4 times 0.40. Let me see here. Did I did this correctly? 0.09. This is 0.09. Sorry, 0.9. 0.9. Here, let me rewrite this. 0.09. Okay, so it's 9%. Okay, 9%, not 90. Minus, you have 0.45 times 0.4, so that's going to give you a 0.18, so that should be 0.18. Okay, so when you add that together, it gives you minus 9%. Yeah. So your expectancy is 0.09 minus 0.18, which is gives you minus 0.09, which is minus 9%. So your expectancy is actually negative, okay? So which is super bad, okay? Here, let's keep it on here. So that's your expectancy. Now, you have to calculate your expectancy for your second option. And the expectancy for the second option, okay, well, if it goes from $10 to 16, well, that's a 60% gain, which is huge. If it goes down from 10 to 8, well, that's a 20% drop, right? $2 over $10, you're losing 20%. So what's the expectancy? Okay, well, making 60%, so 0.6 times the probability of that occurring, which is 0.4, plus what can happen? Losing 20%, so minus 0.2 times the probability of that occurring, which is 0.6. Now, how much would that add up to? So 0.6, 12, 24, okay, 0.24, okay. Plus, minus, so then that becomes a minus, sorry. 0.2 times 0.6, so 12 minus 0.12, 0.12. Okay, so then that gives us 0.24 minus 0.12 gives us 0.12, which is 12%. Okay, so in this situation, this is what you have. You have an expectancy of making 12% if you buy this stock, and an expectancy of losing 9% if you pick this stock, right? So obviously you gotta choose XYZ. So even though XYZ had only a 40% chance of going up compared to ABC, which has a 60% chance of going up, when it goes up, you don't make as much money, you only make 15%. But when this one goes up, you make 60%, so it's a lot. And this one, when you lose, even though you don't lose as often as this one, when you lose way bigger, so you lose 45%. This one, you only lose 20. So this one is actually the better one. So that's why you have to make those calculations, because if you don't, you might be overlooking the price and the probability. So very important to have this mentality, this way of thinking. And when you have options, to take the one that has the highest expectancy. Because this one, if you keep playing it, every time you play, it's like you make 12%. Yes, you're going to make 60, and then sometimes you're going to lose 20, you're going to lose 20, you're going to lose 20, then you make another 60. But when you add them all together, on average, it's like if you made 12% every time you played. This one, you lost about 9% every time you play. So even if this option didn't exist, even if this wasn't here, okay, even if this didn't exist, and you had only this stock that you could buy, you shouldn't buy it, because it has a negative expectancy, so you're actually losing. If you keep buying stocks like this that have negative expectancies, you're only going to be losing money. So even if you have no options and that was the only options you had, you don't take it because it's bad. So you only want to have something with positive expectancy, and if you have many of them simultaneously, you choose the one that has the highest, okay? Now, obviously, in this situation, how would you have known that the stock has a 60% of going up, and if it went up, that it would have went up by 15%? These are things that we're going to talk about later, and in our more advanced course, we're talking about based on the strategies that you're doing, you can calculate certain probabilities, and then when you trade, you keep a track record of your historical trades, and then see historically, you specifically, what are your probabilities of gain and how much on different strategies. And based on that, you can really calculate approximately how much your expectancy is. Okay. So that being said, that really covers expectancy. I hope, I really drilled it in because this is the mindset that you need to have when you're trading. Okay. You got to just keep attacking things that have profitable expectancies, and it adds up. So that being said, this is going to cover this lecture, and I'll see you guys in the next one. Hey guys, welcome back. And in this lecture, we're going to be talking about gambling versus educated betting. So I made sure to make a full lecture about this topic because I honestly feel that if you don't understand the probabilities and how trading actually works, you will not succeed in this business. Okay, you have to really understand what it is a trader does to be able to do it. Because if you don't know what you're getting into, you're not going to be able to do the right thing when the time comes. So what is betting and what is gambling, anyways? So the definition for gambling is going to be to play games of chance for money. So the act of gambling money on the outcome of an unpredictable event. Okay, so it's an unpredictable event, and what you have to understand or realize by this is that you might think it's predictable, but it's not, or you might not know that you're gambling, but you're actually gambling. So a lot of people gamble without knowing that they're gambling. They think they're doing something else. So betting, on the other hand, or educated betting, is the act of gambling money, and note I still use the word gambling, on the outcome of an event that you perceive has a positive expected value. And if you remember from last course, we talked about about expected value. Okay, so in the last lecture, we did a full lecture on that. If you didn't see it, go back and see it. You only want to take bets that have a positive expectancy. So if it has a positive expectancy, you should take that bet and you should repeat it as much as you can, because you're going to be generating money by doing so. So if you perceive that something has a positive expectancy, you should take that trade or bet, because it is going to get you money. Now, even though it will make you money in the long run, the reason why I put it in there, the act of gambling money, is because there is still always a chance that you lose. Even if your chance of winning is 70%, well, yes, your odds are good. You should keep playing that as much as you can, but 30 times out of 100 you are going to lose. So you have to know that, right? And you have to account for that, because it is going to happen. And that's where it's going to come to when we talk more about risk management and how much we should buy or sell, considering the probabilities of loss. So that being said, what makes something a gamble and what makes it a bet? A lot of people think it's the product. So some people will tell you, hey, stock market is gambling and poker is gambling, real estate is investment. No, not necessarily. If you go and buy a house, but you didn't do your research, you didn't check the house if it's good material, the neighborhood, if there's new projects around, the whole market, the interest rates, if you haven't checked everything, you just bought it, well, guess what? That's a gamble. Because any type of product that's price can fluctuate can potentially be a gamble if you're not informed. So anything can be a gamble, and anything can be a bet, right? So it's not the product that makes it a gamble or not, but the way you go about making that investment or trade or whatever. Okay, so somebody else could be going to the stock market and he's super smart. He has a super good strategy. It has positive expectancy. He keeps repeating it. He's doing educated bets. Somebody else could be playing poker and he studies, he knows every single probability. He studies the players he's going against. He knows how to play his hand, everything. He's doing educated betting. Yes, he's going to lose sometimes, but in the long run, he's going to make money. So really understand that some people gamble in the stock market, like in anything else, but others don't, right? So you got to make sure that what you're doing is educated betting, where you're getting something that has a positive expectancy and you're just repeating. Now let me ask you this. When you go to the casino to gamble money, you don't have positive expectancy. You're not gonna make money if you go in the long run, right? You might make a few times, some people make sometimes, but if you keep going, you're gonna lose. Now let me ask you this. The casino itself, is the casino gambling? Absolutely not. The casino isn't gambling. The casino is making very calculated and educated bets. Non-stop, all the time. You, on the other hand, you're not doing educated bets when you're going to the casino. So let me actually show you. Let's put it on paper, okay? So if you go to the casino and you go to play roulette, and I might have this a bit wrong because I don't go too often. Actually, I never go because I know the numbers are against me. So why should I? So if you have a game like the roulette where there's a bunch of holes around the circle and somebody throws in a ball, and if it falls in your number or your color, you win, and it has something like maybe 16 or 18, I'm not sure, let's say 16, maybe probably 16, I don't know, 16 red spots, no, it should be 18 red holes, and then there's 18 black ones. Okay? And then, as a player, one of the games you can play is bet on a color. So you can either bet on red or black. Okay, and there is more to the game, but whatever. Red or black. Now, if you bet on red, okay, and you win, you double your money. If it doesn't come on red, so if you lose your money. So it's either you win, you double your money, or you lose all of it. Now, there's a little thing in the game. They actually added another one or two holes. It depends. You're playing American or European. So there's two white holes, and if the ball falls in these holes, you also don't win. Okay, so there's two extra ones here where you don't actually win. So what is your probability of winning? You know, if you're going to bet on red, let's say, what is going to be your probability of winning? Well, you have 18 chances of winning out of a total of 38, right? So it's not 50-50. You're not winning 50% of the time. You're winning less than 50% of the time. So you're actually winning something about like 40, 48, 47%. Maybe less. Now, let's see here. I don't want to calculate it. So you're winning less than 50% of the time. So it's not a good game to play. So if you calculate the expectancy, the expected value, which we talked about in the last lecture again, you realize that your expected value, okay, so you know the probability, the amount that you would win, okay, times the probability that you would win, okay, plus all the expected value, which is going to be 0, 0. So if you do your expectancy, you're going to see that your expected value in this game is about minus 2.7%. What does that mean? What it means is actually that every time you play, it's like you're losing 2.7% of the amount that you're playing. Yes, sometimes you're going to double it, sometimes you're going to lose all of it, but on average, if every time you're playing $100, it's like if you're losing $2.70 every time you play. So by the 10th time, you would have lost $27. By the 100th time, you would have lost about $2.70 if you kept just betting on red every time. Okay, so if you went to the casino and you played, you just kept betting on red all the time. On average, every time you bet, it's like you lose 2.7% of your money. So if you're playing $100 every time, that's $2.7 every time on average, right? So even though you might win a few times in the beginning and lose after, it's going to average to that. So it's going to come out to, if you play 100 times, you would be down 270. So it keeps adding up. Now, what I want to get to is that it has a negative expectancy, so you should not play this game at all. The casino, on the other hand, the casino has a positive expectancy of 2.7%. So yes, you're losing money, you have a negative expectancy, but the casino has a positive expectancy. So you can see here that the casino isn't gambling. The casino is doing educated betting. Even though, yes, sometimes he loses, and sometimes, somebody's going to make a lot of money in the casino still makes way more, right? So it's the same thing as trading. The casino has a plan, strategy that works, where he makes a bit more than when he loses, and he keeps repeating it non-stop, and it adds up, right? So you're losing. He's making 2.7% on the amount you bet, but you're not the only person. There's a bunch of other people on your table, and you're not just playing this hand. You're playing more and more and more. It's open 24/7, and it's not just your table. There's hundreds of tables. So imagine how much that adds and how it amounts to. So on a very small expectancy of 2.7, which is not huge, the casino makes huge amounts of money. So understand that when you trade and you have an opportunity to have strategies that have way higher expectancies than that, you have very good opportunities to make money. The thing is, you have to understand that it is educated betting, and part of this game is that you do take losses, like the casino, right? Sometimes people are going to win. He's not going to shut down and say, I'm not going to run this model anymore. It works. Yes, they're going to win, but I'm going to win more. So it's very important to understand this. Why? Because you're going to have to do proper risk management and money management. So how many shares do you want to buy? How much stocks? Considering the fact that you will lose sometimes, and these are the amounts that you could lose, right? You have to factor that in. That way, when you're doing your position sizing, your risk management, which we're going to talk about in the next lectures, you know that you're going to be safe even when those losses occur, right? So, and really, another difference between the stock market and I guess the casino is when you go to the casino, you can go and play against the casino. Everybody can go and play against the casino, right? They can't just play against themselves. They have to. The casino is involved in a way, right? And the casino is the one who made this game, and the casino made sure that the game benefits them and doesn't benefit you, right? So it's a losing battle going to the casino. There's no way of winning. But when you go to the stock market, you're not playing against one party. You're not playing against the exchange. You're playing against other participants. Everybody, when you go to, let me take this off. When you go, when you trade in the stock market, you're playing against everybody else. And it's a zero-sum game, which means that for every dollar that you make, somebody else lost it. And for every dollar that you lost, somebody else made it. So everybody's there in the stock market, buying and selling against each other, right? Okay? So anybody can trade with anybody, right? Now the nice thing about this is you can actually make your own game, right? When you go to the stock market, you can come and say, hey, you know what? I have this very solid strategy, okay, that where I make money 65% of the time, okay, and when I make more than I lose, and I have a very positive expectancy, and it's working very well, and it's consistent, and I can do it every day, okay, so it works. So I have this strategy here, this game, and I'm gonna sit here, okay, I have a positive expectancy, and if somebody wants to come play with me, want to play this game, for sure, come, I'll trade with you. When indicators are good for me to buy, I'll buy from whoever is selling because I have a positive expectancy. You know, if somebody's selling something, if somebody's buying something super high, and my strategy says I should short there, well, good, I'll short there, and if it goes down, I'll make my money. So I can just sit there and act as a casino. Let other people come play with me, but I'm not gonna wander out there and go play with somebody else on a strategy that I don't know how it works and what is its expectancies or whatnot. I'm gonna build my table and I'm gonna keep generating revenues just like the casino does, okay? And as I get better, I'm gonna have another strategy, and if other people want to come play on this one, sure, come for it. I know long term I'm making money on them, and you just keep adding strategies. So for example, in here, when everybody starts trading, everybody gets a simple strategy that they start, but then with time, as they make money here, they build another strategy, and then they build another strategy, and it makes them even more and more money, because the more you have, even just like a casino, even if on one day one doesn't work well, you have two others that might be working very well, right? And again, in the advanced course, we actually give you exactly 3 strategies to start off with that we do here in the office, because those strategies, again, they're stable, and when one of them works, when one of them doesn't work, the other strategies are negatively correlated, so they actually work. So then you could have different strategies that are beneficial as a group, okay? And it comes out to the same thing as saying, if you had to open 2 stores and you had an ice cream store, well, maybe the next store should be an umbrella store, because if it's raining and nobody's buying ice cream, well, they might go to your umbrella store and get umbrellas. So one of your stores is always going to be making money, right? So that's the same type of thing you want to do with your strategies. You get in the market, build your own things, have other people come play against you, and then slowly rack up the money. So hope that made sense to you. If not, just rewatch the video and think about it. It takes a lot of reflection to grasp these concepts. So just think about it, and it'll make more sense to you. And if you really grasp those concepts, that's when you're going to be able to really succeed in this business. Okay? So that being said, that's going to do it for this lecture, and I'll see you guys in the next one.
Hey guys, this is just another reminder that if you want to follow us on social media, the social media links that you've been seeing through the course are not valid anymore, as I have started a new company called Bloom Trading in place of MTG. So if you want to follow us, make sure to follow us on the new social media handles, which I'll put on this side. If you want to follow me personally, it's on this side. Just pause the video, look at them, and follow us on those social media handles.
Welcome back, everyone. In this lecture, we're going to be talking about batting average and win-loss ratio. Now, what is the batting average and what is exactly the win-loss ratio? Both of these are actually metrics that we use to gauge performance, okay? So when you're trading, as when you're doing everything else, any high-performance sport, poker, whatever it is, there's some metrics that people look at. You know, if you play basketball, they're going to look at the average percentage of your shots, or if you're playing baseball, the average hits that you get. If you're playing any type of sports, okay, they have averages, percentage of the possession of the ball that you had. There's a bunch of different metrics that they use to gauge performance, to compare performance against other players and against yourself at different periods of time. And if you're a basketball player and you always miss your free throws, you know, you only get half of them, then you know that you should focus more on that and work on that to improve on it. So, regardless if you're trading, if you're playing poker, basketball, soccer, whatever it is, there's some. And for each different thing, there's different metrics that you look at. But for each of them, there's going to be these metrics that you need to keep track of for yourself to be able to improve on what you're not doing well on and to leverage what you're doing well on, right? And to know why you're doing well on that. So the ones we're going to look at today, and these are the ones we cover for, you know, our introductory course, batting average and win-loss. There's some more advanced ones that we cover in other courses, like the Sharpe ratio and so on. But these ones are two of the most important ones, okay? First is the batting average. Batting average is what? Is the average probability that a trader is right, okay? How do you calculate that? It's the number of profitable trades divided by the total number of trades in that same period. So batting average, imagine this, it's just like in baseball. The amount of balls that you're able to hit out of all the balls that were thrown at you. So that would be the batting average. How many of the stocks or of the trades that I made money on out of all the trades, okay? So if I made 100 trades and I made money on 80 of those trades, that's 80% batting average. So by looking at that, you can know right away what's the percentage that you're right. Okay. Then there's also the win-loss ratio that we want to look at. Win-loss ratio is going to be the ratio of the average of your profitable trades divided by the average of your losing trades. So if on average, every time you make money, you make 10%, that's your average. But every time you lose, you're losing about 5%. That's your average when you lose. Well, then 10 divided by 5 is going to give you 2. So your win-loss ratio is going to be 2, meaning that you usually win about twice as much as when you lose. So by looking at both of these, you're able to know, and actually, let's actually do an example right now. Okay, so let's say you've been trading this strategy for 10 days, okay? Day 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. 10 days you've been trading a strategy, and every day you made or lost, you know, and let me actually, I put this way too high. So you either made or lost money on each day, right? You're doing an intraday strategy where you're buying a stock and by the end of the day, you're out of it already. So let's say on the first day, you're able to make, and let me just change it up. You made 5%. On the next day, you bought another stock and on that trade, you lost 4%. Day after that, you made 8%. The fourth day, let's say you lost 6%. And then the day after that, made 4% again. Then made 5%. Then lost 7%. Then 4%. Oops, sorry. Then minus 2% and 1%. Okay, so after these 10 days, what you have to do is you have to look at your historical results. You have to do it. If you don't do it, you're never going to make it. You have to look at your historical results and see, how am I doing? Am I doing good or no? Because if I'm not doing good, I'll change strategies. I'll find the strategy that works. If I'm not doing good on, some of the symbols, some of the stocks, maybe I'm not doing good on the stocks that are in finance or are in healthcare. Maybe I shouldn't do those, right? You got to look at your losses and see why you lost and your gains and why you gained. So one of the things we want to look at right off the bat, okay? Right off the bat, what you're going to have to do is you're going to have to compute some metrics, okay? First of all, you're going to have to add all of these up. See what's your total return, right? So you want to get your total return. And these are some basic ones that we're not even at the batting average and the win-loss ratio yet, but total return is a no-brainer. You have to calculate that. So that would just be the total. So let me grab my calculator here. So 5 minus 4 plus 8 minus 6 plus 4 plus 5 minus 7 plus 4 minus 2 plus 1. So your total return is 8%. Okay, great. Now you need to calculate something else. You want to calculate your average return. Okay, and average return is going to be what? It's going to be all of your returns, okay, divided by the total, okay? So how do you calculate that? Well, easy. 5, so you add all of these together divided by the total. So we know that the total return is 8%. Okay, so you add all of them together, gives you 8%, divided by the amount of trades, so that was 10, divided by 10. So your average return is about 0.8%, right? So you make about 0.8% return per trade. Super good, right? Because if that's your average, all you have to do is just keep doing trades, and it adds up. So, if you make 10 trades, you're going to make about 8%. If you make 100 trades, you'll make about 80%. So that's very good. Now, whenever you're going to, let's say you've been doing good, okay? You've been making some money, and you want to start trading big. You want to get a lot of money. You want to trade a lot of cash, okay? So you want to go and see some prop shops or some trading companies, show them your results and tell them, hey, look, I'm good. Can you guys give me some funds to trade and, keep a percentage? Because this is something we do. We have traders that come, they're good. We give them cash, they trade it. They keep part of it, we keep part of it, everybody's happy, right? It's not, finding capital isn't hard when you're good. We're in North America, there's a bunch of capital everywhere. Finding talent is the hard part. So if you're doing good, you can go see a firm and ask for capital. But the firm is going to ask for your results. And they're going to look at some specific metrics. And you're going to have to provide those metrics. If you don't, sometimes I get guys here who want to trade and they tell me, I've did good returns. And I tell them, what's your batting average? What's your win-loss ratio? And they're like, I don't know. Well, if you don't even know that, then I'm not going to take you. So these are things you have to know and you have to be able to explain why these are that. So batting average, let's calculate that. Actually, let's change colors a bit. Purple isn't the best. So we have this one that was green. So again, what is the batting average? The number of profitable trades divided by all the trades. The number, right? So here 1 positive, 2 positive, 3 positive, 4 positive, 5 positive, 6 positive. So I have 6 positive trades. Batting average is going to be equal to 6 divided by how many? Oh, I have 10. So 6 divided by 10 gives me 60%. So I'm 60% right, okay? And how good is 60%? It's actually pretty good. So, and I'll get back to what's a good number here. Now, the second thing I want to compute is my average, my win-loss ratio. So to calculate win-loss ratio, you need two things. Your average winners and your average losers, okay? Average winners. So here are my average, here are my winners, right? I have one of them is 5%. So the first one is 5%. So let's go here. We're going to go 5 plus the second one is 8%. Plus the third one is 4%. Plus we got 5%. Plus another 4 and another 1. So we have 27%. That's the total winners divided by how many winners do we have? 6, right? So 27 divided by 6 is 4.5. So when I win, usually I'm winning around 4.5%. Now what is my average losers? Well, okay, let me do that in red. Maybe it's going to be a better color. I have 1 here, 2, 3, and 4. So I got 4%, and I don't need to put the minus because they're all minuses. So 4%, and there's a 6%. Or you know what? For some, let's put the minuses on and then we'll remove it after. It'll make easier sense for you guys. So 4% loss, 6% loss. Then I have a 7% loss and a 2% loss. Okay. So how much is that? Here's 10, 17, 19. Okay. So minus 19 divided by how much? By 4. So I have minus 19 divided by 4, which gives me, let's do that here. 19 divided by 4 gives 4 minus 4.75. So when I'm losing money, I'm losing about 4.75%. Okay? These are all percentages here and here too. So I'm losing about 4.75% when I lose. The nice thing though is I win way more than when I lose. It's not a 50-50, so I'm winning more. So when I'm looking at this, and then so now I already computed the batting average. Now the win-loss ratio is going to be the average win, right? So 4.5%, which means 0.045. That's 4.5%, divided by minus 475. We don't put the minus, we just put the absolute value. So 0.0475. And this gives us, here we go, let's see, clear. Okay. Yeah, so 4.5 divided by 4.75, that gives us 0.95. Okay, so that's how much it gives us, 0.95. So when I'm looking at these two metrics, I can gauge, okay, I can come here and say, hey, okay, look, I win 60% of the time, and when I win about 0.95 as much as when I lose. So my batting average is great. That's a good percentage. I can predict which direction it goes pretty accurately, so 60% of the time. But my win-loss isn't as good because I'm making less than 1. Like if it was 1, if my win-loss was 1, it means that when I win as much as when I lose. But here, when I win, I only make 95% of what I would lose when I lose, right? So it's not that good, right? If your win-loss was, 1.5, then I'd be like, okay, well, that's cool because you win 50% more when you on your winners than on your loser, right? So if you're losing about 5% per trade, well, if your win loss is 1.5, then you'll be making 7.5 when you're winning, right? So obviously you want both of these to be as high as possible, but you want to see where you're struggling. If you're struggling on a win-loss ratio, then you know that your winners, either you're not riding them, you're not letting them make a bigger move, okay? So you need to be more patient with your winners, or maybe that it's your losers that are too big, and then you need to learn how to cut your losers better, right? So the really nice thing about this is you're going to be able to see where you're wrong. You know, if you go on this, then you have to go and see, well, okay, which one is it? Why is this low? Is it because my winners are very small? You know, here you have a 1% winner. You have a few 4. Or is it because my losers are too big? You did have, you know, a 7 and a 6%. That has an impact. So that's going to be something that's going to lead you to improve on yourself. And then if you do want to get funds and trade for somebody, if you don't have these metrics, they're not going to take you. You have to calculate this before you see anybody for anything. And seriously, if you don't need to have super good numbers, you just have to have consistent numbers. Let me pull out results for one of our most recent traders. So let's go here, TG. So one of our most recent traders here, he started January 1st. And let's see here. So this should be, let's see. Here we go. Okay, so if I'm going on, let's say, Tiwi, so he started in January, okay? So let's take a look at his results. We're gonna go in trade performance. Okay, trade performance. Let's go January 1st. So he started. Tiwi is actually he's doing great now. He started January 1st. Had never traded before. We actually hired him through one of the courses that we give here in house, and this is his results, his trade performance for the first month. So on his first month, and you can see here's the wins, here's the losses, and here's the total. So he had 51 winning trades, okay? And he realized about $2,300. He held them on average for about a day. Now, losing trades, he had 29 losing trades. So in total, okay, if we go to the total, he made $1,500 on his first month, which I'm super happy about. Because honestly, the first month you're just learning. So you need to understand that in the beginning you learn. Anything where you can make a lot of money, you don't make a lot of money right away. You gotta learn, right? So first month he made $1,500 gross. Fees were $100. So he netted $1,400. Now, what is his batting average and win-loss ratio? Look at this. Batting average. He was right 63.75% of the time, which is great. And his win-loss ratio was 1.47. So I know that when he wins more than when he loses. And then look, we actually have some calculations on long trades and short trades. So he can see if he's, here I see that his long trades he's doing better on than his short trades. And we can actually see that he makes way more money in the morning and in the afternoon than in the evening. So either he should slow down on this or, capitalize and trade more on those periods of the day. So that's why it's really important to look at your statistics and see what you can improve on. Now that was his first month. So if we go to February, and let's go February, if I generate the report, February, he started trading more, right? So on February, I gave him more capital because it's good returns, right? So I gave him more capital. He did exactly the same thing. And look at this. Well, he made more. His fees were more expensive, but he, instead of netting 1,400, now he netted 4,000 on his second month. So very good improvement. Batting average still around the same. And so the next month, third month, March. So he did even better, right? Because I gave him more capital again. So that month, he grossed even more. So he started trading way more. So he had 199 winning trades, 108 losing trades. So in the end, he made 8,700 gross, 1,500 fees. So there were a lot of fees that month, but netted 7,000. And again, his batting average 64%, almost 65, so consistent around there. His win loss is way lower on that month though, because he had a very big loss on one of the trades. But again, it doesn't matter because it's the combination of both of them. And I know that this is low because of one outlier and it's not all his statistics. So I know that. But you're going to have to be able to explain your numbers if you do want to get funding one day, right? So extremely important. So because sometimes, yeah, the ratios will not look good, but there's actually a logical explanation behind them. So in that way, in that sense, it's okay. So the reason why I'm showing you this is because you might, some people are gonna tell you online, hey, I'm right 80% of the time, 90% of the time. This strategy is amazing. It works 90% of the time. Bullshit. There's almost nothing that has 90% batting average. Like, I've been in this business for 9 years now. I hire people that I give hundreds and millions of dollars to people to trade our money, right? And none of them get anything close to that. So when somebody's on the beach telling you, hey, I make 80% of my trades are good with this system, full of bullshit, okay? If you can make 65% batting average, that's gold. You're amazing. You're going to make a shitload of money. So again, that's within 3 months. And then I'm giving him more and more capital. That's 3 months ago, and he's doing even better and better and better. So if you want to get funding, don't try and hit the moon. Don't try and be right 100% of the time, because if you try and do that, you're not going to trade well. You're not going to take your losses when it's not going your way. You're going to be stubborn because you want to get that 80 or 90% batting average. And then what's going to happen? You're going to lose all of it. So you got to play smart, okay? And again, when I tell you the casino only wins 52% of the time, and they make hundreds of millions. So if you're able to make 64, 65, that's great, okay? You don't need to over, and it's extremely hard to get over that. So, but again, that's sufficient to make good money. You don't need more than that, okay? So, very important metrics. Make sure to calculate that. Put your trades in an Excel sheet and just calculate them. It's not that hard to do. Honestly, there's also other metrics that you want to look at. You have to look at the Sharpe ratio and Sortino ratio, which again we cover in a more advanced class. Or you can look it up. But these ones, that's the basics. You have to know these. So I hope that shed some light on what you need to do in terms of monitoring your historical trades and what type of ratios you want to look at. So if you have any questions about that, don't be shy to post them either down in the comments or send me an email. I answer all the time. That being said, that's gonna do it for this lecture, and I'll see you guys in the next one. Hey guys, hope everybody's doing well. In this lecture, we're going to be talking about risk management. So, risk management, as you know, is one of the most important topics in trading. If you don't have proper risk management, you will not succeed. And basically, that's because no matter how much money you make, if you lose all of it, you're done, right? So, one thing that's super important in trading is it's not how well you start, but it's how you finish that matters. And if your risk management is not well defined, you're never going to finish well. So what exactly is risk management, and what is risk in short? Risk is basically an action that has a potential to go wrong. So anything that you do that has potential to go wrong involves risk. Okay, so that could be anything. Buying a house could be risky. Buying a car can be risky. Being in a relationship can be risky. Anything can be risky. Skydiving, skiing, anything you do has potential of risk. Now, why do we do these things? because we perceive that the reward associated with them outweighs the risk, right? So yes, you can get married, there's the risk that you'll get divorced, but the benefits and that you see from getting married outweighs that risk. Yes, you can go skydiving, there is risk, you can die, but the benefit of going skydiving, the fun you have, the exhilaration, outweighs that risk. So it's the same thing in trading. There's going to be a risk in buying a stock or shorting a stock because we can lose money, but we perceive that the benefits and the probabilities of gaining are so much better that we're willing to assume that risk, right? Now, that being said, we shouldn't just assume a risk blindly. We have to calculate it, measure it, make sure that we can take it and try and mitigate it so we can reduce it as much as possible. So really quickly, what are the risks involved in trading? There's two types of risks. There's systematic risk and unsystematic risk. Now, the definition for systematic risk is the risk inherent to the entire market or an entire market segment. And systematic risk, also known as undiversifiable risk, affects the overall market, not just a particular stock or industry. So when we're talking about systematic risk, it's the risk that all stocks assume, right? The risk that something happens to the whole market or a whole industry, right? So if there's a market crash tomorrow, all stocks will be going down. If, a specific industry is doing really well, if oil prices are going up, well, the oil industry might do super well. So it's a risk that's common to either a whole industry or a whole market. Other than that, we have unsystematic risk. Unsystematic risk is company or industry specific hazard that is inherent in each investment. So unsystematic risk, also known as diversifiable risk, can be reduced through diversification. What that means is basically this. Unsystematic risk is risk that is just inherent in a specific company. So if a CEO resigns, that's really going to affect just this one company. If, a company's main office goes on fire or, they've been doing fraud, that's unsystematic risk. It's something that's inherent just to that company. And you can actually diversify away all unsystematic risk by buying a lot of different stocks. And when I say diversify away, I mean that if you diversify your portfolio, so instead of buying just one stock, if you buy 20 different stocks, and so you're diversified, even if one company has something, strange that happens, well, it's just going to be one out of a lot of companies that you own. So that risk is going to be diversified away. So even if a company, their CEO resigned and it drops 10%, well, it's just one out of 20 companies that you own. And maybe one of the other companies does super well. So you're not really going to assume that risk because you were able to diversify it away. Now, systematic risk cannot be diversified away. If the whole market goes down, all your 20 stocks are going to go down. No matter how many stocks you have, the whole industry or market might go in that direction. So you can't really reduce that type of risk in that way. Now, these are the risks that exist in the market when we're trading. And there's, again, different ways for us to manage that risk. Because what we're worried about or what's in our hands is how we can actually manage that specific risk that we have. So there's 4 types of risk managements that we can apply. One of them is called risk acceptance. This is the first one. The second one is risk avoidance. Third one is risk limitation. And the last one is risk transference. So risk acceptance basically means you accept the risk that is involved in that stock. So if I buy a stock at $10 a share and my game plan is just buy that stock and that's it, well, basically that means I'm accepting the risk that it goes to zero and I lose all my money on it. If my game plan is just to buy that stock and just hold it, well, I'm literally accepting all the risks involved in it, which means that since every any company can go bankrupt, any company can go to zero. That means I'm accepting the fact that it could go to zero and I lose all my money on it. That would be one of the risk mitigation techniques. So these are all risk mitigation techniques, right? Obviously, we never do that. We never just accept the whole risk. We always have better risk mitigation techniques than this one. Another type of risk mitigation is risk avoidance. Risk avoidance is basically you saying, hey, you know what? I can't take the risk on this position. I could lose too much money. So I do not want to get in that trade. So it's literally you saying, I don't want to buy the stock because there's too much risk. So you're avoiding completely that risk by not participating in that trade. And this is actually something we do often. So we'll look at something, and if we deem that the risk is too high for the reward that it has, we'll just not take it and we'll move on to something else. So avoiding risk is something that you're going to have to get familiar with, because it is something that you're going to have to practice when you deem that risk is too high for the level of reward that you're getting. The third one is going to be risk limitation. Risk limitation is basically exactly what its name says. It's you limiting your risk. So if you're buying a stock at $10, well, maybe you don't want to accept the risk of it going to zero. Maybe you're going to tell yourself, well, you know what? If this stock goes down to $8, I'm taking my loss and I'm getting out of it. So I'm going to limit my financial losses to a maximum of 20%. That's going to be my maximum amount of losses. So I'm going to be limiting my risk. That way I can quantify exactly how much I could lose at any point in time. And usually we're going to be able to do that through stop losses. And this is why it's important for you to always have a stop loss on any position that you have. In that way, you have your risk limited at all times. Okay? So, if you're owning a stock and let me get this out of here. If you have a stock and that stock's been fluctuating here at, let's say this is $10. It's been fluctuating at 10, and there's another level here, $8, where this was a support, let's say. Okay. And now you bought your stock here at $10 because you think it might go up. But you never know. You just never know. This stock might plummet, right? So you told yourself, you know what? I'm going to look at a support that's here, and this here looks like a support. So I feel pretty good about the stock not dropping below that point. So even if it falls a bit, I think it's going to bounce off here and go up, okay? But if it doesn't, and if it breaks below this level, you know what? I'm out. I'm taking my loss. I was wrong. I accept that. I'm getting out of it. In that way, I won't lose more than, this $2 from $10 to $8. So I won't lose more than 20%. That's the max I want to lose. Okay. So you set this up, and you're going to set this up by putting a stop loss at $8. Okay. And what a stop loss is basically an order. Okay. It's an order type. We've already seen market orders, and we saw limit orders. Now, there's another type of order that's called the stop loss, a stop loss order. And a stop loss order, again, its name is very self-explanatory, is a type of order that you put to limit your losses. Okay? So you can put this order at a specific price. So that way, if a stock goes against you, you can limit your losses at a particular price. So if you had this stock that's fluctuating here, then it went up and you bought it here. If you have a position, you bought, let's say 100 shares at $10, and you think this might keep going up, but if it doesn't, you want to get out of it. You want to get out of it if it touches $8. Well, you can send a stop loss order, a stop STP, a stop loss order at, or let's say a stop loss for 100 shares at $8. And if ever, and this is going to be a stop loss sell order, right? So it's selling. And if ever the price of the stock goes to $8, your stop loss is automatically going to sell your shares at that point, right away. So that way, even if you're not on your computer, even if you're not in front of your screen, you're at work, doesn't matter. If the price trades at $8, your stop loss is going to get triggered and your order is going to be sent to the market to sell your shares. So then you would have lost, from $10 to $8, you would have lost some money, but at least you would have closed it out at that. You're not assuming more risk, because if you were wrong buying it at 10 and it went to 8, well, that's it. You were wrong. There's no use in holding it more, right? Then otherwise you could lose even more. And you're not in the game of just, hoping that it comes back. So you always have to predefine what is the maximum amount of money that you can lose on a stock and set a stop loss at it. So if it does go against you, your risk is already calculated and it cannot be more than an amount that you came out with. Now we're going to talk in detail about how to calculate that amount and in the next lecture. But in this lecture, part of risk management is basically managing your positions, right? And this is what we're doing here, because you can literally say, hey, okay, I have the stock. I'm going to put a stop loss at $4 or at $1 or at $6. Like, how do you choose that, right? So you're going to be able to choose that by looking at different price level, different support levels and resistance level, and say, well, this is a very strong level. It's going to have a very hard time breaking this level. So I'm going to put my stop loss just below it, because I know it's so unlikely that it goes there. So I might put my stop loss, instead of at 8, if $8 is a very strong support, I might put it at maybe $7.90. That way I know that it's very unlikely that it goes there, but if it does, I'm just going to take my loss, because then it can just keep going down, right? So no matter what stock you're buying, and let me just put up whatever, let's say Bank of America. If I buy this stock today at $24.10, well, you know what? This stock looks like, let's put a daily chart on. Okay. If I'm buying the stock and I really think it might go up a lot, well, I might put my stop loss somewhere here. Okay, you see this line, how this is such a big support level. The stock really bounces off a lot on the $22 range. So I might say, okay, you know what? I'm buying this stock here. And if it goes up, cool, I'll make some money. But if it goes down, I'm maximum going to be losing $2. I'm not going to lose more. You can actually use this. There's a tool here that you can use for your returns. Let me check it out. It's not this one. It's not this one. It should be here somewhere. Pitchfork. Again, let's see. No, Fibonacci. It's not that. Let's see here. Rectangle. Text. Here we go. This one, you can actually draw your profit and return. So if you buy your stock here, you can say, well, look, my target is $28. I'll buy it at 24. I think I can get out at 28. So that's going to be a 16% return. But if it goes against me, I'm going to put my stop, and you can see actually they tell you stop here. I'll put my stop at $22. So I either lose $2, which is 8.6%, or I make about $4, which is 16%. So this is a very good win-loss ratio, right? And that would be a good trade. But then your risk is limited. You're never going to really lose more than that, which is super important. Because if you just let it go and you just lose, you could keep losing, right? Because at the end of the day, you never know, okay? So this is going to be risk limitation. I'm going to talk more about how to choose the quantity of shares and how to set your stop loss in another lecture. That being said, another risk mitigation tactic is risk transference. And risk transference is basically you paying somebody to transfer the risk to. So it's the concept of buying or selling an option that is basically gonna limit your losses, right? So if you bought some shares in Apple, let's say, well, you could buy some put options in Apple as well. And put options are going to give you money if the stock drops. So basically, you're kind of limiting your risk because if the stock drops and you lose money on your stock, well, you're going to be making money on your put options. And again, this is more of an advanced topic. You don't need to understand put option. You don't need to understand options at all. But just understand that there are types of products that you can buy that will eliminate a certain type of risk for you. So, but these products cost money, so you're paying for them, right? It's not free. You'll be paying for them to eliminate that risk. Again, this is something that's available. We don't use risk transference because it's too expensive. We're in the business of actually predicting where a stock is going to go and not just, if we think there's too much risk in it, we'll just not take it instead of paying such a huge amount of money, which is not really smart to limit that risk. So the risk mitigation that we're going to be using and that all profitable traders use extremely well is risk avoidance, so eliminating trades that are not worthy, and risk limitation, so minimizing your risk on every single trade that you take. Okay? So that being said, that explains a bit what risk management is. In the next lecture, we're going to develop on that by talking about money management and how both of these relate with one another. Hey guys, welcome back to our trading course. In this lecture, we're going to be talking about money management. So in the last lecture, we talked about risk management. Now, the difference between risk management, where we're trying to quantify and limit risk on a single trade, in money management, we're concerned about our whole portfolio, the amount of money that we have in general, and how we manage that whole amount of money. So if in our whole account, we have $100,000, then how much money do we put in each stock? How much loss are we willing to accept in each of these stocks? Whereas in risk management, we were concerned of how do we manage our loss in terms of where do we place our stop loss? Where should we go out to limit our losses? In money management, we're concerned of how much money should we lose, what would be the maximum amount of money that we're willing to lose, and because of that, how much money should we put in each of those positions, right? So when you're looking at money management, you're looking overall on your whole portfolio, and then you're coming out with these numbers. Now, why is it important to have proper money management? Very simple, and I think the best way would be for me to draw it out. So imagine you have a $10,000 account, let's say. Okay, so let's say you have a $10,000 account, and let's put it up here. So you got a $10,000 account, and you're trading. Now, what happens if, let's put it like this, percentage of account lost. So let's say you lose part of your account, and based on how much you lose, I would want to know how much is required to get back to being flat. Okay, just to get back to your $10,000. So if you lost, let's say 20% of your account, meaning you went from $10,000 to $8,000. How much would you need to make to get back to $10,000? You're not going to need to make 20% because you know, when you lost 20% of 10,000, yes, that got you to 8,000, but now you only have $8,000 to trade with. So you're actually going to have to make 25% to get back from 8,000 to 10,000, right? So you see that when you lose, it took you 20% to get down here, but to get back to where you started off, it's going to require you 25%. And that makes sense because you have less money to trade with. So it takes more returns to make the same amount of money, right? Now, the bad thing is when this gets bigger, and let's say you lose 30%, well, if you're at $7,000, now you have even less money. How much money would you need to make to get back to 10,000? You need to make 43%. Now, imagine you would have lost 50% of your accounts. So now you only have 5,000. Well, if you want to turn 5,000 into 10,000, you need to double it, right? So the amount of money that you would need to make is 100% just to get back here. So you see here, there's a big difference. When you lose money, it's so much harder to get back to where you were. It takes way much more return. And look at how big it starts getting if you lose 60%, so just 10% more, okay? Meaning you're at 4,000. Well, it's gonna require you 150% to get back to $10,000, right? So you see a 10% move here is gonna require a 50% move for you to make money to get back there. So what you have to do is make sure that you never reach a place like this, because if you reach the zone where you took so much losses, it's going to be incredibly hard, if not impossible, for you to get back to where you were. Having small losses like this is okay. It happens. You get out of it. But if you get to that zone, then you're really in trouble, right? So obviously nobody just makes money without ever losing money. Nobody, let's say this is your account, okay? This is your account. So this is your P&L here, how much money you make across time. Nobody just makes money like this. Nobody just keeps making money. It's never as clean. Your P&L fluctuates. Sometimes you'll make some money, then you'll lose some. You'll make some, you'll lose some. You'll make some, you'll lose some. But hopefully, you'll be making more than you lose. So your account will be trending upwards and you'll make money over time, even though there's fluctuations. Now, what you want is to not have, it's okay if you have fluctuations like this where you lose 10%, but then you make 20 here and it comes back. What you don't want is having big losses like this, because then it's going to be impossible to get out of the hole, right? If your P&L, and by P&L I mean profit and loss, if your profit and loss, if your profits are fluctuating in such a big manner that, yes, sometimes you win, but then you lose so much that you have so little capital, okay, that then you're really unable to get back there, You're unable to get back up because you have such a small account. You should never let this happen. And this is done by having proper money management, okay? So what does money management tell us? It tells us that you should basically never risk more than 5% of your account on any given position. And that's like ever, right? And it actually, and that's general rule of thumb. And the actual general rule of thumb is don't lose more than 2% of your account, okay? On one given trade. And why is that? Because there's a very real probability that you can lose, or you can have 10 losing trades in a row. Like, it happens. It happens. You're going to buy something, you think it's good, it goes against you. You take your loss. But then you buy something else and it also goes against you. And another one, it happens. If you trade long enough, these very rare events do occur. right? So you have to account for that. And you account for that by making sure that even if it does happen, you're not going to lose as much. So basically, in the rule of thumb in money management is that the ideal amount is that you should not lose more than 2% on a trade. So if I'm buying the stock, I think it's going to go up, I'll make sure that I won't lose more than 10%, than 2% of my account on the trade. So what does that mean? It basically means that if you have $10,000, you should not lose more than 2% of that, okay? Which should be about $200. So you shouldn't lose more than $200 on one trade, okay? So if you take a trade and you lose $200, that's cool, okay? You just lost 2%. And then if you take another trade and you lose another, if you do 10 trades and all your trades were bad and you lost on all your trades, okay, lost on all of them, then how much would you lose? 2% each time of your account, right? So $200 each time on each of those trades. So you'd lose 20%. So you'd still have 8K. So you're good to go, right? And by having, by following this rule, you're really not gonna wipe out. You're gonna make sure that you're in the game and you're gonna be able to survive these fluctuations. But if you trade too big, you take too much risks, those fluctuations are gonna be too big, and at some point you're gonna wipe out. So this is what you don't want to do. Now, based on the account size you have, based on how much money you have, you could be more or less risky, right? So obviously, if you have a very small account, if you're trading with, $1,000, like when I started trading, I only had $1,000. I couldn't only take a 2% loss because that's $20. How am I going to do that, right? So I was taking more. I was taking 5%, even 10%, which is extremely risky, right? Because if I lose a bunch of times, then I might just lose my whole account. But when you are small, you do have to take risks that are bigger to bring your account up because you really have no choice. So, based on your account type, you could go up to 5%, but know that you are taking risks, and this should be just a temporary thing for you to get your account to an amount that's good enough. And as your account gets bigger, you have to take less risk because you have to really avoid a scenario where you lose your whole account. And by following something like 2%, which is, just the general rule of thumb, you're eliminating that risk. If you follow a bigger percentage, there's always that risk, right? So this is something that you should only do if you have such a small account that you are ready to lose it and you really want to get it up there. So you're willing to take that risk of losing your account by having a bunch of bad trades. Very unlikely, but that does happen. Very bad trades in a row. And as you get your account bigger, then you start moving to smaller and smaller percentage max losses. So it's even less and less risky, right? So some people are going to trade with max loss 1% of their account. Some people even less because they have millions of dollars. So they just want to reduce the risk as much as possible. Okay, so 2% is ideal, but if you have a really small account, then, we understand if you take a bigger percentage as your max loss, but know that there's always risk of you losing your account if you use a percentage that big. So only do it for a short amount of time to get your account bigger, and, only if it's money that you're willing to lose. So that being said, it's extremely important that when you buy something, and you actually lose, it hits your loss. Let's say you're saying, I'm going to buy the stock at, $100, but if I lose 2%, if it goes to $98, I'm taking my loss. It's extremely important that if it does go to $98, you do take your loss. You can't just say, okay, well, this time I'm going to hold it. This time it's going to go up. It doesn't matter. You have to follow your rule of taking your losses, because the only thing that can break you is if you don't follow your money management rules and you let small losses turn into big losses. You know, if you say, I'm going to take my loss, I'm buying the stock at $100, you know, I'm buying the stock here at $100. At $100, I'm buying it. But if it goes down here to 98, I'm going to be taking my loss, right? I'm going to take a 2% loss or a $2 loss on this, and that's it. You have to respect that. Because if you don't, that stock might keep going down. And then you might, instead of taking a $2 loss, you might be taking a $30 loss or a $40 loss. You don't know. So you have to take that. Taking losses is by far the most important thing and the thing that separates good traders from bad traders. Anybody can take money off the table. Anybody can take a gain. It's not hard. Anybody can come in, okay? I can take anybody off the streets, tell them, hey, look, buy a stock at 100, and when it goes to $110, take the profit, take the money off the table. Anybody can do that. You're not special for doing it. Why should you get paid? Why should you be compensated for doing something that anybody can do? You shouldn't. People get paid, they get compensated for doing something that other people cannot do. And what people can't do, and people struggle with, and people aren't good at, is taking losses. Because when you take a loss, it's basically like you're saying, I was wrong. But that's the thing. If you're not okay with being wrong, you're not going to be able to be successful in the stock market. You are going to be wrong a bunch of times, and you're going to have to accept that and take your losses. And if you're able to take your losses, if you're able to do what's hard to do, that's when you're going to be successful. Okay? So taking losses is one of the most important things. You have to practice being good at being wrong. So being good at being wrong in a trade and taking your loss at it and moving on to the next one. Because, you know, you're paid to take losses. You're not paid to take gains because that's something anybody can do. You're actually paid, you're compensated for making these hard actions where you say, okay, I was wrong on this one. I didn't make money. I'm taking my loss. I'm moving on to the next one. So that really much covers money management. In the next lecture, what we're going to be doing is we're going to be combining money management with risk management and covering position sizing. So basically how many shares can we buy based on our money management rules and our risk management rules. Welcome back, everyone. In this lecture, we're going to be talking about position sizing. Now, in the past few lectures, we've talked about money management and risk management. We've said how money management is the process of figuring out what's the maximum amount of money that you're willing to lose on any one given trade in order to not lose too much on your whole portfolio and be in a bad position. We've said how risk management is the process of trying to mitigate risks on any given trades, so minimizing the risk as much as possible. In our case, we're going to be limiting or avoiding risk. Now, position sizing is basically that. Is using the risk limitation combined with the money management, so how much money we could lose, to decide how many shares we're going to buy of a stock, right? So basically, position sizing is going to be how many shares to buy and how to buy them, okay? So we're going to use this technique, so position sizing, to figure out how many shares we buy. Now, based on our money management and our risk management, this will change. So it is reliant on your money management and risk management. Now, once we figure that out, there's also different ways of entering a position. Not just how many shares, but how we enter. Do we just buy one time? Do we split our order, buy a bunch here, a bunch here, a bunch here? Do we get out in one shot? Do we split our orders when we're getting out? So a lot of different ways. And obviously in this foundation course, we're only covering a simple position sizing technique. In the advanced course, we're covering more advanced techniques that we use with different strategies, right? So the thing is that with position sizing, as well as with anything else in trading, there's different ways that work best for different strategies and under different circumstances. Okay, so you cannot follow the same position sizing methodology for all strategy or all stocks. Some will work better on different strategy and different situations. Okay. That being said, let's take an example or talk about just the most basic position sizing technique there is, which is just the simple position sizing where you're buying one position and you have one exit and one to take your profit and one exit to take your loss. So that's it. There's no scaling in, there's no pyramiding in, reverse pyramiding in, scaling out. There's none of that. It's just simple. One entry, one exit. So let's look at the function. The way you calculate your position size for the simple position sizing method is going to be by calculating the maximum loss per trade that you're willing to take and divide that by the amount you can lose per share on that specific trade. So let's take an example. Let's actually go here on trading view, or you know what? Let's choose a stock. We'll go on Finviz and let's choose a random stock, something in a trend line. Okay, so let's say we're buying whatever. We'll just take this for example. Or you know what? Let's find something better. Let's find a top, double bottom. Double bottom, double top, double bottom is good. Okay. So let's say we're going to be buying this stock, SRTS. SRTS. Okay. So SRTS looks like it has a good support here at $3.50. Okay, so you see here. How can I grab this? Let's see if I can pull this up a bit. Yeah. So as you can see, the stock has been dropping, but at 350, there's some kind of support. And here several times it hit the 350 and always rebounded off of it. So, and you can see that it comes with very strong volume as well. So if I think this stock is going to go up and I want to buy it right now, it's trading at 4.16. I want to buy it right now, but I'm scared that if it goes against me, I'm going to lose, right? Because obviously I can buy it, but you never know what's going to happen, right? I can buy it. Let's see if I can just get on here. I can buy it here, expecting it to go all the way up, but you never know, right? It could break down. Now, if it goes against me, when will I take my loss? At what price? And that's the big question, right? I have at one point to take my loss. I can't just hold it forever because this could go to zero. Anything could go to zero, right? So I got to decide on a price that's far enough so I just don't get stopped out for no reason, but close enough so I can buy more shares. And you'll see why. So let's say if it goes to this price here, okay, which is 340. Let's say if it goes to 330. If it goes to 330 or 320, let's say, okay, I'm gonna take my loss. If it goes here, I'm taking my loss because obviously it broke. Actually, let's put it higher. 330. So if it goes to 330, I'm gonna take out my or 325. Here we go. So if it hits 325, I'm taking out my loss because obviously if it came all the way down here, then I was wrong, and I'm gonna move on to another trade. So now that being said, how many shares should I buy? Okay. First off, to calculate that, we need to know how much money am I willing to lose on any given on that trade. Okay. So again, the function is the max loss per trade. How much money can I lose? Then divided by the amount I can lose per share. So max loss per trade, which is going to be, we need to refer to our money management. So imagine we have an account with $100,000 and our money management says that the maximum we could lose per trade should be 2% in case we lose too many trades in a row, right? So 2% of 100K is going to be $2,000. So that's the maximum amount of money that you can lose on any given trade. You don't want to lose more than that. So my position sizing is going to be equal to 2000 divided by, and let's see here, amount you can lose per share. So what is the amount that I can lose per share? Well, look at this. If I buy it, and let me draw it out with a long position here. So if I buy it here right now, 417. Okay. So I buy it at 417 because I think it might go all the way up, whatever, to 6 maybe. You know, I'm really optimistic about this. But it could go down all the way to 325, at which point I am going to be taking my loss. Okay? Here. So the difference between 417, if I buy at 417, and it goes all the way down to 325, how much could I lose? Well, I could lose 92 cents, right? Because 417 minus how much? 325. So if I go here, if my purchase price is 417 and my stop loss, basically the price at what point I'm going to be saying, okay, I was wrong, I'm taking my loss, I'm moving on, is 325. So the max loss that I can have per share is going to be 92 cents, right? That's what we said. So I can lose 92 cents. If I buy one share and it goes against me, I know that the maximum I'm going to lose is 92 cents. If I buy 10 shares, I'll lose $9.20. If I buy 100 shares, well, if it goes against me, I'll be losing $92, right? So that being said, I know that I can lose $2,000. So if I can lose $2,000, and if it goes against me, I'll lose 92 cents, then how many shares can I buy? And let me just grab my calculator. So 2,000, or actually let's do it here. 2,000 divided by, so 2,000 divided by 0.92. So I can buy about, obviously you have to round this, 2,100 and let's say 70, 2,170 shares. So I'll buy 2,170 shares, right? Because if I buy 2,170 shares, okay, if I buy 2,170 shares at 417, and then it goes against me, and I take my loss, so I sell my shares, my 2,170 at 325, then how much money would I have lost? Well, I would have lost 92 cents here, right? Times the amount of shares that I have, 2,170, which will be, so 92 cents times 2,170 shares, which is going to be about $2,000, right? So in this way, by calculating my position sizing using this formula to get the exact amount of shares that I have to buy, or that I should buy, so that I never lose more than my maximum amount of loss per trade, right? Because if I imagine this, if I would have bought 4,000 shares and it moved against me like that, well, I would have lost way more money, right? And I can't lose more money than this, because if I don't follow my money management rules, I'm not going to make it, right? I have to follow my money management in order to make it. Now, your money management might be different. Instead of 2%, you might have 5%. If you have a way smaller account, you got to take more risk. Or if it might be slower if you're trading millions and millions. So that might be different. But whatever that is, you have to be consistent in using it to calculate your shares. Because too many shares, then you can lose more than what you want to lose. And too few shares, well, then you're losing opportunity by not having the right amount of shares. Because obviously, if you have, let's say, instead of 2,000 shares, you had 6,000 shares. Okay? Well, if you lost, if it went against you, you would have lost too much. Too much, right? But in the case of where you would have bought too little shares, let's say 500 shares instead, and it went your way, right? You would have made not enough money, right? So in both situations, having too few shares is not good, because if you win, you're not going to win as much. And having too much shares is not good, because if you lose, you're going to lose too much, and it's going to be way harder getting out of that hole. So you have to respect your money management rules, okay? So you see, it's pretty simple how you would calculate that. Let's calculate another one and assume we're going short. Okay, so just to switch it up and make sure that you understand, let's take a multiple. Let's get a multiple top this time. Double top. Okay. You have the stock WDAY. So, okay. This one looks like it has a nice top here. Let's say there's a resistance around that price range, okay? I'm going to short some here. Okay, so let's say we're going to short some at, we're going to short some right now at $100.80. Okay, well, at $100.80, I don't know, I think it could go down here, so I want to make 7%. But if it goes up here above its previous high, I'm taking out my loss, okay? Because then it's too much, and I have to get out, right? So how much money can I lose per share? Well, if my entry price is 190 or 100 and around 80, and my stop loss is about at 107.28, well, then I could lose $6. This is a $6.40 move. $6.40. Okay. So let's calculate that. $6.40. If we get back here, a second. If we get back here, same rules. So let's say we have $2,000 that we can lose. This time, 6,000, our position sizing. It's going to be 2,000 divided by the max amount we can lose per trade, which in this situation, weirdly my computer is lagging, divided by 640. Sorry. Why are you lagging? This is super weird. So, here we go. 640. Okay, so this is a 640. Wow. Okay. So $6.40. So how much would that give us, right? I can lose $2,000, and if it goes against me, I'll be losing $6.40 per share, because this is an expensive stock. So I can buy 312 shares, according to this. 312 shares, right? So very important, because you see, in the other situation, we wanted to buy 2,100 shares, and now we only want to buy 300 shares. So extremely important to have a fixed method of calculating your position sizing, because you want to have your approach as systematic as possible. So rinse and repeat, right? You do it, you do the same thing, you do the same thing. If every time you're betting different amounts, it's not going to be consistent, and it's not going to work out. Now, this is the simple position sizing, one entry, one exit. Obviously, There's way more advanced position sizing techniques where we average into our positions, average out into our positions. Depends if you're running a momentum strategy or a mean reverting strategy, which we cover in the advanced class. But just know that you should not always follow the same position sizing strategy or even the same money management techniques or value under all strategies. Okay, you have to have a valid money management, risk management, and position sizing based on the specific strategy. Yeah, and we'll cover that in the advanced course, obviously. That being said, that's going to cover position sizing. So if you have any questions regarding that, leave them in the comments and I'll make sure to answer them. Other than that, I'll see you guys in the next lecture. Hey guys, welcome back to our Foundation Stock Trading course. In this chapter, we're going to be talking about trading psychology. In this lecture specifically, we'll just be covering the importance of psychology. In the future lectures, we're going to talk about loss aversion, endowment effect, status quo bias, anchoring effect, confirmation bias. So these are all biases that humans have and that affect us when we're trading whatever product there is to trade. We're also going to talk about genes and instincts and how that affects us. And then at the end, we're going to cover misconceptions about trading psychology and ways to improve on your psychology. So that being said, let's get into it. So trading psychology, why is it so important? Okay. Why is trading psychology so important? Everybody knows it plays a major role in your success as a trader. You never hear anybody, failing at trading because, they weren't good enough at technical analysis or they weren't good enough at, fundamental reading the news or whatever. It always comes down to them not being able to handle their emotions, right? Not being able to take their loss, not being able to take their profits. It always comes down to them doing something that they know they shouldn't have done, right? And why would they do something like that? Basically just because they're not able to handle the stress, the emotions, and everything that goes on in those times. So that being said, how important is trading psychology, right? Because you have a lot of things you can look at. You have risk management, money management, technical analysis, fundamental analysis, macro news, a bunch of different things. How much time should you take to get good at, trading psychology or handling your emotions, right? For me, trading psychology is honestly one of the most important aspects in trading. Now, is it more important than risk management, technical analysis, having a solid strategy? Yes, absolutely. Because if you can't handle your emotions, no matter how good your strategy is, no matter how strong your risk management is and technical analysis, you're not going to follow it. You're not going to follow your rules because you're not going to be able to do what's right when the time comes. So, if your psychology, if your emotions aren't in check, nothing else matters. No matter what, no matter how good you're at it, you're not going to be able, to follow your rules and do what you should do, right? So for that being said, psychology is by far the most important aspect in trading. And thus it should, you should give it the time it deserves, right? Now, obviously, when I'm giving a course like this, I can't spend 50% of the time talking about psychology because it's not a psychology course. And the thing with psychology is it's a little bit different for everybody. So whatever affects somebody might not affect somebody else the same, right? So it's really dependent on you. Now, that being said, even though I believe it accounts for more than 50% of, your success as a trader, I can't put up 50% of the course on it, but you should focus a lot on psychology. And again, that's one of the reasons why a lot of people struggle with trading psychology and handling their emotions, is because they don't give it the time it deserves to learn it and to get good at it, right? I see a lot of traders, they have a bad day and you'll see them brushing up on some technical analysis, reading a new book on money management, risk management, or whatever it is that they think they're lacking on. And I asked them, well, don't you already know all the technical analysis you need to? Don't you already know how to do money management and risk management? So if you lost money today or this week, maybe it wasn't because of your technical analysis skills or your risk management. Maybe it's because you couldn't handle your emotions and you didn't do what you know you should do, at that time. So maybe you should brush up on, how do you handle your emotions, how to behave right under stress, how to behave logically under stress, right? Because we all know that when you have a lot of emotions, you don't act right. You're not rational. And that's why a lot of people tell you, don't make hasty decisions or don't make decisions when your emotional weight and think, and then, the next day make your decisions. Well, the reason why they say that is, again, emotions make you completely irrational. So when you're trading and you're playing with money, right, you can either win or lose a lot of money. Don't you think that brings in a lot of emotions? Obviously it does. Money is synonym for being able, to feed your family, have shelter, everything that matters to us as humans, right? So obviously it brings a lot of emotion with it. Now, the problem with that is you usually don't know when you're struggling with your emotions, right? You don't know that. So you might lose money in a week and think it's because you're not good enough at analyzing stocks, but you are. It's just you're not good enough at handling your emotions and doing what you set out to do, following your rules, taking your losses when you have to, because your emotions were too strong, right? We all know somebody who goes to the casino, loses $100, and he just goes and he takes out more money until he blows it all, because he can't handle the emotions. So that being said, it's extremely important that you give it the time it deserves, okay? And throughout this chapter, we're going to be talking about ways to improve on it, because again, a lot of people just think, well, they're good, they can handle the emotions, and they're good. Let me just read on technical analysis. Let me read on that. But no, you're not. The bottom line is you're not. Nobody is. It takes time to work on this, and it's super important aspect in trading. So that being said, I'll see you guys in the next lecture. In this lecture, we're going to be talking about loss aversion. So what is loss aversion? Loss aversion is actually one of the multiple biases that we're going to be looking at. And when I'm talking about biases, I'm just talking about human behaviors that affect us, in this case negatively, when we're trading. And these biases that we all have and we all share to a certain degree are the ones that I've seen throughout my career have affected most traders and have affected me the most. And that I was able to really become more successful when I was able to control those biases and really understand them. And obviously, before you're able to watch out for something or know that you have a certain bias, then first of all, you have to know about it, right? You got to know about it. And then once you know about it, you're going to start realizing that you have, this certain type of behavior that doesn't really make sense. And then you can start changing it. So, that being said, let's get into it. Loss aversion is the first one. It's one of the most important ones, actually. What is loss aversion? Loss aversion is a theory that states that losses have a bigger negative impact than equivalent gains have positive impact. And this theory says that it's about twice as much more negative. So what does that mean? It means basically that if I'm telling you, hey, let's play this game. Okay, imagine I come up with a game and I'll tell you, let's play this game. Let's play head or tails. And we're going to play head or tails for $5,000. Would you play with me? Probably not, right? Why? You have a 50% chance of making money, 50% chance of losing money, and it's the same amount of money, right? So it's a zero-sum game. There's no loss, there's no gain. But for you, you perceive that the gain, the loss, losing $5,000 as being way much more painful than the possibility of making $5,000. So you don't perceive the gains and losses to be equivalent. You perceive losses of equivalent amount to be way worse than gaining that same amount, right? So let's say if I Google loss aversion, okay, so the definition would be in economics and decision theory, right? Which this is super important because that's mainly what we're going to be doing, decision theory, right? Loss aversion refers to people's tendency to prefer avoiding losses to acquiring equivalent gains. It's better to not lose $5 than to find $5, right? Some studies have suggested that losses are twice as powerful psychologically as gains. Now, to further develop on this, I'm going to look at a study here. Most of the studies that I'm going to be referencing in this chapter are going to be from this study, this report. So this is the anomalies, the endowment effect, loss aversion, and status quo bias by Daniel Kahneman, Jack L. Netcher, and Richard H. Thaler from the Journal of Economic Perspectives, winter 1991. So a lot of these biases that I've looked at, I actually, looked at through reading multiple studies like this one, and I've read over 30 different studies in the sort, and these are the ones that really stood out the most, and these are the ones that come out the most, right? So it's not like I believe that they're important, but they're tough to find, or not everybody knows about them. These biases are widely known and widely studied, and in economics and in decision theory, so they are very important. So we're going above, the simple, greed and fear model. There's biases that are specific and that, you can target and change, right? So in one of the studies that was cited here for the loss aversion, what they wanted to do is to prove, okay, that there is a certain loss aversion, and that we do feel that a loss is way worse than an equivalent gain. And what they've realized is that loss aversion is always based on a reference point. It's always based on where you're at right now. So they actually came out. Let me get this rolling here. Oh, let me get this up. Okay, so let's see here. Okay, so what they did is they actually took a group of people, and they told them, okay, look, you have a job right now. Okay, this is your current job. And in your current job, the contact that you have with other people, okay, contact with other people is kind of isolated, right? And your commute time, the time it takes, is that 2 hours? Your commute time is about 10 minutes. Okay, so it takes you about 10 minutes to get to work. Okay, now we're gonna give you two different choices, two different jobs that you can choose from. Job A, which is gonna have a limited contact with other. So you see, it's better than being isolated, but it's gonna have a 20-minute commute time, right? And then we're gonna give you another job, another option, which is gonna be called Job D. Job D is moderately social, right? So better than this one and better than the other one. But this job will take you 60 minutes to get there. Now, which one would you prefer? Which job would you want to go to? Okay, this is your current job, and now we're giving you two options. And I'll let you decide which one would you prefer. Would you like to go from this job to Job A, which is going to have better contact with humans, so more contact, but it's going to be worse on commute time? Or are you going to go to Job D, which has way better contact with others, but way worse commute times? So probably you, like most of the people, have selected this one, right? Job A. You've selected probably job A. Okay, so most people selected job A. So what they've done next, okay, because that doesn't really prove anything. What they've done next is they've said, okay, well, we're gonna come out with a different reference model, okay, reference point. So this is your reference point. This is where you start off. That was your current job. Well, imagine your current job wasn't isolated, but it was. It has very pleasant, very social, and had 80 minutes of commute time. So if you had these, okay, now which one would you have selected? Would you have selected job A, which is worst on the contact with others, so you go from very social to just limited, but it's gonna be way better on commute time? Or are you gonna go to job D, which is, a bit worse? So here you go from very social environment to a limited environment or a social environment. So in either case, you're losing on the contact that you're getting with others. On commute time, you're gaining in either case. So which one would you prefer, job A or job D? Now what they've realized and what the test has proven, right? What the respondents have actually said is that they preferred job D. So they preferred going from a very social environment and a 80-minute commute time to an environment that's social and 60-minute commute time. They were not willing to go to something extremely limited in contact with others. So even though it's the same two jobs, people chose differently. Okay, people chose differently. And why is that? Why did they choose a different outcome based on where they started, based on their reference point? It's because basically they were looking at what they're losing on, right? You can see that the choices that made them choose, the reason that made them choose which job was what they're losing on. So in the first scenario, when they were isolated and they had 10 minutes commute time, what were they looking at to make their choice of job A? They weren't looking at the fact that they could have a better social environment. What they cared about is that they were losing on commute time and they didn't want to lose too much. So they decided to choose the job where they lost the least, right? Where they were losing the least on commute time, because they were losing on commute time, right? You're in the first scenario, isolated contact with others and 10-minute commute time. Well, people are like, okay, well, I can't go and start making 60-minute commutes. I was only doing 10. This is the max I can do, 20 minutes commute. And I'm having better contact, but whatever. This is what I'm focusing on, what I'm losing on. Because what you lose on counts way much more than what you gain on, right? And when they changed the scenario and you started off in a scenario where it's very social and 80-minute commute time, they weren't looking at like, oh, I can go from 80 minutes to 20 minutes. I wanted that. They didn't even look at the commute time. They were looking at what they're losing on. They're like, okay, I'm going from an environment that's very social to something that's limited. No, I can't do that. Okay, I'll at least go to something that's just social. So they were making their decision based on what they were losing on. And basically that's because whatever you're losing on is what impacts you the most. You feel way more when you're giving up something than when you're gaining something. Okay? And that has a very strong liaison with trading, because people always view trading or their losses as way worse than their gains. And I'm going to get back to that. Now, in the same journal, they've done another study, and this study was by Visicus and Magat and Hubert. And it's where what they've done is that they they documented similar effects in a more realistic setting. Their respondents were recruited at a shopping mall. So they went to a shopping mall in a hardware store. The respondents were shown a can of fictitious insecticide. Okay? A can of fictitious insecticide. And were asked to examine it for use. The current price of the can was said to be $10. So I had this can here. Okay? This is insecticide. And it's $10. Okay? Use your imagination. Now, the respondents were informed that all insecticides can cause injuries if misused, including inhalation and skin poisoning. And in households with young children, child poisoning replaced skin poisoning. Now, the current risk level was said to be 15 injuries. So 15 injuries over 10,000 bottles. So for every 10,000 bottles sold, there would be 15 injuries. Respondents were asked to state their willingness to pay to eliminate or reduce the risk. So how much were you willing to pay to reduce this risk, right? This is the risk we have here. How much are you willing to pay to eliminate or reduce this risk? Now, in household without children, the mean willingness to pay to eliminate both risks was so willingness to pay to eliminate the risk was $3.78. So people were willing to pay on top of the $10, $3.78 to have a risk of 0 over 10,000. So just eliminate that risk completely. The respondents were also asked to state the price reduction they would require to accept an increase of 1 over 10,000, right? So to have a total of, instead of having 15 over 10,000, to have a total of 16 over 10,000, right? How much would they accept, right? What's their willingness to accept to have an additional 1 over 10,000 risk, right? How much can we give you as a rebate of that $10 price tag? Now, the respondents were asked to state the price reduction, blah, 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 in each of the two risks. The results were dramatic. 77% of respondents, okay, that's 77%, a huge amount, okay, in this condition said they would refuse to buy the product at any positive price, meaning they would refuse to buy this product at all, okay, at all, for any positive price, okay, even if you give it to them for a cent, they wouldn't take it if you increase the risk by 1, right, which makes absolutely no sense. Makes absolutely no mathematical sense, because if they're willing to pay $3.78 only, right? They're not willing to pay infinite amount of money. They're not willing to pay $1,000. They're willing to pay $3.78 to reduce the risk by 15. Then how come just for 1, they're not willing to get, a few dollars or $5? So it makes no sense. So you can see that losing is perceived so much more negatively than gaining. Okay, and they say the striking difference between willingness to accept and willingness to pay in these studies probably reflect the large difference in the responsibility cost associated with voluntary assumption of additional risk, in contrast to a mere failure to reduce or eliminate existing risk. Which again comes out a lot in trading, right? You can have, 1,000 shares in a stock, and the stock is, plummeting, and then, I'll tell one of the traders, well, okay, this doesn't look like a good position. You should get out of it, reduce your risk to 0, and be like, no, I'm sure it's gonna go up, or whatever. I'll tell them, okay, well, buy another 1,000 shares, buy another 500 shares, and tell me, no, I don't want any more. Well, why? Isn't it a good trade? Why wouldn't you want any more? So, there's always this fear of losing or taking more risk than just removing the risk you're holding. And they say again here, the asymmetry reflects both blame and regret after a mishap, and the anticipation of blame and regret in turn could affect your behavior. So when you're in this situation and you're given an option to, pay to reduce your risk, which you give it, a maybe it's $3.78 to reduce all 15 over 10,000 risk, or get paid to take an additional one risk, and you're literally not accepting that at all for any price, which again doesn't make sense. But it's because you're anticipating, or you're fearful of this happening, and then you feeling regret and feeling blame, right? So blaming yourself and regretting is something that you don't want to feel, to a point that just anticipating having those feelings is really bothersome, right? And because of that, it makes you take risk or bets that are not very good for you, right? So in this situation, this does not make sense. You willing to pay $3.78 to reduce that, but not willing to take any money to increase it. So I'd obviously increase my risk for if I can increase it by one for $5, for sure I'll take that. For sure I'll increase it by $5, get it half price for just one additional risk. If that was what I was willing to pay to eliminate all that risk, then for sure that's how much I would be increasing it by. So how this affects our trading, right? How would it affect our trading? Well, it affects our trading in a bunch of different ways. First of all, when you have a gain, and a lot of people have been in this situation before, where they buy a stock, and let's say they buy it at $10, it goes all the way up to 20, and then drops back to 15, right? And so maybe they invested $10,000. So in this situation, they were up 10,000. But once the stock dropped all the way back to 15, they're only up $5,000, okay? In both situations, they're up money. They're making money. But once they get out of their position here and they bank $5,000 in profit, they're not happy, because they now assume that their reference point is here. That's where they were. So for them, it's like they lost $5,000. And they're not looking at the fact that they made $5,000. Or they know that they made $5,000, but the loss of that $5,000 weighs way much more on them than that particular gain, right? So then they become unhappy, and they don't take their profit. It's not a loss, it's actually a profit. They don't take their profit because they have so much pain, or they feel so sad or regretful and emotional about that position that they have now from that reference point, that they're unable to make the right decision and take their loss. So what you need to understand is losses will seem bigger to you, and they'll feel way worse than similar gains. But that's just a human bias that we all have. We have this bias where losing something is so much painful, way more than gaining it. But if you let that emotion take control of you in trading, you're never going to make the right trades, because you're not going to be mathematically, correct in your trades. Meaning that a loss will seem bigger to you than it actually is, and a gain won't seem as big to you than it actually is, which is going to skew all your trades, because you're going to want to make way bigger trades to fail, to compensate for the losing trades that you've gotten, and that could be a major problem in your risk management and taking your losses and not taking your losses. So I think that covers a bit loss aversion. We're going to get back to loss aversion in some of the other biases, because you're going to see that they actually feed a lot off of each other. So that being said, I'll see you guys in the next lecture. In this lecture, we're going to be talking about endowment effect. Now, what is the endowment effect? This is another one of the biases that we're going to be covering. The endowment effect is a theory that states that we place more value on something that we own than if we didn't own it. So we place more value on something merely because we own it. So it's basically saying, whatever you have, whatever you own, your bag, your binder, you place more value on it than if you didn't own it. So if you didn't own that bag, you wouldn't think it's as worthily as it is to you now than if you own it, right? So whatever you own, you actually place more value on it. You know, your clothes, your cell phone, your computer, whatever, anything that you own, you place more value on it than if you didn't own it. Okay, so if you had the opportunity to buy that same thing off of somebody else, you wouldn't place as much value on it. And if we actually just Google here, endowment effect, in psychology and behavioral economics, the endowment effect, also known as divestiture aversion and related to the mere ownership effect in social psychology, is the hypothesis that people ascribe more value to things merely because they own them. And you're going to see how that impacts a lot of our trading. So I'm going to quote a few studies that were done on this particular bias. And again, it's in the same article that I've read from in the previous lecture. So in one of these studies, what they've done is actually they went in an economics class, so in an advanced economic class, right? So not your regular people, so people that are quite smart, and they decided to do a study on those on the students of that class. What they've done, and let me just get this up here. All right, here we go. So what they've done is they split the class in two. Okay, they had the full class, they split the class in half. Okay, so you have a bunch of people here, a bunch of people here, and what they did is that they gave half of the class some mugs. Okay, they gave them some mugs. Okay, and the other half of the class, they didn't get anything. Now these mugs are mugs that are sold at the school's supply store. Everybody knows about them. They're nothing special. And then what they did is they asked to half of the class that got the mugs, okay, how much they were willing to accept for these mugs, right? How much were they willing to accept to sell these mugs? And for the other people who didn't get a mug, they asked them, how much are you willing to pay for these mugs? Now there was a staggering difference. The mug owners, let's say, were willing to sell them for about $6, and the people who didn't own them were somewhere around $2.50, somewhere around that range. Okay, maybe not the exact prices, but it was about 2 times difference. So then what they said is, well, maybe that has to do with bargaining habits, because we know that humans have bargaining habits, and when they want to sell something, they usually overprice it because they know they're going to bargain down. And when they want to buy something, they usually put a lower price because they're going to bargain up. So they said, okay, well, we're going to introduce a market. So this is going to be a market, and people can buy and sell from one another, right? And we know that when there's a market, there's an open market, we eliminate bargaining habits and we actually figure out the actual price. After they introduced this market where people were allowed to buy and sell from one another, what they realized is that the buyers were now willing to buy at $2.75, and the sellers were at $5.25. So even though it did have an impact, on the willingness to accept and willingness to pay, there was still a difference of about, the price being twice as much, right? For the same mug. So the ratio was about twice as much. So basically that was telling them that these people who have the mugs they're willing to sell them at twice as much the price than the people who don't have them. Why is that? Is it just because they own it that they're valuing this more? So they decided to do something else. They decided to say, okay, well, look, we have the buyers, okay? We have the sellers who can sell, we're going to introduce another group. So they went into another class and they did the same experiment, but they had other people who were the choosers. Now, we know that the buyers don't have a mug. The sellers were given a mug. Now, what they did is they said, okay, we're going to go at every price increment. So let's say $1, and we're going to ask the buyers, hey, would you want to buy a mug for $1 or not? Okay. And if they say yes, well, okay. The sellers, we would ask them, would you want to sell your mug for $1 or not? And they might say, okay, well, no, we don't want to sell it for $1. The choosers will ask them, do you want to get the money or the mug? And they have a choice. They can say, I want the mug, or I want the money. Okay, they can choose. And then we'll go $2. For the buyers, are you willing to buy the mug at $2? For the sellers, you're willing to sell your mug at $2. And the chooser, which one would you choose? And they did all of that, 3, 4, at every price range. And what they realized is, the people who didn't have a mug, the buyers, were willing, the maximum, the average price that they were willing to buy at was about $3. That's where for them, okay, I'm not willing to buy that mug at any price above that. The sellers, again, were somewhere between $5 and $6. That's where they were willing to sell their mug for that money. Now, who would we expect the choosers to act like, right? The choosers are in the same situation as the sellers, right? Because they can choose between the mug or the money. Same thing as the sellers. The buyers can't. The buyers have money, but they can buy the mug or not, right? They're allowed to buy the mug or not allowed to buy the mug. But the sellers have the mug and they can exchange the mug for money at any time. The choosers can choose between the mug or the money at any time, right? So we would, since they're in similar situations, we would expect them to have a similar outcome, right? But what actually happened is that the choosers chose something extremely similar than the buyers. So they were behaving exactly like the buyers, even though they were in the same situation as the choosers, right? So how come the choosers decided to take money over the mug at $3, and that is the same price that the buyers were willing to pay for the mug, right? That's the point of where they changed their what they wanted to do. But the sellers that have the mug weren't willing to sell it at 3 or 4 or 5. They were only willing to sell it somewhere around 6. Well, because the sellers actually own the mug. Like, the only difference that differentiates the choosers from the sellers, because they're in the same situations, is the fact that the sellers have the mug in their possession. So they own the mug. They have it on them. And because they have it on them, they're valuing it more. Right? So that was the experiment that they've used to explain and to show that actually just owning something, the fact of owning something, then not owning it, affects your behavior. Okay? And you value something more just because you own it. Because again, if you're in a situation, somebody else is in the same situation but just doesn't own it physically, it's not on him, he doesn't make the same decision as you. So that really explains, the endowment effect. And there's a bunch of different studies by, different authors, and they all come out with the same conclusion, that endowment effect is based on the fact of you owning something. And again, whatever you own, right, you value it more, right? Whatever it is, if it's a t-shirt, if it's a sweater that you like, whatever it is, you value it more than if you wouldn't have owned it, right? And the problem with that is the longer you own something, the more you actually value it, right? And, that's why when you're in a relationship, the longer you're in a relationship, the more you value that relationship. The shorter, the less meaningful it is to you. There's less attachment. So you actually value something more than it actually is when you own it, right? So then they started to think, well, why is it that they value it more, right? Do they value it more because they actually perceive that it's better? Well, what is the reason behind that? So they actually did another study And let me read it up here. A recent study by Lowenstein and Kahneman investigated this issue. Half the students in a class were given pens. The others were given a token redeemable for an unspecified gift. All participants were then asked to rank the attractiveness of 6 gifts under consideration as prices in subsequent experiments. So basically what they did is they gave them something very similar than this, right? Something very similar. And in the end, they asked them to rate the attractiveness of that product. So they gave them a survey where they could rate that mug. Okay, can you please rate that mug for us? Tell us how you perceive that mug. And what they realized is that the owners rated the mug in the same way that the non-owners rated it. So they didn't perceive that, you know, the mug is better. It's not because they owned it that they thought it was better. And what that actually led, the researchers to is that it's not the fact that they perceive that whatever it is they have is better because they own it. It's that they perceive the loss associated with giving it up to be way bigger than it actually is. And that's what loss aversion is about. You know, when you lose something, it feels way worse than when you gain it. And loss aversion is highly correlated with the endowment effect. So when you have something, the fear of losing it, or losing it, is you feel that it's so much more painful than when you gained it, right? And this is what they say. This suggests that the main effect of endowment is not to enhance the appeal of the goods one owns, only the pain of giving it up, right? So when you're endowed with something, when you own something, it's not like you perceive it as being better than it is. It's just that the pain associated with giving it up is so big that you value it more. And this has an extremely big impact on our trading, right? It has an extremely big impact on our trading because once you get into a position, once you have a stock, you're instantly endowed. You instantly have this bias that affects you, where you value it more than it actually is, right? It's not worth as much as you think it is. You think it is worth as much just because you own it, right? And it's not because it enhances your appeal, but because you're scared, or the fear of losing it, not having it. You think that that would have a super strong negative emotion with it, right? Not having it. So if you buy a stock and then you're in doubt with it because you have it, you don't want to get rid of it because you have this fear of, if I get rid of it and it continues going up, and then I did it, I got out of it at the wrong time, then you're gonna feel these emotions of pain and regret and blame. So you don't want to feel those. So then you keep holding on to it, right? So that's the endowment effect. And there's a bunch of traders that they have a stock, they'll buy a stock somewhere here, the stock tumbles down, it's going down, and you tell them, okay, well, are you gonna get rid of it? No, I don't want to get rid of it. It's probably gonna go up. Okay, well, where are you gonna get rid of it? Okay, here, goes here, keeps holding it. Are you gonna get rid of it? No, soon, no. And then you ask them, well, just get rid of it, okay, sell it, take your loss, I'll come back in 10 minutes and buy it back in 10 minutes. Just get rid of it for 10 minutes and buy it back. Okay, they'll sell it, and 10 minutes later I'll get back to them and tell them, okay, buy it again. And they'll be like, no, actually I don't want it. It's not as good anymore. So just the fact that you don't own a stock changes completely your behavior and your decision making. As soon as you own it, you have to understand that this bias is going to be there. You're only human, so it is going to affect you, and you're going to feel that whatever you're having, you're going to be endowed with it. You're going to feel it's worth way more than it is, Again, not because you think it's better now, but because you have, this fear of losing it, all right? That this pain of giving it up. There's a pain of giving it up because you're always scared that you might miss on an opportunity of you not being in it. This is something you want to watch out for all the time. As soon as you buy a stock, know that your decision making has changed because you're in that stock. And that's why your decision making has to be put on paper, and you got to have a trading plan in a sense that you have to follow that trading plan to the point, to the note, because once you're in the position, you can't trust yourself to make the right decisions if you don't have something systematic written on paper that you are going to do. And we're going to cover that in the next course when we talk about trading plans. But that being said, that should do it for this bias, and we're going to cover another one in the next lecture. In this lecture, we're going to be talking about status quo bias. Now, what is the status quo bias? The status quo bias says that we prefer staying in our current situation or state rather than changing our situation or state. So if we actually Google it, let's put it up here. Status quo bias. Okay. Status quo bias is an emotional bias, a preference for the current state of affairs. The current baseline or status quo, right? And you've heard that before, is taken as a reference point, and any change from that baseline is perceived as a loss. So this is what the status quo bias says. Now, there's been a bunch of studies on it, a bunch of studies, and they've all proven that we have this bias. It is within us, and you know that because you've probably felt that before, where you don't like change. You know that people dislike change. It's hard for them to change. They like being where they're at, and this is just a bias that's within us. It is part of us humans to behave that way. Now, that being said, how did they figure that out? So in most studies, what they've done is that they selected groups and they put them in a current situation, or they gave them a current product, a mug or a pen or whatever it is, and they asked them, would you like to change to that other product or that other situation? And you realize that most of the time people wouldn't change. They would stay with whatever situation they were left in. And then they took different groups and they asked them to choose. And I could basically say, okay, well, if I took 100 people, put 50 on Instagram and 50 on Facebook, and tell them, well, would you like to choose platform or remain where you're at? Most of them will remain. They're not going to change. But if I had taken all 100 people and asked them to choose for themselves, it might be that 80% of people would go in a certain direction than the other. And that's what the tests proved. So they took a bunch of people, asked them to choose something, and most people would choose something. But then when they decided for people didn't change. They would stay where they were placed. And what they actually realized is that the more choices you give people, then the stronger the status quo bias becomes. So if there was only two choices, then there is still a likelihood that somebody says, okay, well, you know what? I prefer being there or having that product instead of this product. But then if they have 20, 50 different options, then it becomes way harder for them to change, and they'd rather stay where they're at, right? And the question was then, why is it we behave that way, right? Is it that we really like, our current situation? We don't, we love it. We don't want anything else? No. The reason why we like to remain in our current state is because we actually fear losing what we have. We don't want to give up having what we have, right? So it comes back to loss aversion, right? It's another one of the biases we've looked at, where when you lose something, the perceived pain of that loss is so big that you don't want to lose it. So most people want to remain where they're at, not because they're fearful of going somewhere else, but because they're fearful of losing what they currently have. Now in trading, that affects us enormously, right? Because you buy a stock and most people are gonna want to remain in that stock and not deviate and not buy something else and just stay in their position. And it's understandable because you have 8,000 different options, 8,000 different stocks you can choose from. So it becomes extremely hard for you to get out of that status quo. So you can have somebody who buys a stock, let's say at this price, the stock is dropping. That person holds it. The stock is not moving, fluctuates, and he's been holding it for months and months and months. How would that make sense? Why would you be in that stock when it hasn't been going your way, when you have 8,000 different stocks to choose from? There's a bunch of other opportunities there. You're just carrying dead money that way, right? You have to jump out of this and jump into another one of them. But no, people are going to remain in it because they think that soon enough it's going to turn around and it's going to make them money. So it's not that they like this stock a lot. It's just that they're fearful of not being in it, going out of it, and then the stock goes up, and then they're going to feel, pain and regrets and blame and all of these emotions that they don't want to feel, right? So in order to avoid feeling these emotions, right, what they do is they just stay in the stock. They stay in the same position. And they end up holding it for so long and not making money or even losing money, right? Just because they couldn't change their situations, change the product, and just get out of this one, get into something else. Again, it's not really, well, I don't want to say it's not their fault, but it's human behavior, right? These are biases that exist, they exist and they're well documented. You can read about them. And they affect us in a way that they make us behave that way, right? They make us behave in a way where we'll hold something that's not going for us for months or years, instead of just saying, okay, well, I was wrong. Let me get on something else. And, not be affected so much by this, this bias and, loss aversion as well and all of that. So you have to be careful with it. You have to realize that we all have this bias, the status quo bias, and that when we're in a certain situation or we have a certain product, we like to remain in that situation or with that product, and we have a hard time changing. So you have to push yourself, to get out of that zone, get out of your comfort zone, and be willing to change what you have. And one of the things that I tell my traders to do is, in their strategy and in their trading plan, okay, and again, trading plan, we'll do that in the next course, they have to put a timeline on how long they can hold something, right? They gotta have a timeline on it. So they could say my max holding period is gonna be 10 days or 1 month or whatever. After that amount of time, they have to get out of their position. They have no choice. They have to follow their rules. They have to get out of their position. And this rule is basically put there to kind of eliminate that bias. Otherwise, you're going to find yourself holding things for far too long, and you're going to be missing out on way more opportunities than, you risk on losing in this one. So that being said, that should cover this bias. Again, if you feel that you need to learn more about these biases, there's a bunch of articles and studies that have been written there about them. So you can just Google them. You'll find so much information about them. And the more you read about them, the more it's going to make sense to you, and the easier it is going to be for you to actually break out of these biases. So that being said, I'll see you in the next lecture. Welcome back. In this lecture, we're going to be talking about anchoring effect. So what is the anchoring effect? The theory behind it states that we anchor to the first decision or information when making subsequent decisions. What does that mean? So let's actually get the Google definition. Anchoring effects. So anchoring effect is a cognitive bias that describes the common human tendency, right? That's the biases we're looking at. Common human tendency to rely too heavily on the first piece of information offered, the anchor, when making decisions. During decision making, anchoring occurs when individuals use an initial piece of information to make subsequent judgments, right? So this is something that, again, it's another tendency that all humans have. And this is something that there's a bunch of studies on it. You can Google it, where they actually test how we anchor to specific pieces of information. And, you know, I'm not going to go through the specific studies, but I actually advise you to do so because it's pretty interesting. But we actually do that. We anchor to the first piece of information or the first decision we've made. Now, this is very troublesome when it gets to trading because it really does affect our trading. So if you had the stock, right, let's say stock ABC, okay, and you believe, you've read some news on it, there's some news that came out that says that this company is coming out with a new drug, okay, that might cure a specific type of cancer, okay, and everything's looking good on it. Reports are saying it's good, clinical trials are saying it's good, and you get in, okay, you buy here. Now you expect the stock to go up, right? But the stock doesn't. It starts fluctuating. And then there's news that, you know, the CEO sold some shares. But then you still believe that, you know, this is good. They're coming out with this drug and this drug is going to work. And then there's some reports of some patients where, you know, it didn't work on them. But then you still believe that, you know, it is going to go up because this new drug is going to work. And then, you know, it comes out that, you know, they fired a few employees, so they're cutting down. Again, all negative signs, stipulating that maybe that this drug isn't, you know, the clinical trials aren't going so good and it might not be released. But you're anchoring to that first piece of information. You're still anchoring to the first piece of information that you see. And this is something that everybody does. You get in a stock for a specific reason. Then with time, things change. Other things happen. But people anchor to that first piece of information and they overweigh it, right? They overweigh that this first piece of information where maybe they had good clinical trials, right? And they overweigh it. They give it more importance. And what happens is that they actually underweigh new information that comes out, right? When new information comes out, they underweigh it, they disregard it, they don't give it as much importance because they're still biased, they're still anchored to that first decision that they made, right? And again, this is something, since it happens so much, I let my traders know, right? When you make a decision about buying or selling a stock, then every single other new information that comes out that has an impact on what you think can happen, you have to evaluate it fairly, right? And you have to forget about your first anchor and value it based on what is going on now, and completely forget, you know, the main reason that you're in it. If there's other reasons that come in, so you give them a fair value, a fair chance to compete on your decision making with your previously used, you know, anchor. Okay. So this is, again, one of the multiple biases that exist, and it is one of the important biases as well. But I think that pretty much covers this one. It's a quick video. Honestly, it's a quick bias. If you want to read more about it online, there's a bunch of articles that you can find and studies. You can read the full research on it. And that should be good for that one. So that being said, we have still a few more to see, which we're going to cover in the next lecture. So I'm going to see you guys in the next one. Welcome back, guys. In this lecture, we're going to be talking about confirmation bias. Now, what is confirmation bias? Confirmation bias theory states that we search for information that confirms our beliefs. So let's actually Google that real quick. There we go. So confirmation bias. Definition. I do not have a definition. Definition. Oh. Okay. So confirmation bias. Let's actually find something better here. The tendency to interpret new evidence as confirmation to one's existing beliefs or theories. Right? So this is the tendency to interpret new evidence as confirmation of one's existing beliefs or theories. Right? Let's see, in trading, did that have it? Investopedia has one. A psychological phenomenon that explains why people tend to seek out information that confirms their existing opinions and overlook or ignore information that refutes their beliefs. Okay? So that is what confirmation bias means. So, that being said, confirmation bias is going to be basically you, okay? Imagine you go online and you search for why milk is bad for you. Then what are you actually doing right now? You're actually trying to find reasons to confirm your belief. You believe that milk isn't good for you, so therefore you go out there and look for information that confirms that. This is not an appropriate way to seek information, right? Or to challenge you challenge your beliefs, right? So if you believe that milk is bad for you, what you should actually be doing is go and look for a reason why it's good for you. So the inverse of what you think. So most people are going to go online, search why is milk bad for you, and obviously, what are they going to find? Reasons why milk is bad for you, right? If I open a page right now, if I go on Google and I write why is milk bad for you, right? What am I going to find? I'm going to find a bunch of websites. Milk is bad for you. Milk and debunking the why milk is bad for you and for your bones. 11 reasons why milk is bad for you. 12 frightening facts about milk. Is milk bad for you? What studies have said. 7 reasons milk is bad for you. So everything I'm going to find is going to tell me that milk is bad for you, because that's what I looked for. So this is really the main thing with confirmation bias. You know, a vegetarian going online and looking why meat is unhealthy. You're going to find reasons why it's unhealthy, obviously, because that's what you looked for. So what you are supposed to do is go look for reasons that contradict your belief. So if I want to cut out milk, instead of finding reasons why milk is bad for me, I should go and find reasons why milk is actually good for me. Because then if I find reasons that contradict my belief, then maybe my belief is wrong. And that's, the process that you should be following. Now, this greatly affects our trading, because you can look at a stock, okay, and most people, you just glance at a stock, glance at a chart, and you already kind of have an idea or a belief about where it should go. You believe it should go up or should go down. And this is very dangerous, because once you have that belief, then confirmation bias is going to make you find reasons that support that belief, right? So if I look at a chart and it looks good, right? Imagine I open a chart here. Let's take this off. Imagine I open a chart. Let me turn this on. Here we go. Imagine I open a chart and I see this stock that's constantly going up. And just by looking at it, I feel that it could keep going up. So what do I do at that point? I go online and I try to find reasons to buy it, because I believe it's going to go up. The problem with trading is you can find reasons to support a buy, and you can find reasons to support a short at any given time. And you can find hundreds of reasons, right? There's so many indicators, there's so many ratios you could look at. So at any given time, you can find a reason to buy or to short a stock. So if you're looking for a reason to buy a stock, look, you're going to find a bunch of reasons. So the idea is to not have a belief and then try and prove it, right? it's to have a belief and try and contradict that belief. So if you think a stock is going to go up, find reasons why it shouldn't go up to see if you can actually find any. And if you can find some, then you're wrong in having that belief, right? And because if you just go on trying to support that belief, you are going to find reasons that support it, right? Now, the other problem with confirmation bias is not only does it affect our belief in where we value information differently, but we actually, so the first pieces of information that we see that tell us, okay, we think the stock is going up, every other information that comes after that, we don't give it as much value as the first piece of information that gave us this belief, right? And that's where anchoring effect also ties in with confirmation biases, where the first piece of information kind of gives us that belief, and then we get stuck, and then we try and find more reasons to support our belief, and we discredit, reasons that don't support our belief, which what we should be doing is giving more weight to what discredits our belief and less weight to what supports our belief. And this is, again, if you decide to become a vegetarian and for you that seems healthy, well, whenever you're reading information about that or new studies come out about that, you should give less value to the information that supports your belief, because that's already your belief, okay? So you have to understand that you're already giving it more weight than you should be, right? And information that discredits your belief, that says that, not eating meat is unhealthy, well, you should give more value to that information, because that's going against your belief. Thus, you're not valuing it as much as you should. So this is really something that's extremely important in trading. Again, most of the times people are going to look at a stock and they're already going to want to have a belief about if they think it's going up or down. And based on that belief, then they're going to go and seek information to buy and sell, which you should extremely watch out for that, because what you want to be doing is looking at the information objectively, and based on that information, building your belief, right? And if new information comes out that discredits your belief, then you should change beliefs, right? And not continue to, find more reasons or discredit those reasons, and actually give them a fair shot at your decision making. So that pretty much sums it up for confirmation bias. In the next lecture, we're going to follow a few more points about psychology. So I'll see you guys in the next one. Welcome back, guys. In this lecture, we're going to be talking about genes and instincts. Now, we've talked about all the biases that humans have and how these biases negatively affect us in our trading. All these biases have been, widely studied and accepted by economists and psychologists. The thing is, why do we have these biases that affect us so negatively and make it almost impossible for us to be successful in trading and stop us from reaching our success, right? It makes it so damn hard. Why do we have these biases? Now, again, the psychology part of trading has been something that's been very interesting to me. So I've dived in it for a long time. I've read about it because I saw the correlation between the more I understood about it and my level of success. The more I understood about it and the more I understood myself, the more I was able to cut losses and generate more profits. So basically my question was, okay, I know I have all these biases, but why do I have them? And that brought me to this conclusion. So this is a bit of my theory, so obviously take it with a grain of salt, but this is my theory on how we came about to have all these biases. So this is basically it. The way I see it is we all have instincts, right? We have instincts to behave in a certain type of way. If you have a cat, if it falls off a high ground, it has the instinct to turn around and land on its feet. A baby, when it needs something to eat or drink, it has the instinct of crying because it knows it's going to get somebody's attention, right? You have a bunch of different animals. Sharks, they're born, and as soon as they're born, they're on their own. They know that they need to hunt. They know what to do without anybody really telling them, right? So there's these instincts, right? And these instincts actually come from our genes, right? So the instincts, they come from our genes. So we actually information is passed through genes, and you can learn through your genes. So the problem with that is what? Is it takes a lot of time to learn through your genes, right? So basically, this brings us to evolution, right? So through evolution, information is passed on, and offsprings of people share the same type of genes as their parents, right? And that's what brings us to survival of the fittest, right? So survival of the fittest means that it doesn't necessarily mean. A lot of people have a misconception of what it means. They think it means that the strongest survive, but it's not necessarily that. Survival of the fittest actually means the survival of whoever is capable to survive in that environment, right? So if you had the traits that were good for that environment, you would survive. Example. Let's say giraffes, which is one of the simplest examples. And excuse my drawing, I'm a mathematician and not an artist. So imagine you have a giraffe. That is going to be the weirdest giraffe ever. You have a bunch of giraffes, and giraffes all had, small necks. Their necks weren't as long as the ones we have now. But some giraffes were born with a longer neck, okay? By chance. By chance, why? Because when people mate or animals mate, sometimes there's a genetic, how would you call that? There's a genetic mutation, and one of the babies can have something a little bit weird, right? It happens. Now the thing is, these infants, and for example, this giraffe that was born with a longer neck was better able to survive because it could reach higher in the tree and eat from parts of the trees that were still there, right? Because maybe everybody had eaten the lower part, right? So they were better able to survive, and because they were able to survive, they were able to mate with other giraffes, okay, and have babies that also had long necks, right? So giraffes had longer necks not because they needed to evolve their necks to be able to reach and survive in that environment, not because the longer neck you had, the stronger you are. No, it was really just by luck. You had genetic mutation. Somebody's born with a specific mutation, but that mutation was good to survive in that environment, and because of that, they survived. They were able to reproduce and give their genes to their offsprings, right? Same thing with, let's say, bears, right? Bears were all brown, but then you had one bear who was born white, and that bear was better able to hide in the snow and camouflage, so it was better able to survive, and thus it was able to reproduce and give its genes to its children. So its children had genes that had this white chromosome, and then they gave it to their children. So it wasn't really that white bears were stronger or anything like that. It just happened to be that they were better suited for that environment. That's the same thing with humans, right? Humans, we've been on Earth for 200,000 years. Okay, so this is a timeline of 200,000 years. And when I'm saying on Earth for 200,000 years, I'm not talking as monkeys. We're talking about Homo sapien, right? Or Homo sapiens sapien, one of probably sapiens sapien, the first one. Okay, so we're still like cavemen, right? Now this is how long we've been on Earth. When we're looking at this timeline, the people that lived 200,000 years ago, right? So actually, let's say, this is minus 200,000. Okay, minus 200,000, and this is going to be the present. People who used to live there, they were in a completely different environment, right? Their environment was completely different. You were constantly being attacked by wild animals. You constantly had to hunt for your food. You had to find shelter. It was not the same environment as we have now. Now, the people who were able to survive in that environment had specific traits, right? The people who survived in that environment were not people who tried new things, because if you tried new things and got out of your comfort zone, you might probably get killed. They weren't people who were risk takers and going out in the wild and venturing out, because you'd get killed. People who were like that died. They didn't give their genes to their children, right? And again, if you think about all the biases that we looked at, let's say the status quo bias. So somebody back then that had this status quo bias, who liked staying where they're at, doesn't like change, well, he would survive. Somebody who liked change, who liked leaving the camp and going in the woods, liked doing something different, they probably die, and they didn't give anything to their offsprings. Now, let's say another bias, like the endowment effect. So if you're endowed with something, if you have this feeling where when you have something, you value it more, you don't give it away, you don't want to lose it, well, our ancestors that had that feeling, they survived because they didn't give their things away. They kept it for themselves. Somebody who just gave his food away, gave his gear, his stones or whatever, they didn't survive. So they didn't give us their genes. So all these biases that we've looked at, and you can correlate all of them back to that environment, they were extremely good to survive in that environment. They were very good. Having loss aversion, feeling that when you lose something, it's way worse than when you gain something. That's good for them because they didn't want to lose anything that they had, and they felt people who didn't mind losing their stuff, well, they all died. We don't have their genes. We only have the genes of the ones who have those feelings that we just looked at, right? So we have the feelings of these guys, right? We have their genes. Now, genes evolved through time, and they change through time, but they're extremely slow to change, right? So we have the best genes, and they're the strongest algorithms. So let's say when you're looking at Google, for example, let's say we're looking at Google's facial recognition. Google's facial recognition is going to be extremely good, but if I put some sunglasses on, I trick it. It's not going to know it's me anymore. If you take a 1-year-old kid, he knows it's you. If you put glasses on, he's still going to know it's you. Why? Because the eyes of a human is the best facial recognition algorithm that exists, because it's been millions of years of evolution that brought that, right? Now, the problem with that, the algorithm is amazing, but it's slow to change. So we have extremely strong algorithms in terms of the way we think, but they're still stuck for that environment, right? Because when you look at this time chart, it was only 5,000 years ago. Okay, it was only 5,000 years ago that we had the first civilization, so people living together, and it was only 200 years ago, okay, that we had in the industrialization, right? So people working in industries. So that being said, and now us sitting on desk working on computer, that's like just super recent. The problem with this is that we're in a new environment, right? We're in a new environment, an environment where there's no tigers running behind you. We have our house, we can go sleep in a warm bed, we have social security, we're good, right? But we still have these same genes and emotions and waves of behavior as our ancestors that were in a completely different environment. And the problem when you're trading, is that you're playing with money, right? And money represents shelter, represents status, It represents being able to reproduce, again, having enough money to cater to kids and having a family. Being able to have food, right? So the same things that were scary back then, shelter, producing food, all of this stuff, when you play with big amounts of money, you get the same feeling as somebody back then, felt when he didn't have enough food, or when there was, a tiger running behind him, right? So you're feeling the same type of feelings that somebody would feel there, and that's showing the same, fight or flight responses and the same types of feelings that you would get, right? And again, we have the same biases as the people who survived that environment. That's why we have these biases. Again, that's my belief. So really, well, the way I view it is, our environment is different and we're not suited for that environment. And this is why so many people feel at trading, because our brain isn't wired to trade. Our brain isn't wired to sit on the desk for 7 hours a day and look at a screen, and when we're losing or making money, which again can be viewed as losing food, shelter, or being chased by a wild animal, to act rationally and think rationally, right? We have certain type of biases that we got accustomed to, and our ancestors that had them were able to give us, that we're kind of stuck with. And going against your genes and what you've learned through your genes and your instincts is extremely hard, and this is why a lot of people struggle with it. But once you actually learn and you give your mind a chance to learn new ways of behaving faced with these circumstances, and you see the profit, then it becomes way easier to change. But you have to trust yourself to go against your instincts and what you feel in the beginning, to actually see that it works, and then have an easier time changing that. Again, this is really a theory that I think explains a bit of our biases. Regardless if you want to subscribe or not to this way of thinking, the biases are still there regardless, and they're still as valid regardless if you agree or disagree with my theory about that. So that being said, I'm going to see you guys in the next lecture. In this lecture, we're going to be talking about misconceptions and ways to improve on handling your emotions. Now, let's start off with misconceptions. I'm pretty sure, and I can bet my life on it, that you've heard a bunch of times people saying, hey, it's fear and greed, the emotions that, kind of ruin people in trading. Everybody is too fearful or too greedy, and that's why they lose money in trading. And even, in most trading movies, you're going to hear that, fear and greed, fear and greed. So, when does greed come in from, popular theories? Well, they'll tell you that if a stock's price is going up and you don't take your profits, okay, and then you end up just holding the stock and it going down, and you're actually losing money because you were too greedy. You wanted to make too much money, right? And whenever you're losing money on a stock, okay, and you just get out of the stock, then the stock keeps going up, goes up after, and you took your loss. You got too scared. You were fearful, and you didn't make the money, right? Because you got out and you just lost money. So they tell you fear and greed are gonna be the emotions that make traders unsuccessful. Okay, it's because of those emotions. Now, I actually don't think that greed has any implication for traders who are not successful. I actually think that greed is not a bad emotion when it comes to being in business, because if you want to make more, you're going to work harder, you're going to find new strategies, you're going to do more things. It doesn't mean that you're going to make a bad decision when you're trading because you want to make more. That greed isn't going to affect you in that way. The only things that affect you in that way are things that you fear, right? So it's all fear. And again, I've had the biggest struggle with my emotion becoming, trying to become successful And I struggled with those emotions for the longest period when I was starting out. And that's the only reason why I wasn't successful earlier, because of fear. So when you're actually in a position like this, why do you keep holding it? Not because you're greedy and you want to make more money. The actual reason is because you fear getting out of it here, right? You fear getting out of your position, and then after you get out of your position, the stock continues to go up, right? You're scared to get out here, and then the stock increasing, right? You're scared to get out here, and then the stock just keeps going up. Why? Because if this happens, you're going to feel a lot of regrets, a lot of blame, right? And you fear feeling those emotions. So in anticipation of future emotions, you keep holding it because you don't want to get out of it, and then it keeps going up, and then you have this regret and all these negative emotions. So you just keep holding it. So the reason why you keep holding it wasn't because you're greedy. It's just because you fear that it continues going up without you being in it. And when you're losing money, again, you're fearing holding it, and then it keep going down, and then you blame yourself that you held it. So it's always fear that's gonna control you, right? And just look at anywhere in your life where you're struggling. It's always gonna be related to fear, fearing something, because you're running away from fear, and that makes you do the wrong decisions. You're not, when you're running towards something, and could be greed, could be whatever, that's not going to negatively impact you. What's going to negatively impact you is you running from something, which is usually fear, right? So different fears, but it's always going to be fear. So that's really one of the misconceptions that I feel. Now, ways to improve on your trading psychology and on your emotions. I feel that in the beginning you should have a diary, right? And I still have one right now where I write notes in it about my trading and what I did right, what I did wrong, what I should change. I don't use it much. I might look at it once every month, but when I started off, I was using it every day. And as you get better, you start using it less and less, and then once a week, and then once every 2 weeks, then once a month. So use it less and less. But in the beginning, it's very important for you to use it every day. And you're going to have to make daily reviews on them. So at the end of your trading day, when you look at what you did right and what you did wrong, did you do your technical analysis, your risk management, all this stuff, where you need to work on. But then I challenge you to actually look at how you handled your emotions during that day. Is there a type of emotion that affected you in a negative way, that if you had that under control, you would have made more money, or you wouldn't have lost money, right? So if you didn't take a loss because you felt it was going to come back, or you interpreted information in a different way, or you changed your stop loss, well, that has to do with your emotions, right? So what emotion caused that? And how can you prevent that in the future, right? So you really want to treat your emotions and how you handle your emotion as just another facet of trading that you have to improve on, right? And now you want to look at, is there a specific bias that affects you? And if you find one at the end of your trading day, you put it on paper, you note it down, and you put on paper what you should do next time when that situation arises. So for example, if once you get into a position, you got into a long position and you think it's going up, but then there's a news that comes out that it's not so good, but you still think it's going up, right? So you were anchoring to the first piece of information, and then the stock drops and you lose money. So at the end of the day, you look at it and you tell yourself, okay, well, look, I anchored, so I'm going to note it down. I have this tendency, I'm going to put it on paper, and next time that I get into a position, I'm going to put it down that if a new information comes out, I'm going to give it, and it goes against my my initial position, then I'm going to give it more weight. I'm going to give that news more weight and take out my position if it doesn't seem right. So then you leave that on a piece of paper, and it stays in front of your screen like all your other rules, and that way you don't forget about it and you improve on it. And when that's done and you're good at controlling that type of emotion or that bias, you move to the next one, right? And you move slowly but surely, you start removing biases and you start improving on how you handle your emotions. Okay? So that being said, that should cover this one. and that covers actually this chapter. And I'll see you in the next video, which I'll make just to include a bit about this course. Hey guys, welcome to Montreal Trading Group, where we're all about trading. If you're interested in trading in any way whatsoever, consider subscribing. Now, in this video, we're going to be covering one of the best screeners out there, Finviz. Now, let's just jump into it. As soon as you get on Finviz, this is what you're going to see, their main page. Now, we're only going to be looking at their screener today because honestly, this is the best tool they have, and this is what most traders and most people use their site for. Now, there's a bunch of other stuff like seeing what the index have done today, looking at the heat map, knowing what the industry's been doing, top gainers, top losers, some technical analysis tools. I might make another video soon about those, but today we're going to be covering the screener. Now, what is a screener? A screener is basically a tool that you can use to subset the markets and find stocks that fit criteria that you're looking for. So whenever you're running a strategy, you're not running a strategy on all the market. There's too many stocks. You gotta find stocks that have a predefined set of criterias that work well for your strategy. And that's why you need to screen for them. Now, this is how you're going to use Finviz Screener, and Finviz Screener is very comprehensive and it's actually free to use, and that's why a lot of people use it. Now, let's say you're doing a fundamental strategy and you're a value investor, okay? And you want to look, and I might give two examples, one for a fundamental investor and let's say one who wants to trade momentum stocks, growth stocks. So if you're a fundamental value investor and you want to look for some value stocks to invest in, you might want to say, okay, well, I want stocks that have a low PE. Now, you look at this. There's 7,000 stocks that you have right now. If I want to start to narrow down this list and have fewer stocks, I gotta tell Finviz what are the criteria I'm looking for. If I go here on fundamentals, I can tell Finviz, look, I want stocks that have a low PE, a low price to earnings, because I know that low price to earnings stocks are value companies. I'm getting them for cheap, right? So I can select low, and then I went from 7,000 symbols all the way down to 850 symbols. Now I might want to say, look, I want a stock that gives high dividends, because companies that give high dividends are stable and good companies. So I can go in descriptive, and in dividends yield here, I can say I want high yields. Now I'm down to 173 companies. I might also have a criteria, since I'm a value and conservative investor. I want something that does enough volume. I don't want something too illiquid where I'm not going to be able to get out of my position when I need to. So maybe I'm going to say I want something that does over 300,000 shares a day. Then I might also have, now I'm down to 60 symbols. Okay, we got a company in Spain, Mexico. I might say I just want to look at US companies. I'll be down to 48 symbols. Then I might say, okay, well, look, I want something that's in the financial sector, because maybe my portfolio doesn't have enough of those. So you can just select financials, and then I'm down to 38 companies. Then I can look at those companies and see which one would be best for me as a value investor, right? And you have some that have super low PEs, and they look pretty good, right? So what information do I want to see from them? You actually have different informations. You can go under the valuation tab and see valuation information like PE, forward PE. You can see their earning, their EPS. If you want to look at financial information, you click on the financial tab, you'll see their dividends, ROE, ROI, debt to equity ratios, a bunch of other ratios that would be important to you. You can actually go under ownership and see what's the float on them, what's the insider ownership, institutional ownership, short float. So it's really up to you what you want to look at. If you want to look even at charts, you can see their charts and it'll give you a quick look. Maybe you want something in an uptrend. So it's very helpful. And if you want to get more information, you can actually click on custom, and this you'd have to be an elite member. Being elite is maybe $30 or $40 a month, and the benefits you get from being elite is, for one, you can add custom information, and you can export this data to Excel. Otherwise, you just gotta view it on the website. There's a bunch of other things that are offered in Elite, but these are the two ones affected by the screener. Now, you might want to click custom and then click on settings and tell Finviz what you want. Do you want to get return on equity? Do you want to get return on assets? Do you want to see the net profit margin? And if you are an Elite subscriber, you can actually export it to a CSV file. It'll just download, and then you can use that information to make your analysis, comparative analysis or whatnot. Now, if you're not a value investor and you're actually a trader like us, let me take this off, and you just want to do maybe a momentum strategy and you're looking for growth stocks that fit a certain criteria, you can use Finviz as well for that, and it's actually pretty helpful. Let's take this off. Here, financials. So if you're looking for a growth stock, well, we know that for growth stocks we need something that has a high PE. So let's go to fundamentals. PE, let's put it over 40. So something that's expensive. Then we might say, well, a growth stock doesn't give any dividends, right? Because they're just reinvesting in themselves. I'll go no dividends. Okay. Right now I'm looking at 380 symbols out of the 7,000. I might say, okay, well, look, I'm looking at a certain sector. I only want to look at healthcare. And the reason for that is I know healthcare is very volatile, and I want something volatile that can just explode. Then I might say I also want to buy something as it's breaking up. I don't want to buy it at any time. So maybe I want to buy something when it breaks its 52-week high. So when it's at its highest. So I can go in under the technical tab, which has a lot of things that you can use for from a technical point of view. So the 52-week high would be one. 52-week high, I can select, okay, I want something that's at its new high. And now I'm down to only 6 stocks. So I can be looking at these stocks. And let's take a look at this one for example. All of them are at their 52-week highs. And then my strategy can be around those. So those can be on my watch list, and if they're breaking up tomorrow and they're continuing this momentum, I can buy it. But then if they break down, I can just have a tight stop loss and take out a stop loss in that way. So this is really how you can use Finviz to screen based on a strategy that you have. So I really highly recommend using them. You don't need to be an Elite member. Their free version is more than enough. As you can see here, I didn't need to export in an Excel or anything. Something that's really nice about them is that they actually have alerts. So you can create an alert, but for that you would need to be an Elite subscriber. And that alert would permit you to get alerts via email for when a stock fills a certain criteria. So I might say, well, when the stock gets to the 52-week high, let me know right away. So I'll get an email and I can buy it right away as it's breaking new highs. So you can use it for that as well. I have guys who use it and they like it, But otherwise, just the screener. If you have any strategy that you wanna run, you cannot run it on the whole market. You gotta subset the market. The whole universe is too big. Subset the universe to a specific set of symbols that fit the criteria that work best for your strategy, and Finviz is going to be one of the best tools for you to do that. If you guys have any more questions regarding Finviz or regarding any other tools, post it down in the comment. I'm most definitely going to make another video where I show you how to do some more in-depth screening using Finviz and some other tools. For now, take care guys, and I'll see you next time. What's up? In this video, we're going to be talking about what's the best trading software out there. My name is Mohsen, And this is Montreal Trading Group. We're a proprietary trading firm, so we know all about trading. Now, out of all the softwares that we've used throughout the years, this is by far the best one, the easiest one to use, no problems, intuitive. It's by far the best, and let me show you why. So we'll log in right now. So tradingview.com. So the software is actually TradingView, and I'll go over a few of the things that I think make it so good, and then I'll let you judge for yourself. So as soon as you get on the page, the first thing you see, top authors. So these are people who put their trading alerts or trading ideas out there. You can follow them. You can see what they think is going to happen to a stock and the explanation for it. You can comment on it. So very useful. I gotta admit, I don't use this as often, but if you're a new trader and you want to get some ideas, follow some of the guys who have some good ratings and see what they do and learn from them. So this is something that's very helpful. Again, I haven't used it that much. Now, the really nice thing about TradingView is you have access to all the markets. You have all the currencies, Spain stocks, Indian stocks, anything you want, you're going to be able to get it there. Now let's jump into the charts, because that's what you're looking for. So when you go on the charting, usually you're going to be met with this page, and let me just take this off. And you have your daily chart for whatever stock you want to look at. Let's say Apple. Okay? You can basically do anything you want to do. Anything on these charts. So if you want to draw some trend lines, you can go on trend line and draw the trend line that you want. Okay, here you go. Easy as that. Fully customizable. You can double click on it, change the color, change the size, whatever you want to do, you can do really on here. Okay, you want to put a pitchfork, which I don't know why you would use that, but here you go. You can do that as well. Any type of indicator you'll find on you. If you're doing videos or if you're an educator, super nice. You can write things on it, draw stuff. You can put text. By here, whatever color you want, and you can move it anywhere you want. So fully interactive, very easy to use, and as you see, you want to use Elliott waves, whatever type of patterns you can think of, they have it, right? If you're going to be, let's say you want to do a long position somewhere, maybe you want to buy here, and you want to see your profit and loss, well, you can just you can use this tool, put your entry price, your stop price, your take profit price, and then you'll actually have your ratio for win-loss return. So very easy to use and very visual. So no other platform has this. We actually used to use eSignal, which I actually have here. I'll open it right now. Back in the days, everybody used eSignal. eSignal was the charting software that all traders used. Okay, it was the best one out there, and that's the one we've used. We're still subscribed to it, but again, it's uncomparable right now. So this actually reminds me that I have to cancel my subscription, but we still have it. But it's not as user friendly. Sometimes it bugs, and you open it and there's no quotes, and it's more expensive. Okay. And I'll come back to the pricing of this one because you can actually use it for free if you want. But as of this point, everybody here is using TradingView, and everybody that I know honestly uses this. What else can you use? Icons. If you want to put some icons on it, you can do that. Zoom in, zoom out, measuring stuff. So you can really do whatever you want in terms of drawing on it or simplifying things for yourself by putting them on the chart. Now, indicators. If you want to put indicators, all you got to do is right click, or you can actually go on indicators here, or again, right click and click on insert indicator, and you have every type of indicator you can think of. Okay, so if you want to add a Bollinger Band, just put in Bollinger, here, Bollinger Band, and you have so many different ones, and you just add it, and here's your Bollinger Band, add it. If you want to add something else, let's say an RSI, relative strength indicator, put in RSI, here it is, just add it, and it's at the bottom, right? And again, you can change things. If you want to change your levels on the RSI, you can do that. If you want to insert a moving average, again, simple moving average, SMA, here we go, and you get your moving average. If you want to change the moving average from, let's say, it defaults at 7, let's say you want a 200 period moving average, put in 200, here you go. So super simple to use, has all the indicators you want. Now, on top of all of that, and this is why I think it could be very beneficial, if you're trading, and let's say I'm trading this stock here, okay, and you say, okay, well, this looks like a support level, I'd want to buy it if it breaks below this level. You can just right click and click add alert, and if you do that, it'll say, okay, well, what is your condition? Condition is that this stock crosses the value of this. When that happens, I want you to show me a pop-up, play a sound, send me an email, even send me a text message. So you can create your alerts just like that, and then you have an alert created. And whenever the price falls to that level, you're gonna get an alert, so you'll know about it. And you'll see here, I have so many alerts, right? And this is, in this section, you can watch your alerts. So I have so many alerts, and this is the alerts log. I had so many alerts that were sent out to me today, and yesterday, and the day before. So very useful if you're looking at a lot of stocks. Another thing that's super useful is you can actually click here and see multiple stocks at the same time. So if you want to see one stock, you click on this, but if you want to see 4 stocks at the same time, you can click on this, and then you have 4 windows. So you can monitor 4 symbols at the same time. Super, super useful. You can actually go up to 8 if you want. Now, time frames. Now we're looking at a daily chart. You can actually click on daily and then see, well, do you want 1 month chart, 1 hour charts? Okay, so you can check 1 hour charts. You can check 5 minute charts, 1 minute chart if you want. Okay, so every type of time frame is available on there, and super easy, super intuitive to use. You can actually do way more things. You can actually combine symbols. That's more advanced, but it gives you the opportunity to do things like that. If you want to create or publish your own ideas, you can do that. You can have people follow you. So that's also something available. Now, the other nice thing, watch list. You can click on here and you have your watch list. So these are symbols that you want to watch for. So these are the symbols I'm watching today, or that I've been watching for the past few weeks. If I want to add another symbol to them, let's say Apple, I'll just go here and say Apple, and it gets added to my watch list. So super easy to follow them in that way. And you can have a lot of different watch lists. You'll have, you see I have one for Brazilian stocks, Bovespa, and Hong Kong stocks, and foreign exchange. So I have different watch lists for different things that we trade, right? So again, very useful to have that on. That being said, there's way more things you can do on them, and I'll let you play around with it because you just learn by playing around with it, I guess. You actually have another one nice part is going to be the hot list. So things that are moving today, biggest gainers, biggest loser. You have a calendar if there's big news on something. Everything you want. Now, pricing, which is what you want to know about it. To be honest, okay, so the one I'm using right now is the Pro Plus, and that's the one we're all using actually. You can actually start using the free version. Okay, you can use the free version, and it's gonna meet your needs for most people, right? For most people, it's gonna meet your needs. If then you require more, go to the Pro, okay? And then if you require more, go to the Pro Plus. If you require more, go to Premium. So don't just go and buy one of them right away. Start off with the most basic one. Once you want to use an indicator or something, and it tells you, oh, you need to be a Pro member to use that, then upgrade. So don't upgrade right away. Wait until you need it. The main difference, honestly, between like Premium and all of these, well, on the free one, you can only have 1 chart. On the Pro, you can have 2. On the Pro Plus, you can have 4. Premium, you can have 8. So we don't even need to have 8. So we just use the Pro Plus. devices on the same account. Well, if you want to be able to log in from 2 different accounts, 2 different computers, well, you need a Pro Plus. If you need 5 computers, you need a Premium. How many alerts are you going to be using? Free, you can only use 1. Pro, 10. Us, we use more, so that's why we get the Pro Plus. How many indicators are you going to put per chart? So again, in the beginning, you can start off with the free. As soon as you see you need more, go to Pro. If you need more, go to Pro Plus. Okay? And the pricing is honestly super affordable. And you can just go on a monthly plan where you're paying, I guess if you go monthly, it's probably going to be more expensive than that. But on the Pro, it's $10 a month, which is nothing. On the Pro Plus, $20 a month, it's just nothing. Again, we were paying like $100, but that's including the quotes for eSignal per month. So again, that's super inexpensive, even for the Premium. To be honest, it's not expensive at all. So this is honestly the best charting software out there. Give it a try. I'm actually going to put a link in the comment section, and I've probably put one up on the screen somewhere if you're watching this on YouTube. Go on it. I'll make it lead to our page, so you can follow us, because I want to start putting more of our ideas on there, so you can follow our ideas as well. If not, I'll put our name into the comments so you can follow us as well. That being said, subscribe to our channel and like this video. Take care, guys.